Vishal, will you let me know once I've gone live? Am I live now? Okay. Why is it not showing in this tab? All right, okay, hi. Good afternoon, morning, good evening, all of you. How many days left for the exams, Feb folks? क्यों याद दिला रहे हो? How many days left? 16 days, 15 days for you. Okay, how is the feeling? क्या है, चलेगा? Hi YouTube, how is everyone doing? I can see a few candidates, the usual names on the chat box. Good to have you here. Hello from New Zealand, hello from India. Shri Hari Soni, and she is halat tight hai sir. Excited, who's the excited one? 14 में डर लग रहा है, सर ऐसा लग रहा है कुछ नहीं आता. Okay. So I must be I must be Newton. I seem to discover new formulas every time I watch the lectures. Hello from Malaysia, hi from India. Okay, we have someone from Zambia, good to have you here. I have a question, I only watched FSC session, didn't watch day 3, day 4. You can watch them later, we're going to keep them on YouTube. Hello from Bhopal, okay. Hello to everyone. All right, we have a fantastic subject ahead of us today, which is fixed income. And I know I say this almost at the beginning of every session, but I believe it when I say it, because I truly find a lot of joy in learning and teaching this subject. Fixed income is mathematical of sorts, so there are 2 parts to it. One is your calculations, and there is a long chain of calculations that we have to do. Almost my guess is about 40 to 60 different variations of calculations today. And then there is an equally large number of list of factoids that we need to memorize. Factoids means government bonds, do they follow actual by actual convention or 30 by 360-day convention? Which one? Actual by actual, right? So a long list of stuff that we need to memorize. I'll highlight as many as I can from you. It's going to be a longer session. I don't know when will I be able to finish. Okay, that's my disclaimer right at the beginning. Though our official time is, we start at about 2-ish afternoon, go on till 10. Today I really don't know, right? We'll try to squeeze it in the time, but we'll see how things follow. So with this background, if everyone is ready, give me a large I pass on the chat box, and then we will start the subject. Okay. Glad. Now, we are going to start today's session with one comprehensive question. One question that will cover probably 70 to 80% of calculations that you have at level 1. One single question will cover all of them in one go. I eventually want to create a question like this for every subject at level 1. But right now my framework on fixed income is ready, right? So we'll start there. The question will have multiple subparts. So what I'll do is I'll lay down the whole question together at once, everything that I can think of. But we will solve 5 at a time, which means I'll give you time to solve the first 5. Then I will solve the 5, then you solve the next 5, then we will solve the 5, right? That way we can work in partnership. So let us start. For this question, we have a bond with a face value of 1,000. Coupon rate of this bond is 10% per annum. Maturity of the bond is 4 years. The spot rate curve is as follows. This is year. These are your spot rates in percentage. Year 1, year 2, year 3, year 4. Spot rate 10, 12. I'm intentionally keeping the deltas very large. Of course, we know in practice it's kind of unreasonable to have these kind of jumps. But 10, 12, 15 and 18. That's it. This is my basic data. Now, based on this information, question number 1. So let me create different blocks of question together. So let's solve the green block first. Question number 1, I want you to value the bond, okay, using spot rates. Question number 2, then find out what is the YTM of this bond. Preferably, I will prefer if you show me an equation of how the YTM was calculated. Of course, you can't solve for YTM, you'll have to use the TVM row, but show me an equation of how YTM works in that equation. Then question number 3, find out all the 1 year discount, all the appropriate discount factors. Question number 4, value the bond again, okay, using the discount factor shortcut expression. And if you don't know what this is, I'll show you, but there's a shortcut way to value this bond. So value the bond using discount factor shortcut expression. And 5, please quote relationship between various spot rates and yield to maturity. What is the relationship between various spot rates and yield to maturity? These are your first 5 questions. You can start solving it, and I'll try and prepare the set of next 5 questions in the interim. Please let me know once you're done with the first 5. I'm done with 20 questions so far. We're probably looking at maybe about 25. One question should revise most of the stuff for you. Are you done with first 5? Yes. 4, okay. Waiting for it. Do you want to see the questions again? Putting them on a screen briefly. As I said, one question will cover almost every calculation that you have in the fixed income. Okay. So we have 24 questions to deal with. Please let me know once you're done. I'd like to start solving. Should we start solving? Okay. So now I want all of you to focus. Right now, learning objective is just this. Okay, we have to master these 5 concepts. First, how will I value a bond using simple spot rates? Your rule or the thing that comes to your mind is respective cash flows, respective spot rates. Okay. So I have a bond with 4 cash flows. So let's do question number 1 here. Cash flows are 100, 100, 100 and 1100. Respective cash flow will discount with respective spot rates. Spot rates are 10, 12, 15 and 18. So 1 plus 10%, 1 plus 12%, 1 plus 15%, 1 plus 18%, raised to 1, raised to 2, raised to 3, raised to 4. We solve for it, we get the answer. How much is this? 80? 3.7. How many of you got this right? Give me hand raise or I pass on the chat box. Okay. Online you can type in I pass 1 for the first question. Second, now we need to figure out what is the YTM and probably equation. Now, how will the YTM work? So we have same 100, same cash flows. However, now we'll say, I don't want to use this 4 rates. Okay, I don't want to use this 1, 2, 3, 4 rates. Can I not simply use 1 rate? Okay, instead of using 4 separate rates, So that means what I'm trying to do here is somehow average out the 4 spot rates. So 1 plus y raised to 4. And what I want is I want the valuation to be same. This y that you have in the denominator, this is calculated using trial and error method. And who does trial and error for you? The calculator, right? So the calculator will find out what is the YTM. So please do it together. Second, clear TVM. Second, clear TVM. 100 payment, 1000 future value. 4N, 803.7 negative present value. Compute IY. 17.17%. Those of you got the second piece right, can give me a I pass 2 on the chat box. Let's go to question number 3. Give me hand raise. How many of you? I'm guessing. Okay, good. Nice. So second one is out of the way. The third one, let's find out all the discount factors. These discount factors, we call them as the Z factors or Z factors. So we have 4 of these. First, 1 divided by 1 plus 10% raised to 1. 1 divided by 1 plus 12% raised to 2. 1 divided by 1 plus 15. 1 plus 18% raised to 4. These are your discount factors. Help me with each one of them. Just one of you. आप बोलिए ना with 0.9, 0.909, second one 797, okay, 515. Can we please take a total of the 4 discount factors? 2.87. Okay, nice. Now, once I have done that, then how do I use these discount factors, which is your expression 4, okay? There is a possibility that on the exam, they'll give you a table just like this with all the discount factor and ask you to value the bond. If you have data of this, then there's a very faster, elegant way of solving this question, which is, the formula is, I will take coupon, I will multiply that with the total of your discount factors, plus I will take face value multiplied with the last discount factor. So my coupon amount is 100 multiplied with 2.87 plus face value of 1000 multiplied with 0.515 should give you the same bond valuation of 803.7. If you are precise with your decimals, you should be here. How many of you got this part right? Okay, very nice, good. Question number 5, relationship between spot rate and YTM. So see, our spot rates were like these, right? We had 10, 12, 15 and 18. Now for these spot rates, we got a YTM of how much? 17.7. 17.7, right? 17, okay. Can I say first that YTM is an average of various spot rates, and typically YTM will be closest to the last spot rate. This is 18, this is 17.17. Now, what kind of an average is this? Is it an arithmetic average? No. Is it geometric average? Harmonic mean? No. It is a weighted average. Okay? And weights are determined based on the cash flows, and which one has the highest cash flow? The last one. Therefore, this is closest. Okay? Now, my question to you, and I'm very confident if I ask this question to maybe 10 CFA chart holders, at least 6-7 of them will get this wrong. So then, can I conclude that if the spot rates are 10, 12, 15 and 18, YTM will be 17.17 because it's an average. So if the spot rates are 10, 12, 15, 18, average will be 17.17. No, why? Because depending on the bonds, the weights will change. Imagine a 2% coupon bond versus a 20% coupon bond, right? So do you think the weight of the last cash flow as a ratio to total cash flow will change? Quite significantly, which means in the same set of spot rates, but different bonds will have different YTMs depending on the respective weight of their cash flows. Is this clear? So that concludes your block number 1. Any questions you would like to ask? You can ask me now, either on the chat box or you can ask, just raise your hand and ask. Good. All right, then let's solve the next 5 questions in the yellow box. These are your next set of 5 questions. Please solve them and keep on explaining them in the, keep on posting your answers in the chat box. Okay, someone is asking, can you explain the last part again? Sure. Explain the last part. See this YTM number that you see, okay? It is an average of, YTM is an average of these 4 rates, 10, 12, 15 and 18. But what kind of an average is this? It is a weighted average. Okay. Now, obviously the last cash flow has the highest weight. For example, what are my cash flows for this bond? Cash flows were 100 rupees, 100 rupees, 100 rupees and 1100 rupees. Since I had the highest cash flow in the final year, YTM came closer to this. But what if I have some other bond which might have a cash flow of, I'm just making up, let's say 10 rupees and 1010 rupees. For this bond, obviously the YTM will be very different because the weight of the last cash flow vis-a-vis rest of the cash flows is significantly higher, right? 1100 is 11 times of the coupon, but 1010 is 100 times of 10 rupees or 101 times. So weight of the last cash flow will change, the YTM will change. All right, please solve the subsequent ones. These are the next 5. Sneha is asking why didn't we use the formula for Z factor here? I don't know which formula you're referring to. Maybe you're confusing with the par rate formula. That will solve subsequently. That's called par rate. Avanti says hello. Hello, Avanti. Captain Trader says all spot are equal to forward rates, not YTM. I don't know what you mean by that, Captain. Please keep on posting your answers on the chat box as and when you're done. Avanti, I've captured some of those questions towards the end, solving 24 questions today in the first section. Please let me know once you're done so that I can start solving them. How many are you done? All of them? Nice. When are you taking the exams? Good. What's your name? Vaidhi. Good job, Vaidhi. That's impressive. Vaidhi is done with all 5. Sneha Patil is done with all 5. Pritesh is done. Okay. Do you want me to solve them now? Yes? Okay. Let's do it together. Just create some blank pages in between. The sequence in my answers might be a little off, but you can arrange this later on. We'll solve question number 6. Question number 6 is calculate all 1-year forward rate. So see, your spot is 10, 12, 15 and 18. How will I calculate 0y, 1y? What does a 0y, 1y mean? It means after, help me out, 0 years for 1 year. Graphically, how does it look like? If this is time 0, this is time 1, this is the rate we're talking about, 0 to 1. 0y, 1y is nothing but 10%. Then 1y, 1y. What does this mean? It means after, help me out, 1 year for 1 year. How does this graphically look? This is 0 to 1. This is 1 to 2. We're talking about this rate. After 1 year for 1 year, either for borrowing or lending purposes. Here, the way we construct the formula, 1 plus 2 year rate divided by 1 plus 1 year rate and minus 1. Technically, there is an under root 1 here, right? But we don't write since it's just 1. So, how much is this coming to? 14.03. Then, 2 by 1 by, which would mean after 2 years for 1 year, which means the rate that's applicable between 2 and 3. How would you solve this rate? 1 plus 15% raised to 3, 1 plus 12% raised to 2, minus 1, how much? 21.24. How would you solve for 3y, 1y? It would mean after 3 years for 1 year. So rate between 3 and 4. That would be 1 plus 18% raised to 4, 1 plus 15% raised to 3, minus 1, how much? 27.47. Okay. Bonus question. How would you solve? Let's see how many of you can solve this. 1 by 3y. Is it possible to solve for 1 by 3y? Yes. What does it mean? After how many years? After 1 year. For how many years? 3 years. So 1 to 4. Whenever you are calculating rate, which involves multiple years between, how many years does it involve? 3 years. It is going to be under root 3. Because it's like dividing by 3, right? Once you get the total rate, you have to divide by 3. So what will be the formula here? 1 plus 18% raised to 4 divided by 1 plus 10% raised to 1. Then we take the difference of these exponents and we take the third root. 4 and 1 difference is third. And we can also see that we are, this thing inside the bracket of sorts, this thing here, this is basically a total rate for 3 years. Okay, now when I take the third root, I divide them per year basis, minus 1. Okay, so how much is that? 20.7. Okay. And then how would you solve for a 2y, 2y? It would mean after 2 years for 2 years. So we're talking about this rate. Now, the moment you're looking at 2 years, you know there's going to be under root 2, right? So what would this be? 1 plus 18% raised to 4 divided by 1 plus, second year kya tha? 12. 12% raised to 2. Under root 2 minus 1, how much? Come on, help me out, quick. Hmm? 24.32. So you should be able to calculate any of the forward rates once you have the spot rate structure available with you. Okay. So what we did is we did 0y, 1y, 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 2y, 1y, 3y, 1y. These rates, the first 4, the second term was always 1y. That means we calculated 1 year forward rates. After 1 year or 2 year or 3 year. Here, then we did 1y, 3y. Okay. Then we did 2y, 2y. We could also do, maybe just for practice, one more 1y, 2y. 1y, 2y would mean after 1 year for how many years? 2 years. So we want 2 to 3. So this gives you a hint that third year rate should be the numerator now. So 1 plus 15% raised to 3. And 1 year rate in the denominator, 1 plus 10% raised to 1. Difference of exponents is 2. So under root 2 minus 1. 17.58%. You should be able to handle any forward rate as long as the spot rate structure is available. Okay. Now, just because I want you to be able to think about this, I'm going to give you a visual representation on how it looks. If I want one rate to discount cash flows between 0 to 1, okay, or one rate to discount cash flows between 0 to 2, or one rate to discount cash flows between 0 to 3, and one rate to discount cash flows between 0 to 4. Which rate is that going to be? Just one rate to discount the cash flows. Spot rates. Respective cash flow, respective spot rates, right? So here rate will be 10%, here 12%, 2 times. That's why we do raised to 2. It means in the denominator I have 1 plus 12 plus 1 plus 12 2 times. Here the rate is 15%, how many times? 3 times. So I'm using the same rate for every region. And here 18%, 18%, 18% and 18%. That's how you visualize spot rates. Then how do you visualize forward rates? If I have to discount some cash flow from time 0 to time 4, then I will use a different rate from 0 to 1, a different rate between 1 to 2, a different rate between 2 to 3 and 3 to 4. 0 to 1 rate is same, 10%. But a rate applicable between 1 to 2 is your 1 by 1 by. After 1 year for 1 year, which is how much? 14.03. So forward rate is used only when you have a specific requirement of discounting cash flow from year 2 to year 1 or compounding cash flow from year 1 to 2. मतलब ये जो रास्ता है, this route, this rate is useful only when you are migrating from 1 to 2 or 2 to 1. Okay? But if you want to go from 2 to 0 directly, then 12%. So if I have a cash flow that I'm getting in year 2 and I would like to directly take it to year 0, then I can simply divide that with 1 plus 12% raised to 2. Or, and remember now, in the class I told you, discounting cash flows with spot rate is like a direct flight. Once you get into the flight, you don't need to change. But what if I want to use connecting flights? I'm getting some cash flow in year 2 and I would like to bring it to time 0. Then once I will divide with 1 plus 14%, and then I will divide again with 1 plus 10%. These are called connecting flights. And so forward is some sort of a connecting flight for you. What is the rate applicable between 2 to 3? So that should be 2y, 1y, 21.24. What is the rate applicable between 3 to 4? 27.47. Okay. Now you would say, okay, fine. But what if, let's assume this is from Delhi, you're flying to Washington DC maybe, okay. So you go to Delhi to Doha, Doha to, I don't know, Munich, Munich to New York, New York to DCSA, some random flight. Now what if you say, you know what, is it possible to at least reduce the time of the flight a little bit, change the number of hops? Yes, we can. How? We also have a 1/3y rate, okay. Now how to think of 1/3y rate? After 1 year for 3 years, so 1, 2, 3. So maybe I can just use one connecting flight from here to here and then one rate from here to here. Okay, so 0 to 1 rate is 10% and 1/3y, which means one rate for 3 years. 1/3y, what was that rate? 20.7. So if I use 20.7% to discount, single rate to discount for these 3 years, it will still work. Are you getting the feel of it? So when I discount cash flows using route 1 or route 2, my discounting will turn out to be exactly the same. Give me a hand raise if you feel more than 80%, 90% you've understood this. Okay, good. Online, give me a I pass or I struggle with this. How about visually, how should I think of, let's say, a 2y2y? A 2y2y would be one rate between, bolo? 2 to 4. A 2y2y is the rate. So 2y2y is here visually. I don't think you've understood this. Okay. See, so think of it this way, okay? Think of it as destination 0. Okay? Destination 1, destination 2, destination 3, and destination 4. My job is I want to take a flight from 4 to 0. Now, flight means discounting cash flow. Some cash flow that I'm getting in year 4, I would like to take it to year 0. One way is, I will say, you know what, let me just take a direct flight. Let me directly go from 4 to 0. That means one rate that I will discount 4 times in the denominator, raised to 4. What is that rate? 4-year spot rate, which is how much? 18%. Alternate ways, you would say, let me do 1 year at a time. Let me go 3 to 4, then 3 to 2, 2 to 1, and 1 to 0. These are your 1 year forward rates. Okay. So first 1 year forward rate was 10%. Second 1 year forward rate was 14.04. Then third 1 year forward rate 21.24. And fourth 1 year forward rate 47. Okay, that's another way to reach. But are these so only 2 ways? No. Now I can also take a hybrid of the 2. Still a connecting flight, but not 4 hops, maybe 2 hops, right? So maybe I can go from year 4 to year 3 directly, and then year 2 to year 0 directly. ऐसे भी रास्ता ले सकता है. How will I do it? I will need one rate that will work between 2 to 4. So after 2 years, for 2 years, what rate is that going to be? 2y, right? So 2y, 24.32. So I will use 24.32, but remember when I am discounting now, this will be 24.32 raised to 2 because I am going 2 hops, right? And then I want to go from year 2 to year 0. For that, which rate is available? A 2-year spot rate. A 2-year spot rate is how much? 12% for 2 years. This will also work, will get you the same answer. Is this the only way? No. What I can also do is go from year 4 to year 1 directly, and then year 1 to year 0. That will also work. Now visualize. If I want to go from year 1 to 4, I need one rate between 1 to 4. So which means a rate starting after 1 year for 3 years. What should be the rate? 1/3y. है ना? 3 साल के लिए 1/3y. What is 1/3y? 20.7. So I can use 20.7 here and use 10% and it will still do the job for me. Any combination will work. Are you with me? maybe I can also go from year 4 to 3 using forward rate, and then after destination 3 take a direct flight 3 to 0, which is a third year spot rate. Okay, yes, no, show me a little confidence please. I hope you understood this. If you have, then we go to question number 7. How would you value the bond using forward rate? Okay, so I just told you valuation of bond using forward rates. I can use the connecting flight method, which will be like this. These are my cash flows: 100, 100, 100 and 1100. Now, this cash flow, everyone please look at this. This cash flow is coming to me in year 4. What is my job? Take it from year 4 to 3, 3 to 2, 2 to 1, 1 to 0. How will I take it from 4 to 3? So 4 to 3, I will use 27.47. Correct? This is the rate, 27.47. So 1 plus 27.47 percentage raised to 1. The moment I divide 1100 with this number, my cash flow is migrated from 4 to 3. Now my job is to take it from 3 to 2. 3 to 2, how would I do it? So 3 to 2, the rate is 21.24. So in the denominator, 21.24. Now all of these are raised to 1 because I'm just going 1 year at a time. Now I've reached year 2. Now I want to go from 2 to 1. How will I go from 2 to 1? 2 to 1, what is the rate? 14.04. So 1 plus 14.04 percentage. And now I've reached year 1. I can simply do 1 plus 10% raised to 1. Now this cash flow is already in year 3. So now my job is 3 to 2, 2 to 1, 1 to 0. So 1 plus 21.24 raised to 1. 1 plus 14.04 raised to 2. 1 plus 10%. Sorry, why did I do raised to 2? My mistake. This should be just raised to 1. We're just going 1 year at a time. And then again here. This cash flow is in year 2. So 2 to 1. 1 plus 14.04 raised to 1 into 1 plus 10% raised to 1. And finally 1 to 0 is simply 1 plus 10%. That is how you value the bond using the forward rates. What do you think? Make sense? Okay. Now, on the exam, if this question shows up where they give you forward rates and they ask you to do the valuation, notice how this is a little time consuming if you have to put in those 4 terms in the denominator. So I have a shortcut for you for this, right? The way that shortcut works is, it uses a basic mathematical principle of taking a certain number common in an equation. So I want you to look at the denominator of 1100, okay? And in this denominator, compared to the denominator of values on the left and find out which one is unique. So compare denominator of this denominator, let's call it denominator 3, let's call it denominator 4. Find out denominator 4, what is the unique one? This 27%, right? So you highlight this unique denominator. Then compare 2 with 3, denominator 2, denominator 3, find out which one is unique in the denominator 3, 21.24. Then compare 1 with 2, find out which one is unique, 14.04, and then obviously this one is unique. Okay. Once you've identified that, you can leverage a beautiful shortcut to solve this in the calculator, super fast. Do this with me. 1100 on your screen. We start from the opposite direction, right to left. So 1100 divided by 1.2747. 1100 divided by 1.2747 equal to, how much do you have? 860 something, right? Now don't do anything but think. Now my job is to divide this 1100 with remainder 3 denominators, right? 3 terms in the denominator. But anyways, the same denominator is repeated for the values on the left. So why do it individually? So what you do now is in the numerator you say plus 100. Okay, plus 100 means the 100 which was on the left. So now your numerator is made of 1100 which is already discounted with this unique value plus this new 100 that you've added, right? Now this total you divide with 1.2124. So now you have 794. What is this 794? This is actually 1100 divided by the first 2 terms and this 100 divided by this term. With me? Now add one more 100 to the numerator. Okay? Now your numerator is actually 200 and 1100. Divide that with 1.1404. So the moment you divide this total with 1.1404, the first term got divided with this. The second 100 got divided with 1.1, that 14%, and this one is obviously divided with this. Now you have how much? 784. Now please add 100 to it and now divide that with 1.1. So everything gets divided by 1.1 and it will get you the same valuation. This is an extremely fast, elegant way to value the bond using forward rate. You don't have to do that 4 times. Did you understand the logic? Easy? Good. Now, just a little thought process, okay? Instead of this, an alternate denominator for me, okay, again for thinking purposes, what am I doing here? This 1100 I took from 4 to 3 by dividing with this, 3 to 2, 2 to 1 and 1 to 0. Now, could I have used a little bit of direct flight instead of having 4 hops? Sure, I could. Maybe what I could have done is from 4 to 2 I could have taken a single flight. The rate was how much? 24.32. So instead of using these 2 terms, a substitute for this would have been 1 plus 24.32 percentage raised to 2, which is nothing but this thing multiplied with this thing, right? Raised to 1, raised to 1. So when I do raised to 2, that means I'm multiplying with twice, right? So instead of using 2 separate rates, this rate would have been some sort of an average of these 2. Are you with me? And then rest of the terms would have still been the same. Okay? Or, now, what am I doing here? I'm using, this is my cash flow in year 3. What if I don't want to use these 2 separate rates? Sorry, these 2. So what is this rate? This rate, the job is it's taking my cash flow from year 3 to year 2. Now, after that I want to take a direct flight. So 2 to 0. So any flight that is a direct flight to destination 0 is nothing but a spot rate. So I'll just use a 2-year spot rate. So these 2 I can replace with 1 plus 12% raised to 2. They'll be the same. Am I speaking Chinese? Are you with me? Maza aa raha hai isme na? So once you kind of get the hang of, you know, how this is working visually, then you can manipulate the numbers the way you like. Okay, I hope you've understood. So I'm going to move to next question now. Find 4th year spot rate using various forward rates. Okay, let's put all the forward rates in a graphical format. This is 0 to 1, 1 to 2, 3 to 4, sorry, I forgot 2 to 3, and 3 to 4. Quickly help me with these rates. 10%, which is the next one. 14.03, okay. 21.24 and 27.47. Now, also, is there a rate available for us which is 0 to 1 and 1 to 3? This is 10%. Is there a direct flight available between destination 1 to destination 4? Yes. That would be 1 by 3y. How much was this rate? 20.7 percentage. Is this correct? 1 by 3y? Okay. 20.7. Also, is there a flight available for us from go to destination 0 to 2? Any flight starting with destination 0 is your spot rate. So 0 to 2 is what? 2 year spot rate. How much is that? 12%. And then a flight from destination 2 to destination 4. What should that be? A 2y, 2y. How much is that? 24.32. 24.32. Okay. और कौन सा रह गया? Am I missing any route? Yeah. We can also do one more route. I mean, we can be creative, by the way, create a lot of routes. But let's say I will take one direct flight from 0 to 3, and then one connecting flight from 3 to 4. 0 to 3, since starting at 0, it has to be spot rates. A flight starting from destination 0 is spot rate. Okay, my mistake. 15%. 15%. Okay, and 3 to 4 is which one? It's 1 year forward rate, 3 years from now, 27.47. This will also work. Is it okay? Now the beauty is, if I invest 100 rupees, okay, and I took any of the 4 rates, 1, 2, 3, 4, the end value that I'm going to get is same. It has to be same. Alright? So let's see if that works. Do this with me. Start with 100 rupees. Let's take route number 1. 100 plus 10% plus 14.03 plus 21.24 plus 27.47. I hope you're pressing the percentage button. So 100 plus 10% plus 14.03% plus 21.24% plus 27.47%. How much is that? 193.84. So my 100 rupees using those forward rates is becoming 193.84. Okay? With me on this, everyone? Now let's take route number 2, 100 rupees plus 10% plus 27.7%, do it 3 times. Plus 20.7%, plus 20.7%, plus 20.7%. 193.84. So it has to be same if the decimals are right. Let's take this route. 100 plus 12% plus 12% plus 24.32% plus 24.32%. How much? 193. Okay, should be same. And finally, let's take the last route, 100 plus 15 plus 15 plus 15 percentage plus 27.47. $193.84. Okay. Now, if I ask you, and if I were to say, you know what, why make it so complicated? Why not just give me one direct flight? Okay. I don't want 4 different rates. Just give me one rate where my 100 rupees will become 193.84. What rate will that be? So use a TVM row. Second, clear TVM. I want 100 rupees to become 193. So 100 negative present value, 193.84 future value, 4 as n, compute IY. 17.9, which is nothing but a 4-year spot rate of 18%. That's a 4-year spot rate, direct flight, right? So what do we learn from this? We learn from this that spot rates are nothing but a geometric mean of various forward rates. This CAGR that you compute in TVM row is nothing but a geometric mean. What if you had to use a formula? then the formula would have been, how do I take geometric mean of these 4 rates? It would be 1 plus 10% into 1 plus 14.03 into 1 plus 21.24 into 1 plus 27.47, all of them raised to 1. Since I have 4 values, 4th root minus 1. Okay, try. 1 plus 10%, so 1.1 into 1.1403 into 1.2124 into 1.2747 equal to under root 2 times, because when you do under root 2 times you get root of 4 minus 1 equal to 17.95. Okay, so about 18%. Now, what if I were to take geometric mean of this equation, the second root? Okay, can I do it? Sure. It would be 1 plus 10% multiplied with 1 plus 20.7% raised to 3. Raised to 3 times, you know? And then same 4th root minus 1. Let's see if this works. So do this with me. 1.207 raised to 3 into 1.1 minus 1 equal to 18%. Geometric spot rate is a geometric mean of various forward rates. How about the third root? Okay, can I build an equation for it? Sure. Let's see what equation will be. 1 plus, you help me. 1 plus third root. कैसे बनाओ equation? 12% square. Very nice. Into 24.32 raised to 2. To 1 plus 24.32 percentage raised to 2. And then again we'll have to do minus 1. Okay, try. Solve it. Under root 4. Because of 4 years. How much are you getting? 1.12 x square into 1.2432 x square equal to under root minus 1. 18. If I have to make an equation for last one, 1.15 raised to 3 into 1.2747 under root 4 minus 1. Done. Spot rate is the geometric mean of forward rates. Okay. I hope you've understood that. All right. Now we need to go and find all par rates. So first, what is a par rate? A par rate is basically a coupon rate. A par rate is the coupon rate. Tell me, which will force the bond to trade at par value. Par value, typically you're talking about 1,000 rupees or $1,000. Typically $1,000. Now, what is the formula? For 1 year, the formula is first year par rate is same as spot rate, which will be how much? 10%. Second year par, does anyone know? 1 minus Z2 divided by Z1 and Z2. Okay, the Z factors that we calculated earlier. A third year par, 1 minus Z3 divided by Z1 plus 2 plus 3. And a fourth year par, 1 minus Z4, Z1 plus 2 plus 3 plus 4. Can you please solve them using the discount factors earlier? And let's do it together. Eco with Gecko, there's an under root button on the calculator which you can use. This will work for root of 2, root function of 4, 8, 16, in that order. If you want to take third route, you'll have to do raised to 1 by 3 by opening the brackets. Can you tell me what's the second par rate? 11.88%. Can you tell me the third par rate?
14.48.
And the fourth par rate?
16.81.
There you go. These are your 4 par rates. Okay. What does it mean? It means if there were a bond which had a maturity of 3 years and it had a coupon rate of 14.48, this bond would have traded at the valuation of $1,000. It's a coupon rate that will force the bond to trade at the par value. अगर कोई 2 साल का bond होता, had there been a 2-year bond, and if that bond had a coupon of 11.88, then the bond again would have traded at $1,000 at given the current spot rates. Is that okay? And finally, where are we? We have to compare different curves together. This is a 7-star question for your exam. 7-star means, in my guess, my view, my opinion, I think you would have it on the exam, but it's my guess again. 3 different curves. Okay, there are plenty of questions in learning ecosystem on this. If this is my spot curve is also called zero curve. Why is that? Because a spot rate is YTM of, help me out, zero coupon bond. If this is my spot curve and it's upward sloping, then my forward curve will be above and my par curve will be below. Okay, so the relationship between the 3. Forward above, spot in the middle, par below. But if my spot curve is downward sloping, that means the rates are decreasing. Generally, when you have a structure like this, economy is bracing up for a recession coming in, right? Typically in a negative economic environment, your yield curve or spot curves flatten or start going inverted. If I have an inverted spot curve like this, then forward will be below and par actually will be above. Okay, so the way you think about forward curve is you think of any character that comes to your mind who overreacts. Okay, tell me 1 or 2 characters. Any character that you think always overreacts. I know one, that lady on Kapil Sharma show. Archana, right? Archana, Kapil Sharma. Kuch to, and this is good. So think of her as the forward curve. She's the overreaction curve. So wherever spot is heading, forward will amplify that direction. So if the spot is going down, forward will fall faster. If the spot is going up, forward will rise faster. So it is amplifying or overreacting to spot behavior. And think of par as someone who's extremely slow to react. Do you know anyone like that? No. Someone on the chat box says, "Meri mummy." Yeah, who? Give me someone who underreacts. Kon? Government. Okay, fine. Whatever you can think of, right? You put your character there, but there you go. That's your question number 5, and we're making good progress. We've done 10 questions so far. Do you want a break? No? I'm impressed. No break? Nice, okay. All right, then let's do question number 11 to 15. Whenever you get tired, let me know. After all this, we will know a lot about Indian culture. Okay. Good. Now, let's solve the subsequent rates. Let me rearrange my notes again. Okay. All right. Find modified duration. This becomes question number 11. V minus V plus divided by 2 into V0 into delta Y. This is your mod duration. For us, the muscle memory that we've tried to build the whole season, RCL1 minus RCL3 divided by 2 RCL2 delta Y, which you can choose whatever you want, right? Smaller the delta, better the answer. This is your duration formula, modified duration. Then we have to also find Macaulay's duration. Once I find modified duration, then Macaulay's duration is going to be equal to shortcut expression, modified duration into 1 plus YTM divided by the frequency M. If coupon frequency is once a year, just divide with 1. If it's a semi-annual coupon, divide with 2. That's your Macaulay's duration. Then 13. We'll have to find out, so 12 and 13 is combined. This is 12 and 13. 14 we'll have to find convexity. This will be V minus plus V plus 2V0 divided by V0 into delta Y square. Okay. So RCL1 plus RCL3 minus 2 into RCL2 divided by RCL2 into delta Y square. So that's how we're going to kind of conceptualize this. These are low-hanging fruits on the exam. You do not want to miss even a single question with this, right? And how to build muscle memory, just create 5, 10, 20 questions and keep on practicing using the same sequence. Okay, so let's do it together. Now obviously we'll have to get V minus, V plus, all of them. So here's how we're going to do it. The current YTM of the bond is how much? 17.17%. And the current valuation of the bond is how much? 807. Okay, let's do it together. Second, clear TVM, all of us. Now, I want my bond value answer to come positive. So, I'm going to enter payment and cash flows as negative. Second, clear TVM, 100 negative payment, 100 negative payment, 1000 negative future value, 4 as N, 17.17 as IY, compute present value. 803.96. Okay. Now this number, which is your V0, which is the current value of the bond, we park this in second memory slot, STO2. Okay. Now I have to make a decision. What decision? I have to assume some delta Y. I'm going to assume some delta Y. Delta Y means the change in the interest rate. Now, what can I assume? Can I assume 1%? Sure. 0.5%? will work, 10 basis point will work. You can choose whatever delta y you want to assume. The shorter the assumption, the more precise the answer. Okay. So for this question, I'm going to assume a delta y of 10 bps, which means once I'm going to reduce this and make it 17.07, once I'm going to increase by 10 bps, make it 17.27. Okay, so let's do it together. Please make 17.07 is IY, 17.07 is IY, and compute the value of the bond. 806.3 something. Put this in first memory slot so we don't lose decimals. Then 17.27 is IY, find out valuation of the bond. 801.62, put this in the third memory slot. Okay. So now we have three memory slots, one which produces a higher bond value. This in your formula is called V minus. One that produces a lower bond value, this in the formula is called V plus. Now, why is V minus a higher value? Because the rate is lower. So that minus is for showing lower YTM. Okay. And obviously this is your base value, which is V. So now let's do it. Let's solve for duration on your Texas calculator. RCL1 minus RCL3 divided by 2 divided by RCL2 divided by 0.1 percentage equal to 2.92. That's your modified duration. Let's do it one more time just for practice. And this is how I want you to keep on practicing at least 5, 10, 15 questions. And when you do it, say what I'm saying now, which is RCL1 minus RCL3. So it will help you memorize that better. RCL1 minus RCL3 divided by 2 divided by RCL2 divided by 0.1 percentage equal to. Tell me how much is that coming to? 2.92. That's your modified duration. Now how do you capture your Macaulay's duration? So you take 2.92, multiply with 1 plus 17.17 percentage. Now this 17.17 should I divide with something? With 1. Why? Because this bond has a annual coupon. Had this been a semi-annual coupon bond, I would have divided with 2. Quarterly bond, I would have divided with 4. This thing is my 5-star on the exams, this formula. Okay, I feel there's a good chance you might do something around this, so make sure you know this formula really, really well. So help me out with the number. 2.92 into 1.1717. 3.42. All right. I hope all of you are together with me. Let's do convexity. Let's solve it together. RCL1 plus RCL3 minus bracket open 2 into RCL2 bracket close equal to, that's your numerator. RCL1 plus RCL3 minus bracket open 2 into RCL2 bracket close equal to, that's your numerator, divided by RCL2 divided by 0.1 percentage x square. 11.80. That's your convexity. We'll do it one more time. RCL1 plus RCL3 equal to minus bracket open 2 into RCL2 bracket close equal to. That's your numerator. Can you tell me how much is that? 0.0094. Okay. Divided by RCL2 divided by 0.1 percentage x square equal to. That's your convexity. And What was the fifth question in this series? What is your dollar duration and PVBP? So a dollar duration in CFA curriculum now these days they call it as money duration, okay, which is equal to, very simple, the current price of the bond multiplied with modified duration. That's it. Current price of the bond multiplied with modified duration. Current price is 17 RCL2, right? 803.96. Modified duration is 2.92. Please find out how much is this. 2347.56. Okay, now what to do with this? What to do with this 2347.56? Okay. Now I want all of you to look at the screen carefully. On the exam, if they give you this number, okay, which is called dollar duration, what to do with this? Different scenarios. I'll create 3-4 different scenarios. Okay. Let's say if they tell you that find out the change in the bond price if delta y is 1 basis point. Delta y means change in the interest rate. By how much? 1 basis point. 1 basis point means 17.17 became 17.18 or 17.17 became 17.16. So 16 or 18, that's called 1 basis point, which is 0.01 percentage. Okay? Or find out change in the bond price if delta is 30 BPS. Or change in the bond price if delta is 70 bips. Or change in the bond price if delta is 120 bips. Okay? Or change in the bond price if delta is 4%. I'm just making up random scenarios. How will you do it? Very simple. You will take the dollar duration, 2347.56, and multiply with 1 basis point, 0.01%. Finish. Okay. What will you do here? 2347.56 multiplied with 0.3%. 2347.56 multiplied with 0.7%. 2347.56 multiplied with 1.2%. And finally here, 2347.56 multiplied with 4%. Help me out with each of these numbers, please. Point. Okay, so 0.2347. So let's make it, okay, let's keep it 0.23. Tell me here. 7.04. No. Yeah, 30. That's right. 7.04. Tell me next one. 16.43. Next one. 17. Last one. 23.9 something. Okay. Now, what are these numbers? What is the meaning of these numbers? This is my dollar duration or money duration 2347. Once I have money duration, and if someone tells me what is their expectation of change in the YTM, I can actually counter by saying, okay, that means my bond price will change by 23 cents. Okay. Or my bond price will change by $7 if delta y is 30 bips. Or if interest rate changes by 70 bips, my bond price will change by $16. If interest rate changes by 120 bips, my bond price will change by $28. Are you getting hang of it? Now, the idea is, काय झालं मग? Something is wrong? How much is that? 93 point? Okay. Now, please focus. The core fundamental relationship is 1 basis point change. For every 1 basis point change, 0.01%, bond price is actually changing by $0.23. Okay. Now, I can just extrapolate this relationship here. For 1 basis point, $0.23, how much for 30 basis point? So try it. $0.23 into 30. I mean, it should ideally be same here, because if you look at this equation, this is nothing but 1 basis point into 30. So ये भी number गलत दिया है आपने, करो. 2347.56 into 0.3 percentage equal to 7.04. Okay. Then we are losing out on some decimals after this. So what you do is 0.2347. I'll have to take all the decimals to reach some precision. So 0.2347 into 30. Now we'll get 7.04. Are you getting hang of it? So this is like a bare bone equation. It's like you in your head, if you're a bond trader, right? And let's say you're doing some scalping type of trades. मतलब 4 आने 8 आने कमाने के लिए बैठे हो. Smaller trades. In your head, the equation is 1 tick, which is 1 basis point change in the interest rate. If it goes in my favor, I make 23 cents. If it goes against me, I lose 23 cents. Now today, interest rate changed by 30 bips, great. If it went in my favor, I made about $7 per bond. If interest rate changed by 70 bips, same equation, I can multiply 0.2347 into 70 bips and it will give me approximately $16.43. Okay. So this number here, which gives you change in the bond price per basis point, this is called PVBP. PVBP stands for price value of a basis point. So how do you calculate price value of a basis point? You find out the bond price, multiply that with modified duration, gives you money duration into 0.01 percentage, PVBP is ready. Did you have fun with this? मजा आया? Online, can you give me I pass, I struggle with this concept, please? Okay. Now you should take a break. And some of these concepts get a little complex, so I want you to have a small break. We'll do 20 minutes, and then my guess is we'll take another hour or so to finish rest of the questions after the break. All right. Some of the comments on the chat box are about playing something together. I'm guessing it's a video game. Vishal, I need a little extra volume here for the classroom. A small it's crazy how silver has been, right, for the last few days. Should you be buying, do you think it's a good idea to buy silver now? No? Let me show you a chart. I want you to see a chart. I'm just slightly going off topic to kind of break monotony here. This is a company called South Sea Bubble. The victim of this bubble, one of the notable character, a victim of this bubble, the famous victim is Isaac Newton. Now why? Because he was considered one of the smartest humans to have ever lived, right? So he buys a stock here and goes up and he sells the stock. But his friends do not sell, right? So when the prices are going up here, what Newton experiences is called FOMO. Now, if you act on a FOMO, you are actually committing a type 1 error at the cost of, because of your unwillingness to commit a type 2 error, and I'll explain that in a bit. I did discuss with some of you in the morning today, right? How to think about type 1 and type 2, and I'll quickly come back to chart and quickly then go back to fixed income, which is the agenda today, but you should think, right? Now, this is not my original example. This I have learned from the Pulak Prasad book. What is this? Pulak Prasad is the fund manager of Nalanda Capital. It's a very interesting investment framework. What is this? It's a pond. And okay, now I'm going to make a big fool of myself here, but this is a reindeer, a deer. To me, it looked like a cockroach to me at first. Char pair chahiye na. This is a deer, right? Now he wants to go and drink water, but there's a risk. Maybe somewhere behind these trees, okay, there is a tiger kaise draw karo over here. Let's say isko char pair aise nikale. This is a tiger. So let's say there's a tiger waiting there. Now, the deer needs to take a decision. Okay, now there are two decisions. You're taking a picture, you're going to make fun of me now. See, हमारा teacher ऐसे drawing करता है. The deer needs to take a decision, right? Now, what is the decision? Decision one, let's go and drink water, you can't resist. Okay? Now, if you go and drink water and then the predator attacks you, okay? That means things went wrong. This we call as type 1 error. Now, you decide that, you know what, let me not drink water. Let me not drink water. But actually there was no predator, you were scared for no reason. You missed out on the water. But there was no predator there. This is a type 2 error. Okay. Now if you think about it conceptually, and of course his book is called What I Learned About Investing from Darwinism. So he connects evolutionary biology with finance or investing. If you think about it, if deers have survived for so many years, eventually deers figured out not to commit too many type 1 errors, right? Which means, of course, if you're committing a type 2 error, you might not have water and you might die out of exhaustion, but it gives you another day to live and fight, right? So if you miss out on something that's doing well and you don't make money out of it, that's your type 2 error. But you get into something where you feel there is no margin of safety, there's a little bit of risk, right? But that risk might be significant, then you're committing a type 1 error. So whenever someone is experiencing FOMO and they invest, think about it. What are you thinking? You're thinking, okay, silver is going to go up. If it's going to go up, all my friends will make money, other people will make money, but I will not make money. Let me go and invest. So you're saying, I don't want to commit the type 2 error. But when you want to avoid type 2 error, you're accepting the risk of type 1 error, which Newton accepted, where the stock price kept on going up and he let the FOMO get better of him, and then he bought at the peak, and then when it fell, he went bankrupt. Right? So this is your decision-making framework. With everything in life, maybe silver will go up quite significantly from here. We don't know, right? That's a possibility, and that's a reasonable possibility. But then the way I would think about it is that the risk of me losing sizable money is higher since it's already gone up quite significantly, which means I should probably avoid type 1 error at the cost of making a type 2 error, which means I did not invest and then silver went up, but that's fine. I can always make money somewhere else, right, when I find the right opportunities. So that's my 2 cents on how I would like to think about this. And obviously, if you saw what happened with Newton, enters here significantly and then exits somewhere here, broke, right, made significant amount of losses. Plus, a lot of these graphs, they look very confusing. The return from here to here is actually lower than return from here to here. Okay, why is that? Because of the base effect. So let's assume silver was, I don't know, 40, 50,000, I don't know how much was it, 50,000 earlier, right? From 50,000 it went to 3 lakhs, okay? And from 3 lakh, let's assume it's supposed to go to 6 lakhs. Hypothetically, it's going to double from here. Now when you'll see it on a graph, it will look at this beautiful one-way rally. But the question you ask yourself, have you participated in this one-way rally? If you decide to enter here, for you, it's just 100% upside from here. It's not going to be so steep for you because you're entering late into the cycle. But if it were to fall, then you will experience the full downside. Correct? So generally, if you get too late in the cycle of some investment, probably the smarter thing is to just avoid type 1 error. Because that's how I would look at this. What I am doing with my silver is, and I could be wrong, but I'm thinking I don't know what the peak is, right? So every week I'm selling a little bit. Okay, now there's a chance that I would commit a type 2 error, which is I would probably end up exhausting all my silver when I'm here, because I'm selling a little bit every week. So maybe I will not get to capture a little bit of that upside, and that's okay, because at least what basically ensures is if it's going to be a bubble like this, then you don't at least participate on the downside. Okay. Fixed income again. Everyone comfortable with 11 to 15? Let's do 16 to 20 questions now. So do you have physical silver or ETF? नहीं भाई मेरे पास कुछ physical नहीं है. So please don't come to my house looking no physical silver. All right, here we go. 16 to 20. If holding period is 3 years, then what? So, I will capture 16, 17 probably in one question itself. Okay? A quick reminder of some concept that we studied in the class. You'll get to see my fantastic drawing skills one more time, unfortunately. That we have this long terrain that we need to cross. And the first part of the terrain happens to be a mountain. And after you cross the mountain, you have a nice, beautiful, McDonald's store. And after that, there is a large river that one needs to cross. Okay? I kind of enjoy drawing this. I remember in my school, we had an optional painting or drawing session. So everyone was allowed to participate. So I went there for 2 days, and then the teacher said, "Mata." So this is your mountain, this is your MACD, and this is your river. And then we have a character. Okay. Name of that character is nice. Name of our character. Name of our character is Ishwar. Ishwar. Okay. Now you can think of any name that works for you that starts with I. Yeah. Okay. Indra the tiger. Sure. So whatever name you want to think, okay? And this, think of any mountain range from P, I don't know, P is, yeah, so Hindi mountain literally translates to Pahad, which is a P, or you can think of any, mountain that starts with P. This is McDonald's, and this is obviously your river. Okay, river is R. Now, Ishwar is nothing but interest rate. This P region is nothing but, anyone? P is for price risk, okay? McDonald's is your Macaulay's duration, and R is your reinvestment risk. Now, what Ishwar needs to do is he needs to somehow figure out a way to cross through the tunnel. Okay, nahi, aise hi jayega. So, because this is one of the rare times when people laugh at this, and I'm not joking. So, when Ishwar wants to cross here, the skill Ishwar needs to be shorter, right? Ishwar needs to shrink in size. That means The benefit in this region is if interest rates are lower. When you're in MACD, you're sitting and sipping whatever you want to sip. So here, it does not matter. You're not sensitive to interest rate. Whether you're tall or short does not matter. But suddenly, when you're near river and you want to cross the river, then interest rates or issuer needs to go taller. That means interest rates will go up and then it will benefit you. This is the whole structure of your immunization process. Okay. So what is immunization process? In this example, we have a 4-year bond. So that's the total maturity. However, what is the Macaulay's duration of the bond? Can anyone look up Macaulay's duration? 3.42. So my Macaulay's duration is 3.42. The region on the left of Macaulay's duration is the region of price risk. Okay? The region here on the right is the region of reinvestment risk. That means price risk is dominating and reinvestment risk is dominating. If I am going to hold a period for year 3.42 exactly, if I buy this bond and if I keep it with me for 3.42 years, then the two risks will offset each other. Okay, so price risk and reinvestment risk will be cancelled out and I will be able to earn the original YTM at which I purchased the bond, which in this example is about 17%. Okay, but if my holding period is lower, then I have both the risk, but the dominant risk now is price risk. Then what will happen is, if issuer goes down, then the earnings that I will have will be more than that 17 point, kya number tha, can you? 17. So I will be able to earn more if interest rates goes down, that means if issuer shrinks in size. But if I hold for a bond with a maturity of 4 years, but if I hold it for let's say only 3 years, okay, and unfortunately interest rates go up, then I will actually earn less than 17.17. So when is the benefit coming? When the interest rates are shrinking, so that we can pass through the pahad. That means we can pass through the price risk domain. In price risk area, you want interest rates to go down, then you make more money than the original YTM. If interest rates go up, you make less money because price risk is more dominant than reinvestment risk. When I reach and when I hold the bond exactly for 3.42, price risk, reinvestment risk is going to offset each other. When I get into the river area, okay, now this is where if I'm going to hold the bond, let's say for all the 4 years, or if I'm going to hold the bond for 3.8 years, which is more than 3.42, then here I have two scenarios, interest rates going up, interest rates going down. Okay, interest rate going down, interest rate going up. Now visualize that image. Do you want interest rate going up or down? Up now. So this is where I will earn more than 17.17 if the interest rates go up. But if the interest rates go down, I will earn less than 17.17. Okay. And finally, another elegant hint for you. This P can also help you memorize that if I am holding the bond in Pahad region, I will have something called as a positive duration gap. And if I am holding the bond in this region, I will have a negative duration gap. And if I am holding the bond exactly here, then I will have zero duration gap. Okay, let me give you an example now. Think of the same bond that we have, okay, 4-year bond. Let's say there is an investor who buys the bond. An investor decides, okay, I'm going to sell it in 2 years. Okay. At the time of purchase of the bond, YTM was how much? 17.17. Investor is going to sell the bond in 2 years, and let's assume for some reason interest rate fell down to 16%. Okay. So you are in which region? Are you in the Pahad region or river region? Pahad region. And interest rates have fallen down. Is it beneficial or disadvantage? Beneficial. So that investor actually will earn a return which is more than 17.17%. Okay. But if you're holding the bond for 2 years and for some reason interest rate went up to 20%, interest rates went up. Now because you're in the Pahad region and interest rates have gone up, it's a disadvantage. So how much you will earn? You will earn less than 17.17. Your earning will reduce. 17.17 is the benchmark. But if you hold the bond for 3.42 years, in one case interest rates fall, in other case interest rates go up, doesn't matter. The two risks are going to offset each other. You will earn closer to 17.17. This is called immunization. क्या बोलते हैं? Immunization, which means somehow I want to protect, immunize myself from changes in the interest rate. The smart thing to do, just hold the bond for 3.42 years equal to Macaulay's duration. And if I hold the bond, let's say some investor decides I will hold the bond till maturity for 4 years. And interest rate increase from 17 to 20%. Good news or bad news? Good news. I will earn more than 17.17. If interest rate decrease to 10%, bad news, I will earn less than 17.17%. That's it. Okay. So, question number 11. If holding period is 3 years, you are in the which region? Pahad region or river region? Pahad region, mountain region. Will you have a positive duration gap or negative? You will have a positive duration gap. Had the holding period been 2 years, then positive duration gap. How much? 2 years and 3 point क्या number है? 42. Difference between 2 and 3.42, 1.42. If the holding period is 3 years, then 3 and 3.42 difference is 0.42, but positive number. So positive 0.42. What if the holding period is 4 years, then duration gap is negative. How much? 4 minus or 3.42 minus 4, 0.58. Negative. Because I am in the negative territory. Okay. Now, how does price risk and reinvestment risk work? Now we know. If I am holding less than Macaulay's duration, price risk will dominate the reinvestment risk. If I am holding for more than 3.42, reinvestment risk will dominate price risk. All right. Question number 18. Delta Y, 18 and 19 will club together. Delta Y is how much? 30 bips and negative 120 bips. 30 bips and negative 120 bips. Okay, so this is minus 30 bips and this is positive 120 bips. What formula do we use? We will use minus duration into delta Y plus half into convexity delta Y square. Okay. So tell me how much is the duration? 2.92 into delta Y negative 0.3 percentage plus ये positive था and 120. Okay, sorry, then let me just change this. Plus half into what was the convexity? 11.80 into 0.3 percentage square. Now the way you're going to solve this is solve this from right to left. Store this number in second memory slot, this number in first memory slot, and add up the two. Okay, so let's do it together. 0.3 percentage x square. 0.3 percentage x square into 11.8 into 0.5 equal to STO2. Now notice, because we are squaring that number, Okay, whether delta y is positive or negative does not matter. The second term will always be positive. That is why we say convexity is the friend of bondholder. Okay, let's solve for the first term. 2.92, आपका कैलकुलेटर कहाँ पे? ब्लैक टी शर्ट. तो थोड़े उंगलियों को तकलीफ दो सर. 2.92 into 0.3 percentage equal to, make it negative. 2.92 into 0.3 percentage equal to, please make it negative. Now add up the two memory slots, RCL1 plus RCL2. Minus, उसको 100 से multiply कर दो. 8770 percentage. Is everyone okay with this? Which means if interest rate goes up by 30 bips, bond price will fall by 0.8706 percentage. Let's solve the second one. Minus 2.92 multiplied with negative 1.2 percentage plus half into 11.8 into negative 1.2 percentage square. Solve this, put this in the second memory slot, solve this, put this in the first memory slot, add up the two together please. Let's do it together. 1.2 percentage negative, 1.2 on your screen, then percentage negative x square into 11.8 into 0.5 equal to STO2. And then 2.92 into 1.2 percentage STO1. And then please add up the two, RCL1 plus RCL2. 5. What do you think? And then the last question here, which is question number 20. How to draw a price yield relationship. This is price, this is yield. If I am drawing a graph like this graph is showing the relationship based on which metric? Duration or convexity or both? Notice I have drawn a straight line. That means this is how a duration only behavior is. Duration is just the first derivative, it shows a linear change. A duration of 5 means 1% change, 5% change here. Right? Linear. 2% change here, 10% change here. Proportionate. But in real world, it's not proportionate. The true graph is like this. This is convex to the origin, price and yield. And this is showing you a duration plus convexity approach. This is your convexity, your convex to the origin. And what is the meaning of convexity? Compared to, if I were to have a straight line, okay, straight line would have been like this. So notice what's happening. When I'm increasing in bond price, compared to straight line, I'm increasing faster. And when I'm decreasing, compared to the red line, I'm decreasing slower, decreasing slower. That's the concept of convexity. When the bond price goes up faster. When it goes down slower. Therefore, convexity is the friend of the bond holder. Okay. So, this block is done. Now the next block, is this the final one? Khatam ho gaya. Let's do the last one now. Question number 21. What was it about? Which bonds have negative convexity? Callable bonds. Okay. This 3-star callable bonds have negative convexity. Okay. So what kind of question can you see on the exam? I can visualize 2 questions. If I were writing questions for you, I would have put something like this, that there is a portfolio and fund manager for some reason wants to reduce the convexity of the portfolio. Now they have a choice of buying one of the 3 new bonds. I will keep one of the 3 options as callable bond. And which option should I use? Which bond should I buy so that the overall convexity of the portfolio will go down? The answer is callable bond. Why? Because callable bond will give me what? Negative convexity. So portfolio convexity will reduce. Make sense? Okay. Second question. What happens to callable bond duration when the interest rates have fallen? What happens to callable bond duration in low interest rate environment? It reduces. What happens to callable bond duration in a high interest rate environment? Behaves same like a regular straight bond. What happens to puttable bond duration when the interest rates are low? Behaves like a regular bond. What happens to puttable bond duration when the interest rates are high? Reduces. Okay, so we technically have 4 scenarios. Okay, which scenario? Interest rates have become low. Interest rates have become high. Let's assume a straight bond. A straight bond, interest rate is low or interest rate is high. Your duration will behave like a straight bond. So we'll call it as a benchmark here. Okay. So for simplicity, let me just call it as, okay, let me not do anything here. Let's say callable bond. A callable bond compared to straight bond when the interest rates are low. Okay, let me just call it this as A and B for simplicity, okay. When the interest rates are low, your duration here will be lower than otherwise comparable A bond. Your interest rates, your duration will reduce. Okay, duration will reduce. This is duration. This is duration. Okay. So callable, I think I should just mark it here. Straight bond duration, callable bond duration. Here, it will be same as B or similar to B. It will not be different. If it's a puttable bond, here it will be same as A, and here it will be lower than B. Now, if you feel that this chart is a little difficult to memorize, I have a simple technique for you. Just remember these 2 graphs. This is your regular bond. Okay. How is callable bond different? So for a callable bond, I want you to remember this graph. A callable bond will behave a little bit like this. Okay, the blue part of the graph, this is callable. So what happens in a callable bond? This is my low interest rate regime. This is my normal interest rate, high interest rate. Now, because the upper price of the callable bond is capped, when the interest rates go low, it deviates from regular bond, right? So this is where the duration of the bond will become fairly low. Duration means the bond price will not change as much, and this is where convexity of the bond will become, convexity will become negative in this region. This is a callable bond. How will a puttable bond look like? This is a puttable bond. In a puttable bond, as the bond prices start falling, after a certain level, putable bond will behave like this. It will have a flattening effect. So when we have high interest rates, okay, in this case, the duration of the bond will become low. The bond price will not fluctuate much. When we have low interest rate, it will be like a normal bond, similar to a regular bond. And here my convexity will get closer to 0 because it's becoming a straight line. Straight line means no curvature. No curvature means convexity. It's not negative, but it will become low or 0. Is this okay? Good. Then question number 22. क्या है 22? क्या है 22 बताओ? Okay. We have to do 1.7 and 2.2. So 22, 23 will solve together. This is the bond. Time 0, time 1, 2, 3, 4. We have to value the bond here at year 1.7, assuming constant YTM. Now on the Texas calculator, you cannot directly value the bond at year 1.7. So how will we do it? On the TVM row, we will find out valuation a period earlier. So we'll figure out valuation of year 1. And that valuation, we will take it forward at 1 plus YTM for 0.7 years. Okay? In the same way, for the second question, 0, 1, 2, 3, 4. Now second question, we have to value the bond which year? 2 point? एकदम से एनर्जी कहाँ पे खत्म हो गया आपका? खाना खाने गए थे आप? 2.2. So now if you have to value the bond at year 2.2, that means we have to value the bond here at 2.2. We know we can't directly value at 2.2, so we'll value the bond at year 2 and then 1 plus YTM raised to 0.2. Okay, so let's do it together. Remember YTM is 17.17. Second clear TVM. 100 negative payment, 1000 negative future value, 17.17 IY, but I'm not sure what should be the N. N should be how much? I'm valuing the bond at year 1. 3N or 1N? 3N of course, right? Because I have to take present value of future cash flow. So 3 is N. After 1 year, we are left with 3 cash flows. So 3 is N. Compute present value. 842.0. Okay, so 842.0. Multiplied with 1 plus 17.17 percentage raised to 0.7. 9? 940.77. In the same way, how will I value the bond at year 2? If I want to value the bond at year 2, how will I do it? Second clear TVM, 1000 future value, 100 payment, 2 as N, 17.17 IY, compute present value, 886.58 multiplied with 1 plus raised to 0.2, 915.12. Now, this 940.77, what is this called? This is called full price of the bond. From this full price, we are supposed to deduct accrued interest, right? How do you calculate accrued interest? Accrued interest. So you take coupon for 1 year. Coupon for 1 year is 100 rupees. Take the coupon between the previous coupon date and today, which happens to be a time period of 0.7 years. So accrued interest becomes 70. You deduct this accrued interest from the full price of the bond to get your flat price. So 940.77 minus 70 should give you 8. This 870.77 is called what? It's called the flat price. Full price also called dirty price. Flat price called clean interest. So what is dirt? Accrued interest. So from the dirty price you remove the dirt to get the clean price. Which price is the one at which you do the transactions? Full price. Which price is quoted to you by the dealers? Let's do the same thing here. 915.12 full price. What is the accrued interest? The time period between 2 and 2.2 is 0.2 years. So that should be 20. Okay. And finally, if a corporate bond is trading at 450, find out G spread and Z spread. Last question. 24. G spread and Z spread. The corporate bond is trading at 450, I think I should have mentioned, with same coupon and same maturity. Otherwise, equivalent bond is what I meant. Equivalent in terms of cash flows and everything. So, now if the bond is trading at 450, which is market value, face value is how much? 1000. Coupon is 10%, maturity is 4 years. Can you find out YTM of this bond? 39.53. Whereas YTM of the government bond, which is what we are dealing with, is 17.17. What is the difference of the two YTM? 26. That's your spread. YTM of a corporate bond minus YTM of a government bond. Now, there are nuances of different spread definition, which I'll show you when I take you to the juice notes. Now, once you are, is this clear? What is the meaning of this spread? 22.37, what does it mean? It's how much extra you're earning because of the risk that you've taken. Okay. Now, How will you find out the Z spread? So this is your corporate bond. Now, corporate bonds market value is how much? 450. What was my spot rate for year 1? 10%. Can I discount spot rate of year 1, spot rate of the government bond with cash flows of the corporate bond? No. So my rate should be a little bit more. How much more? We don't know. So that Z needs to be added to the denominator to make this equation work. Okay, so Z is some sort of a rate, whatever the rate might be, that I add to in the denominator in such a way that present value of the cash flows becomes equal to the market price. Now, how can I solve Z? I cannot. Not even in the calculator. I cannot solve Z directly for the CFA exams with the calculator that you have. Okay, I cannot. Just there is no way to do it. So then, if this question shows on the exam, you would be given 3 options. Okay, let's say something like 10%, 18%, 15%. The way you want to solve this on the exam, look at the 3 options and go and look for the option in the middle, which is which one? 15. Now, assume that 15 is the correct answer and solve, insert 15 here, okay, and solve. And once you've done that, it will give you some bond value, which will be either higher than 450 or lower than 450. If the given bond value, let's say your calculated value came out to be 500, just for example, but your answer is how much? 450. That means denominator mein whatever rate you added, it's not sufficient. You need to add a little bit more. 18% becomes the answer. But if your calculated value came out to be 300, that means your denominator you've put in a rate that's too high, you need to reduce that rate, then 10% becomes the answer. If you get lucky and your calculated value comes out to be 450, then 15% is the answer. That's how you would do this on the exams. Is this okay? Understood? Easy? Nice. हो गया फिर. Any doubts? Can I answer for you? Let's revise all the formulas. Let's see if we can revise all of it. How do you value a bond using spot rate? Respective cash flow, respective spot rate. What is the relationship of YTM and spot rate? It's a weighted average of various spot rates. Weights, cash flows. Will the YTM be same if the spot rates are same, or will the YTM change for different bonds? It will change because the weights will be different. Then how do you calculate a Z3? 1 divided by 1 plus S3, spot rate of year 3 raised to 3. How do I value the bond with discount factor shortcut? Coupon into total of all the discount factors plus face value into last discount factor. Then what is the formula for calculating 3y, 1y? 1 plus 4-year rate raised to 4 divided by 1 plus 3-year rate raised to 3 minus 1. What should be the formula for calculating 2y 3y. 1 plus 5 raised to 5, 1 plus divided by 1 plus 2 raised to 2, third root, है ना? Minus 1, that's your answer. Fantastic. How can I find out spot rate using forward rates? Geometric mean. Then what is the formula for finding third year par rate? 1 minus Z3 divided by Z1, Z2 and Z3. Okay, now graphically, how does, let me put you guys on the screen. Yeah, graphically, how does a spot curve, forward curve and par curve stack up if spot curve is downward sloping? Par will be above and forward will be below. And if the spot curve is upward sloping, spot above that, forward below that, par. क्या बात है? Formula for modified duration. RCL 1 minus RCL 3 divided by 2 RCL 2 delta y percentage. RCL 1 minus RCL 3 divided by 2 divided by RCL 2 divided by delta y percentage. Formula for Macaulay's duration. Modified duration into 1 plus YTM by N or YTM by M, which is your coupon frequency. Formula for convexity. वो माइक उठा लो ना वहाँ से. किसी के हाथ में दे दो. इसके हाथ में दे दो. She remembers most of them. RCL, आप सब बोलो. Convexity RCL 1 minus RCL 3.
RCL 1 plus RCL 3.
वापस. RCL 1 plus RCL 3 minus
2
into RCL 2
divided
by
two
RCL 2
into
delta y percentage square. There is no 2 in the convexity denominator formula. There is RCL 2. That's a very common mistake people would do, right? Convexity denominator does not have 2, but duration denominator does have 2. So you want to memorize that. Okay. How do you calculate dollar duration? Mic use karo. हाँ, बोलो.
Market price into the
Market value of the bond into
modified
duration. How do you calculate PVBP? Sorry, how?
Modified duration into delta.
Duration. हे balloons कसं काय येतात माझ्या व्हिडिओ वरती? कहाँ से आ रहे हैं? I just saw my videos have balloons coming up from there. If I do this, okay. क्या चल रहा है? PVBP, modified duration into 0.01 percentage. That's your PVBP. Okay. Sorry, my mistake. Money duration into 0.01 percentage. Then if my holding period is less than Macaulay's duration, which risk is dominant? Price risk. When do I benefit?
When
interest rates
lower.
go down. If I am holding at Macaulay's duration,
Indifferent.
they will offset. If I am holding for more than Macaulay's duration, which risk is dominant?
Reinvestment risk.
Reinvestment. And what benefits me?
When interest rate is
Interest
high.
rates going up. Then the change in the bond price using duration and convexity combined, which is minus duration into delta y plus half into convexity into delta y square. क्या बात है? Nice. Price yield relationship graph, it has to be convex to the origin. Which bonds have negative convexity? Callable bonds. Then how do I find out bond valuation at year 1.7? I value the bond at year 1, take it forward for 0.7 with compounding. The given price is full price minus accrued interest will give me flat price. Full price is also called dirty
Dirty
price.
price.
Flat price is also called clean
Clean
price.
price.
Quoted price by the dealer is the
Flat price.
flat price, but the price at which I do transaction is the
Dirty
full
price.
price. And how do you calculate the G spread or I spread? You take the difference between YTM and YTM of a corporate bond, YTM of a government bond. How do you get Z spread?
Trial and error.
Trial and error. It's a spread that you add along your spot curve in such a way that present value of the cash flow becomes equal to market price of the bond. Nice. रात में नींद में याद आएगा. I'm going to download the juice notes from your chat box. Juice notes from the FinTree LMS. खड़ा करना है इसको बोलो. Now we have to deal with large volume of theory and some smaller calculations as well. There are some more smaller calculations. Should we start? Chalo. Look at the index. I am on the FinTree juice notes. This is the index. It's made of 19 learning modules. Lots and lots and lots of theory. Let's do it in sequence. We don't have to do the everything. I'll help you identify the important pieces. LM1, fixed income instruments. What is a bond? What's a face value, coupon rate, YTM? You guys know. Issuer means the organization issuing the bond. Could be government, could be a corporate, could be a quasi-government entity. Maturity means total maturity of like number of years the bond is going to pay you coupons. Remember, perpetual bonds will have no maturity. Face value, also called principal, par or face value. Remember, this is the money you get on redemption or maturity of the bond. Now, we might have a type of bond called FRN, floating rate note, where your coupon is typically some reference rate plus some credit spread. We have to do calculations on this, so I'll deal with that a little later. Then bonds could be senior or junior or subordinated. Senior means they get first priority of repayment. Subordinated means they get the last priority in repayment in case of bankruptcy. Then bonds could be callable options, puttable bonds. Again, we'll be studying some of them. In fact, we'll do it here. What is a callable bond? From an investor perspective, it's a bond minus a call option. A puttable bond is a bond plus a put option. And a convertible bond is a bond plus a call option on equity. You have a right to convert to equity shares of the company. Let's compare callable and puttable. I'll give you a question. Again, I might structure something similar on your exams. Let's say you have chosen to buy a puttable bond compared to a straight bond or callable bond. Will your yield be higher, lower, or in the middle? That's correct. A puttable bond will have the lowest yield. Why do you think it has the lowest yield?
Right.
Because it's the safest bond. You have a right to give it back to the company in case if the bond price falls, right? So safest bond, therefore lowest yield. Callable bond will have the highest yield. Why is that?
More risk.
Because we are taking the call risk. In case if the bond price goes up, the issuer will call back the bond. Correct? So conceptually, this is equal to bond minus call, this is equal to bond plus put, this is equal to bond plus call option on equity. High probability you would have something to do with this concept on the exam in some or the other version. So make sure you're super comfortable here. Okay, now there's a concept called current yield. Add that to your formula roster. Current yield is coupon divided by the current bond price. And there is another metric called simple yield. Simple yield is coupon divided by bond price, but in the numerator we do plus discount amortized minus premium amortized, either of the two. If it's a discount bond plus, if it's a premium bond minus. This is called simple yield, current yield, simple yield. I'll show you examples coming. Then assumptions with YTM. YTM assumes very importantly that all cash flows are reinvested at YTM itself, which creates a risk which is called reinvestment risk, your inability to reinvest your cash flows over a period of time. What is this on your screen? YTM on y-axis, maturity on x-axis. What is this called? This is called as a yield curve. Is this normal yield curve, upward sloping, downward sloping? Normal yield curve or upward sloping yield curve. Then yield curve of government bond, corporate bond will be different. The difference of the two is called credit spread. What is indenture? A legal agreement between issuer and the bondholder. What are covenants? The clauses in those agreements. Now, typically positive covenants and negative covenants. Positive means do something. Negative means don't do some things, right? Don't do a few things. Now, please make sure you're comfortable with identifying which is a positive covenant, which is a negative covenant. Plenty of questions around that. For example, you've already taken a loan. Please don't take one more loan. Negative covenant, right? You're not allowed. Do not sell your assets. Negative covenant. Maintain debt to EBITDA ratio at a particular level. Positive covenant. Pay insurance on your assets regularly. Positive covenant. So just make sure you're technically comfortable with identifying positive and negative covenants. We've given some examples in juice notes. Reading number 1 is over. Reading number 2. A bullet bond. A bullet bond is your break chahiye kya? Do you want a break? No, so then focus. The theory is going to slip very fast, right? You need to be absorbing. We have most of your FEB candidates, you are anyways alert. I don't need to tell you. है ना? क्योंकि आपको अलग जगह से inspiration आ रहा है. If you're a May, August or subsequent attempt candidate, just think that in the next 1 hour, if you're just listening as much as you can, you're going to absorb a large body of knowledge, which will helpful when you prepare, okay? Bullet bond means a regular, any cash flow which is a bullet cash flow means one large cash flow. So the regular bond that you have, coupon, face value, that face value is one large cash flow, that's called the bullet cash flow, okay? Or that's called as a bullet structure. Amortizing debt means your EMI structure. You take a loan, you pay installment, every installment is made of some principal and some interest. A partially amortizing structure means some part of loan you pay through EMI, some part of the loan you pay lump sum. It's like I take a loan for 100 rupees, 70 rupees I'll pay through EMI structure, 30 rupees interest accumulated I will pay lump sum towards the end. So it's a combination of amortizing plus bullet. Okay. Now we have an example here. It becomes a little mathematically tough, so I want you to think about it. Assuming you've taken a loan of 100, interest is 10%. If it's a bullet loan, what's the cash flow? It's for how many years? दिया है क्या कहीं पे? 5 years. Okay. So let's do it together. Second, clear TVM. If it's a bullet loan, you don't need TVM by the way. If it's a bullet loan, every year I'll pay 10. 10, 10, 10, 10. Fifth year I will pay 100. So this is your 100, 100, 100, 100, sorry, 10, 10, 10, 10, 10, and finally we pay 100. Simple bullet loan. If it's a partially amortizing loan, okay, what is partially amortizing? 50-50. Alright? So then what would be my installment? Let's do it together. Second, clear TVM. I'm making a mistake, you correct me. 50 is your present value. 50 is your present value. Is that correct? Yes, because only half of the loan we are amortizing. 5 is N, 10 is IY, compute payment. 13.19 every year. Okay? And then in the fifth year I'll pay, so by paying 13.19 every year, half of the loan is paid. Now in the fifth year I just pay remaining 50 and I'm done. No? Why? उस पे interest देना पड़ेगा ना? We have to pay interest on that 50, right? So, Vishal, I need more volume in the classroom. Second, clear TVM. 50 is present value. 50 is present value. 5 is N. 10 is IY. Compute future value.
80.5. 80.5.
80.52. Right, distance. 80.52 is correct. And if it were to be fully amortizing, then what will you do? Second, clear TVM. 100 present value. 5N. 10 IY. Compute payment. 26.79. These are your three possible structures: bullet, partially amortizing, and full. All right. What is a sinking fund? Keep some money aside to retire some of the bonds early. Sinking fund structure. What's the waterfall structure in our MBS? What's the waterfall structure anywhere? Think of a large step-by-step waterfall. Money goes from. Think of a large. You'll have to give me higher volume in the classroom. Okay, break मैंने कराता रहा हूँ छोड़ दे. Think of a large waterfall. Okay, I think online some people have lost audio. Is this okay now? How about now? Is this all right? Okay, good. So think of a waterfall which has multiple steps. So the water is flowing from step 1 to step 2 to step 3. Water is liquidity, which is money. And money is going in different tranches to other people. That's called waterfall structure. So this term you will see in fixed income in MBS. This term will repeat in private equity. European waterfall, American waterfall in alternative investments, right? Waterfall structure simply means I've created some sort of a staggered, layered payment structure. Whatever money is coming in, first I'm giving to some folks, then whatever is left I'm passing on to second category and third category. So when you create an MBS structure, you typical waterfall cash flow is a waterfall structure. We'll discuss that when we go to last reading. Variable interest rate are called FRN, floating rate notes, where coupon is equal to MRR plus certain spread. Okay, and this credit spread, which is a part of coupon, does it change? No, it does not. What changes is the MRR, and depending on MRR changing, your coupon will keep on changing. We have to do some calculation in third or fourth reading on this. What is a step-up bond? Every year, coupon will go up. Initially, I'll give you low coupons, then over a period of time, I'll give you higher coupons. What are credit-linked notes? The coupon that you pay is a function of how much is your spread, how risky you are. Lower the rating, you pay me more coupon. Higher the rating, you pay me less coupon. Those are called credit-linked loans. PIK bonds. I issue a bond. Every time I have to pay coupon, I issue another baby bond in lieu of cushion or coupon. So, which means I'm not paying coupon in cash, I'm paying coupon in kind. What is that kind? Issuance of a new bond. What's a green bond? An ESG compliant bond. That's something which is environment friendly. Then inflation linked bonds are called TIPS. Okay. And how do they generally operate in practice? They adjust the principal value based on inflation. So if the inflation goes up, face value goes up. Face value goes up automatically, coupon goes up. Right? So they give you fantastic protection against inflation. Zero coupon bond, you already know. Deferred coupon bond, you will not get any coupon for the first 2-3 years, but then you would get significantly larger coupon or a one-time coupon in the subsequent year. The flowchart repeats: callable, puttable and convertible. What is a warrant? Warrant is like a call option which gives you right to buy shares of a company. What are COCOs? COCOs are contingent convertible bonds. COCOs are used extensively in the banking world. And what is the job of COCO? That you borrow the money, but if the company is under stress, automatically those bonds get converted to equity. Now, optionally convertible bonds means as a bondholder, I have a choice. Compulsory convertible bond means as a bondholder, they will be converted. A contingent convertible bond means they may or may not be converted depending on some situation. If you are a bond investor and you are buying COCOs, you should hope that that contingency doesn't come. Because that contingency is only when the bank is not doing good. Only then your bond will be converted to equity. So a classic example here, and again giving you an example so that you remember this point. Saudi Arabia government, the sovereign fund of Saudi, bought large value of Credit Suisse COCO bonds. Credit Suisse is a Switzerland-based bank, and we know what happened a couple of years back. Credit Suisse was under stress, right? And it was going to go bankrupt, but thanks to the Switzerland government, Credit Suisse was bought over by UBS, which is SBI of Switzerland. जैसे हमारा SBI है, उनका UBS है. So, but prior to that period of stress, the Credit Suisse was not doing good, and because of that, those COCO provisions were triggered, and the Saudi sovereign funds bonds automatically got converted to equity shares. Those are called contingent convertible bonds. Then some of these things you have to remember. Domestic is your local bond, foreign bonds issued by foreign entity. So in India, if there were to be an Apple bond, then we would have called it as a foreign bond. Then sukuk, Islamic bonds, right? Now under Islamic or Sharia law, interest is not allowed. So they structure it a little differently. I don't understand much of it, but it's structured for being compliant with Sharia law. That's called sukuk. Then what is a frontier market? Developed markets, emerging markets, and frontier markets. So the markets which will become emerging in the future. So some of the African markets or smaller countries in Asia, those are called frontier markets. Eurobond, a bond trading outside the jurisdiction of a single country, typically bearer bonds. Okay, these are called Eurobond markets, generally denominated in US dollar but sold in the US market, in the European market. उनको कहते हैं Eurobond markets. Then global bonds issued in Eurobond as well as in some other domestic bond market. We call them as global bonds. Plenty of theory questions on identifying whether it's a Eurobond or it's a global bond or domestic bond or foreign bond. Some of you might be clear, those of you are not clear, it deserves a little bit of your time. 5 to 10 minutes, you should be okay. Taxation, typically bonds or interest is taxed at your ordinary tax slabs. Generally, you don't get capital gains benefit, very rarely you do. Now, there's a provisioning called OID. How does OID work? This you need to know. Imagine I buy a zero coupon bond, okay, and I buy it for 70 rupees, and in 3 years I'm going to get 100 rupees. Now this is year 0, year 1, year 2, year 3. Now you tell me that 30 rupees, is that my capital gain or is that my interest income? Why is that difference necessary? Because capital gains generally taxed at lower rate, whereas these are taxed at ordinary rates. So is that 30 rupees capital gain or interest income? Is that 30 rupees capital gain or interest income? Interest income. Because at the end of the day, it's a bond. You are earning interest, it's just that you're not getting that interest in cash. So under the OID provision, the government will say, listen, you're earning that 30 rupees, but don't fool me, it's not capital gains. It's just a bond, right? And that money that has grown is your interest accumulated and accrued. So what you do is, total interest is 30 rupees. Every year, you please pay me income tax on 10 rupees. You would say, why should I pay? I'm not even receiving any cash. Right? Think about it. As an investor, in year 1, did you receive any cash? No. So why should I pay? Government said, that's your problem. Right? I don't care. I need taxes. So you want to sell the bond, you sell the bond. You don't want to sell, beg, borrow, steal, do whatever you need to do. Tax lake do. This provisioning is the OID provisioning. Now we'll stop for a break. Are you liking the speed now? So with this, I'll try to take you through. I'll only stop at areas which I find technical. The easier areas I'll kind of breeze through, but give you an overview of all of it. We'll do a 30-minute break now, slightly longer break. So go do whatever you want, come back in 30 minutes time. Is the audio good now? Yeah, seems good. तुझ्या प्लीज स्पीकर आहेत ना ते चेंज करायला कारण नाही तिथं त्या पॉईंटला स्पीकरच बदलतील ना आपल्याला थोडं जास्त हां डबा चांगल्या वरतीचं स्पीकर कारण मला इथं आवाज अदरवाईज आय नीड स्पीकर हिअर सो आय डोंट गेट अ फीडबॅक I don't know how to answer that question. Someone is asking, are you for real? Someone else is answering me, AI चल रहा है. अच्छा. Where is this class situated? Express short मार के आया. अच्छा. Yeah, someone is asking, in the corporate issuers class, I said CFA Institute removed an interesting subject. What I meant there is, earlier this subject was called corporate finance. Now they changed the name of the subject, made it corporate issuers, and the syllabus and the nature of the syllabus changed over a period of time. Earlier, you had areas with specific focus on capital budgeting, cost of capital, leverages, working capital management. A very structured, organized way of studying corporate finance. Now you have a lot of nonsense like ESG and this different business structures, proprietorship, partnership, which doesn't add significant value at level 1. That's what I meant. Have you been to Delhi? Yes, I have been to Delhi. Do we get a hall ticket for the exams? No, you don't get a hall ticket. You get one doc. क्या कहते हैं उसको? Prometric का कुछ आता ना? Confirmation, prometric confirmation. Are you supposed to take it with you? Yeah, take a printout maybe. You don't need that though. Just show up on time, carry your calculator, your passport, and that prometric screenshot. That's it. Sir, Ahmedabad आओ कभी. Okay. So it didn't sound very good the way you wrote it. It's Ahmedabad आओ कभी. क्या है वो आओ कभी हवेली पे है ना. Do you teach in regular classes? Yes, I do. We run a CFA level 1, 2, 3 classroom and online program. Rohan, classroom program is Pune, but a live Zoom webinar is available. अरे सर वैसे नहीं. After CFA level 2 and having 2 years of experience, can I move to Canada or Australia? Okay, I don't know how to answer some of these questions. Give away your portfolio if you all pass. Wow. खुद ही चैलेंज बना रहा है, खुद ही गिफ्ट दे. मैं तो cordially okay. Thank you very much, Aniruddha. Appreciate it. Let us handle your portfolio for one day. No, उसको मेरे को रहने दो. हाथ जोड़ दो आपके दूर. Yeah, but someone, how many of you want to go outside India for your future career? Give me a hand raise. And I want to show, ek minute, please. Give me a hand raise. How many of you want to go outside India? Right, okay. How many of you want to have, like, you want to be in India? And how many of you are in the middle? Chalega jo bhi aa gaya ho. Okay. Yeah, I mean, this debate I've had multiple times, uh, including with friends, family. I mean, see, every country has its own issues. India has its own issues, but I like India more because it's a country where you can build things, build businesses, build products, build something. Um, because we have such a large population, you build something that's valuable to population, to some small segment, right? There's an opportunity for you to build high quality businesses in this country. But having said that, then we have downside. I think for me, right now the biggest downside about which you can't do anything is air quality, right? I mean, unfortunately, it is what it is, and it is very, very high. And when I speak to folks who who understand this domain a little bit well, they tell me even in normal times our AQI is not good. Forget winters. Winters is bad, but even otherwise our AQI is not good. So that's that. पैसा अच्छा मिलना चाहिए, इंडिया हो या यूएस. And every country has their own issues, by the way. US, as an Indian in US now, especially after the new Trump administration, things are not that great. Apparently, have you seen all the ICE issue? You have to carry your immigration documents with you. That lady was shot, right? Couple of women were shot. Do you know that? No. And plus, I mean that thing of not waiting for years and years in a green card. 140 years. And then waiting for some lottery to come your way. I think that's, again, something that I wouldn't have liked if I were living in the US and if I knew that at any point of time I can be kicked out, then you can't really plan your, things around, right? That's an uncertain variable that always exists. What's the new rule? Why don't you use a mic? No, use a mic. Let us know what's the rule. I'd be very keen to know what's the rule in US now.
So even if you get a green card, everything that you, like all of the house, cars, everything that you buy and all of the equity investments that you have made in that country, once you want to leave, you have to pay a 30% gain on that also.
Oh, yeah.
Yeah. So if you even want to leave the country on your own terms, you have to pay 30% of that back.
Withholding tax, huh?
Yeah.
Yeah, I mean, but I think now what I see happening in the 4-5 years, I'll tell you, a few years ago there was a lot of Indian students going to Canada, and then all those Canadian scams came out, right? Do you know, like people were literally running fake universities where the university looked different in pictures and how it was really, and a lot of Indian students were going there, especially the northern part of the country, जिनको कन्नेडा है ना, कन्नेडा ही बोलते हैं ना, कन्नेडा. They wanted to go. Prior to that, there was a lot of Indian students going to Australia and New Zealand. Then Australia and New Zealand kind of tightened up the residency requirement or job requirements there. I think over a period of time, things should improve. Europe has been completely closed for a long period of time. Indian students have been struggling in Europe. But my guess is 2-3 years down the line, maybe things will get a little bit better. Because Europe needs this talent. Europe needs better labor migration rules. So maybe Europe might be a good opportunity to explore. But right now, in the current environment, so much of uncertainty, and the only legitimate route for you to go as a student is to basically sign up for some course. And courses are expensive, right? So you commit 50 lakh rupees to a crore of your capital, which in most cases your parents would be paying, right? Or you'd be taking some loan. And if there is uncertainty, the risk-reward ratio does not work in your favor, correct? Because the whole idea of you going to an international destination to study primarily would be so that you get a job there. You're not going there for learning. You're going there because you want a job, right? And some people want to go there because they feel it's a good, nice paid vacation and 2 years of fun on parents' money. Sir, marketing team has been formed for you, waiting to contract. What do I think about MBA after CFA? I get this very often. Ironically, in the very early days of my teaching career, I did teach in multiple B schools. I was a professor at one business school, and then as a visiting in a lot of other B schools, including some top tier ones. I always felt the quality of students in the CFA class was substantially better than the quality of students I found in a business school. The level of depth, the level of curriculum you learn from a finance curriculum perspective. But where MBAs did really well is they were great at making presentations. Okay, and that's an important skill to be in practice. They were good at networking. So a lot of other peripheral skills are taught in a B school, which CFA does not teach you directly, right? In terms of how to give nice presentations or how to close a deal or those kind of things. Plus network helps quite a bit. So if you can, depending on what your career target is, that's my view. If your career target is, let's say, equity research, then you don't really need an MBA with that. That I feel is an waste of time, maybe an overkill. CFA is gold standard in investment as an area. But if your career goal is, let's say, front office IB, then the problem is the recruiters will not be happy recruiting only CFS because historically their catchment area has been IIMs and some of the top tier B school. So investment banking jana hai, then maybe MBA makes sense. If you want to get into private equity, which mind you is a total number of people working in private equity core profile in India is about 1,000 people. So you want to be one out of those 1,000, right? Working in a core profile. Then an MBA from top tier IIM ABC will help. But any tier 2, tier 3 MBA, in my opinion, is in fact destroys your profile. So if you are a CFA level 3 candidate, for example, and let's say in your CV also says MBA from some XYZ institute, in my perception, your profile is deteriorating because of that MBA that you're mentioning. So if you're going to do an MBA, go to top tier or don't do it at all, not required. That's my view. And anyways, I think where the world is moving in a few years, education is going to become less and less important, but skills is going to become more and more important, right? So you knowing how equity valuation works is not good enough. You actually being able to do a high quality valuation, considering all the technical nuances of ifs and buts in that situation, that is a skill that would be more valued. Okay. All right, fixed income. Ready? We've done so good so far. I think we should keep up the momentum. That way we'll be able to finish in time. Slightly more technical. There are some theoretical nuances in this reading. We want to spend some time on this. Generally, you need to know what's a bill, what's a note, what's a bond, which is nothing but your maturity. Do you know what a high yield is? What is a high yield bond? A low quality bond. Now, this high yield word, in my opinion, is actually a scam to somehow attract naive investors. There's a story to it. If memory serves me well, this was in late 80s, what happened that time is some of these large US institutions were sitting on large quantity of junk bonds on which they had made losses. Junk bond means companies which do not have good credit rating and they might default. Now, what they wanted to do is, okay, please confirm if audio is, okay, audio is gone. Vishal, something went wrong. No, it's good. Online, can you confirm if the audio is all right? Okay, good. What these guys wanted to do is they wanted to peddle these bonds to the retail investor. So these your television anchors and newspapers, they came up with an idea. They said, let's not call these junk bonds because then why would people buy? Let's call these high yield bonds. Now obviously, junk bond means fallen quite a bit. So if you assume that the bond will pay you everything on time, it will give you high yield, right? So they started calling these bonds as high yield bonds and started peddling these bonds to the retail investor with a concept that, okay, you buy one bond, there's a lot of risk, but if you buy 20 bonds, at least some of them will get you the returns, and that's how the whole term high yield bond investing came into being. Otherwise, prior to that, these bonds were always referred to as the junk bonds. Okay, but these are high yield, some of the riskier bonds, corporate or leverage loan and so on. Then credit rating agencies, the job of these folks is to give rating to companies. The general rating category is AAA, AA, A, then BBB, then BB, B, C, D. Okay. Now, within each, for example, AA, within it will have three categories: AA plus, AA, and AA minus. Within AA plus, we will have three outlooks. We will have a positive outlook, we'll have a stable outlook, or we will have a negative outlook. So it creates a lot of those subcategories. Are you okay? But anything that's BBB and above, and which is the lowest BBB? BBB minus. Anything that's BBB and above, we call as investment grade. Anything below that, we call high yield or junk category or non-investment grade. That's the general framework. Now, I'll show you something. I was studying a business few days ago and I found something interesting if I can find it for you. So I took a screenshot to show it to you later. I found it. Okay, wait a minute, how do I share it? So this is an example of why credit rating as a concept is useless. Okay, not useless, but not to be trusted. Okay, so I want you to look at this particular thing. This is one particular company. On July 2025, okay, the investment rating was downgraded. It was BBB, and it was moved from BBB to BBB minus. Okay, this happened on July 4, 2025, and then on July 11, 2025, how many days after? 7 days. The rating shift from BBB minus to D. Okay. Now, if rating agencies are going to do something like this, then I feel they're completely useless, because the job of rating agency is what? To give me some idea of how well the company's financials are positioned. Now, and therefore, if some company is BBB, the last hope I have from company is that the company will not default. Okay, things go wrong, business is bad, maybe rating can move from BBB to BB, but a rating moving from BBB directly to D, that means the credit rating analyst or agency did not do his job properly. And this is just one case, right? There are hundreds of cases that I can show you where this has happened. So that's another problem, that ratings typically lag the news in the market. Okay, what was the news? Just a week ago, think of that analyst who gave triple B, which means who said, okay, investment rating, investment grade, everything is okay. And then next week, when he did a little more research, he realized, oh, company is actually already defaulted. Right? And someone who's defaulted, I'm giving them a rating of triple B. So he directly downgraded to D. So you want to be a little careful with trusting on rating agencies. Now in India, unfortunately, we have CRISIL. Okay, CRISIL is partnered with S&P. It's an arm of S&P globally. S&P. So globally, there are top 3 rating agencies. Which ones? S&P, Moody's, and Fitch. Okay, these 3. In India, we have CRISIL, we have ICRA, and we have CARE. CARE has partnered with Moody's in India. And then we have a long stream of rating agencies. There is one called Brickworks or something. Then the one we saw now, it's called Info Ratings or India Ratings. So there are a lot of these agencies. And one of the problem we have with agencies in India and even globally, there's a concept called rating shopping. Okay, now this is not in your syllabus, but something you should know. Rating shopping means what? It means I want to get myself rated, but I want to have a, let's say, triple B rating. So I will go to CRISIL. CRISIL, what's your fee for rating me? CRISIL says, okay, I'll charge you 500,000. I'll say, okay, but promise me you will give me triple B. Now CRISIL is probably too reputed to do that. That's my guess. So then I'll go to ICRA. ICRA will say no. Then maybe I'll go to CARE. Okay, now I don't want to get specific, but maybe maybe CARE will say yes. Or I go to the tier 4, tier 5, the next few agencies, and they will be like, sure, why not? In fact, we'll give you a discount also. We'll do it at half the price and give you rating whatever you want. So therefore, you also need to decide whom to trust, whom not to trust. Anyways, then fallen angels, something which was earlier an investment grade, but now it has gone to junk bond, which is what we saw. Name of that company was Sadhana Nitro. Then syndicated loan means 2 or 3 folks coming together and giving a loan. So that's called a syndicated loan structure. Primary bond is like an IPO. Secondary bond, bonds trading between investors. Debut issuer means issuer for the first time. Now when you are a debut issuer or even otherwise, most of the investment banks will do a road show for you. That's a term we use in finance. It's fancy, but it simply means they will prepare a PPT for you and then they will do marketing with investors. Okay, now it could be physical, it could simply be online, just could be Zoom calls. But let's say that I am an investment banker, someone comes to me and says, I want to raise money. I'll say, sure. Now, depending on what kind of company they are, I should know what investors generally invest. So I call those 5-6 folks, I show them the presentation, market for them. That's called roadshow. Then private placement is finding 4 or 5 large investors and placing the bonds to them. Best efforts offering, I'm an investment banker, but I'm not underwriting it. I'm not promising that if no one buys, I will buy. I'm just going to try my best to sell them. That's called best efforts offering. Then bid offer spread, we discussed in equity class. Bond markets are typically quote driven. So dealer will give you a bid quote and ask quote. Dealer will always buy cheaper and sell expensive. Therefore, bid will always be higher than ask. Bid will always be higher than ask. That's right. Ask will be higher than bid. So thoda dhyan se suno please. Distressed debt means companies which are already in stress. At times there are some opportunities for you to make money in some of the distress opportunities. A lot of it we'll learn in depth in the level 2 class when we learn a reading called hedge funds, where there is a distressed debt strategy, where we'll do all the mathematics of doing distressed debts. Next reading, fixed income markets for corporate issuers. When I want to take a loan from bank, I have an option of uncommitted line, a committed line or revolving credit. Uncommitted line means I'm going to let you borrow up to 500 rupees, but I can stop that any point of time. Okay, so least reliable, but also least costly. And the bank has a reserve to refuse, has a right to refuse. Okay, refuse means कभी भी बंद कर सकते हैं आपका उधारी. A committed line of credit, relatively more reliable. They'll commit you for 6 months, 1 year or something like that, but then they will charge you an upfront fee. Okay, so theory questions on this, make sure you know it. By the way, last to last attempt, fixed income paper apparently was quite difficult. Okay, and when we analyzed the scores of the candidates, we realized many of them had struggled with fixed income as a subject because everyone was good with the calculation, but no one really focused on the second part of the crash course. So, मैं थोड़ा डरा रहा हूँ आपको, but I want you to focus on the theory piece as well. There will be questions here. If you're a lender, okay, committed line will require more bank capital. Now, this is something you need to know. Whenever bank gives loan, bank has to have some level of capital with bank to justify that loan. That's called the tier 1 capital, tier 2 capital. मतलब उतना capital होना चाहिए, equity capital. Now, there are some mathematical calculations for this. So, when I give a 100 rupee loan and it's uncommitted line, maybe it's okay for me to have capital of only 8 rupees. But when I give a 100 rupee loan and it's a committed line, then I have to have maybe capital of 10 rupees. Okay, so bank needs to have more capital to give uncommitted line. And what's the problem with more capital? More capital means your relatively cost goes up of giving that loan. Then revolving credit agreements. This is the best out of the three, most reliable. Multi-year credit commitments. Lenders typically seek protection such as covenant, which will require certain actions. Which means for next 2-3 years, this is an agreement, you can keep on borrowing me on a revolving structure. Then when you have accounts receivable on your book, okay, you have an option of either assigning those or factoring those. Assigning simply means assigning those to someone else, getting money up front, but the company will remain responsible for those loans. So the credit risk is not passed on to the other party who's buying the accounts receivable from you. In a factoring, the company shifts granting and collection process to lender. So how does the factoring work in practice? And you should know this because there is something very interesting happening in India. And I'm kind of playing this theme. I've invested into a micro cap company, probably very risky. I've already lost a lot of money on it. But there's a company I've chipped in a little bit. It's called VFin. What is the theme in India? Theme in India is historically Indian banks have always given working capital loans, short-term debt, right? Now those working capital loans are shifting to a different type of financing called supply chain financing. Okay, that's a slowly transition that's happening. Now, if that theme is to play out, I'm betting on VFin because they build software for making it easy for banks to do supply chain financing loan. But what is supply chain financing now? It is an indirect way of working capital financing. Earlier I'll go to a bank, I will say, listen, I have put in a factory of 10 crores, please give me working capital loan of 1 crore. Now in that 1 crore, I will buy some inventory, some accounts receivable, all of that. Now the banks are saying no. You built a factory 10 crores, congratulations. Now, when you need to buy inventory, come to me with specific inventory bill and we will give you loan for that particular inventory piece. Right? Not give you an open-ended loan that you can use anywhere. If you have sold goods of 500 rupees to a customer on credit, we will give you those 500 rupees, but first show us who's the customer. Let me evaluate if the customer will pay us back on time. If yes, we will approve the customer, then you can sell him at 500 rupees and immediately we will give you 495 back, we will collect from customer. When that happens, that's referred to as factoring. Is it okay? So from exam perspective, no assignment, company is responsible, but factoring, the lender is responsible for defaults. Then CPs. CPs are your short-term zero coupon instruments, okay, similar to treasury bills. Typically maturity is less than 3 months, okay. So I'm a corporate, I need a little bit of money, I can issue a commercial paper. Now, with CVs, there is a significant risk called as a rollover risk. Okay, let me explain what a rollover risk is. Imagine I'm running a business, I need capital, so I come to you. What's your name? Meghna. And Meghna lends me for 3 months. So Meghna gave me 99 rupees. In 3 months, I have to give her back 100 rupees. Now, at the end of 3 months, what I will do is, I will go to, aapka naam? Bhavna. I will go to Bhavna and I will say, Bhavna, will you please give me a loan of 100 rupees for 3 months? I will take those 100 rupees from her and give that to Meghna. Are you following this? This is called what? Rollover. It's a standard practice. Everyone does it. Now, what's the problem with this? The problem with this is, what if after 3 months I went to Bhavna and Bhavna said no? And then I went to other folks and they said no. Right? We will not give you a loan for short term because of whatever reason. Then I will default on the first loan. Correct? This risk is referred to as rollover risk. My inability to roll over for the next maturity loan. And typically, how do you minimize rollover risk? So, one way to rollover risk is if you have a committed backup line of credit from banks. Okay, so what is this now? The way committed backup line concept works is, let's assume I went to Meghna and I said, Meghna, I want a 100 rupee loan. Now, Meghna knows that if Utkarsh is not able to roll over in 3 months, he will default, right? So, what Meghna will demand, okay Utkarsh, I'll give you 100 rupees, but first you go to a bank and you get an approval from them of committed line of 100 rupees. You don't borrow from it because I'm giving you, but you keep that approval. In case after 3 months you are not able to borrow from Bhavna, you can always get money from your bank and give that back to me. So as an investor in a commercial paper, I'm going to require what? As an investor in commercial paper, I'm going to need the issuer to have a committed line of credit. Okay. Then some other short-term fundings, one is deposits, right? In India we call them FDs. In the US typically they're called as CDs. CDs can have maturity of more than a year. All CDs are typically zero coupon bonds. So CPs are issued by corporates, CDs are issued by banks. Okay. There are two types of CDs, negotiable, non-negotiable. Theory question. I hope all of you are listening to this. In a negotiable CD, I can withdraw the fund by selling the CD in the open market. It's negotiable, which means whoever has the control, physical control of that CD are the owners. A non-negotiable CD means I cannot sell, I'm locked in. Have you understood the difference between the two? Then interbank markets is where one bank is going to lend to another bank or central bank is going to lend to other banks. And CPs we know are typically unsecured notes which have rollover risk. Now this is where this gets a little tricky. Okay, repos we have to do carefully and we have to do some calculations in repo as well. Okay, we will have an example to deal with below. It's tough. So, if you are a little distracted now, please come back. Focus. Understand the crux of what is a repo. Who is this? A borrower. Lender. Okay. Now, a repo transaction, even though the name says repo, repurchase, it's actually not a buying and selling transaction. It's a collateralized borrowing transaction. Okay, like how you can keep gold as a collateral in a bank and take a loan, it's somewhat like that. The way this transaction will work is, it will have two legs of the transaction. First, a borrower will go to lender and say, listen, I'm selling this bar of gold that I have. Okay, do you want to buy? Sure. So how much? So let's say I will sell it to you for 100 rupees, this gold. Okay. So lender will say, sure, take your 100 rupees. So now borrower has got 100 rupees, gold went to lender. After 3 months, they will sign an immediate agreement. What is the immediate agreement? That after 3 months, the lender will return gold to whom? To borrower. Okay, so the gold is returned now, and the borrower will give to lender a 102 rupees or 103 rupees. So, repurchase agreement. Today I am selling you gold at 100 rupees with an agreement to repurchase at a price of 102 3 months down the line. So technically this sounds like I am buying and selling, but technically I am giving a loan and I am charging an interest from a lender perspective. Lender is charging interest of 2 rupees on 100, and in case of default you have collateral with you, right? You have the gold. So this is called as a repo transaction. Now generally repos are done on, when you think of repo from borrower perspective, we call it as a repo. Okay, but when you think of the same repo from lender perspective, we call it as a reverse repo. So depending on whether you are a borrower or lender, it could be a repo or reverse repo. Okay, now there are two main motivations for doing repo. One is basically a simple borrowing or lending. This is one type of repo, right? I want to take a loan or I want to give a loan. Second motivation for doing repo is if you need some asset for some time. Okay, if you need some asset for some time, you go to that party. So think you are a lender. Okay, but now you don't want to lend, but you just want gold for some time with you. And why, I'll tell you. But आपको चाहिए gold. Now you're struggling to buy that gold in the market. So what you can do is you can enter into a repo transaction where you go to borrower, you say, you know what, why don't you give your gold to me for 3 months and I'll give you 100 rupees and then you give me 102 back. Okay. Now the question is, what will I do with that gold? So technically, would you agree that a lender is borrower of gold? Yes. So lender is a borrower of gold. So I will borrow the gold and I will short sell. So there is another type of repo which is motivated from a short sell transaction. Short sell means right now Nvidia shares have gone up quite a bit. So I will go and find someone who has Nvidia shares and I will tell them, why don't we do a repo for 3 months? You give me your Nvidia shares, I'll give you some money. After 3 months I will return the Nvidia shares to you, and then in the meanwhile short sell those Nvidia shares. Is it okay? Now some technicalities here. Look at this point 4. Rather than involving a specific security, a repo transaction may instead reference a specific group of securities as collateral, which is called a general collateral repo transaction, okay, or a general collateral repo, versus a special repo transaction. So which is general? You give me whatever security you want, treasury bond, gold, all of those. What is a special repo? Where I need Nvidia shares, I need gold, I need one particular asset. Then a reduction or haircut involves a loan value less than the value of collateral. For example, if loan of 95 is issued, the collateral value is 100, we say haircut is 5%. Okay. If haircut is 5%, then the haircut of 5% would result into something called as initial margin of 105.26%. This thing I want you to write down how initial margin is calculated. Okay, there are questions on this. It's a little tricky, so make sure you get the hold of this concept. Initial margin is calculated as the value of collateral divided by the value of loan. Value of collateral divided by value of loan. value of collateral divided by value of loan. Loan value is also called purchase price. Loan value is also called purchase price. So value of collateral divided by purchase price. Initial margin you calculate using purchase price as denominator. Haircut is calculated using the security price as denominator. Correct? 5% haircut. So you kept 100 rupees as denominator. Okay. Then there is another concept which is called variation margin, which is initial margin into purchase price minus the security price. This is the amount of margin that you might have to deposit with the lender. Initial margin into purchase price minus the current security price. Let's do an example. This is from the juice notes. By the way, for two subjects, fixed income and quant juice notes. When you want to quickly revise all the calculation, very easy navigation for you is look for black boxes in your notes. Right? We followed that format. All the mathematical calculation oriented areas are put into these black color boxes. So you can navigate through the material fast. Here's an example one. Look at this carefully. A borrower wishes to keep security of 1000 as a collateral. Initial margin is 102%. Calculate the amount of loan that can be offered. So initial margin is given as 102%. Can you tell me what was the formula for initial margin? Collateral value divided by the purchase price, which is nothing but loan value, right? Now, initial margin is given to you as 1.02 or 102%. And collateral value is how much? $1,000. So what do you need to do? You need to move purchase on the left hand side, right? So 1000 divided by 1.02. How much is that? 980. Which means for a $1,000 collateral, we will get a loan of 980. Now, what is the haircut in this transaction? So in the haircut, we keep 1000 in denominator. So one is 2%, one is 1.96. So you can easily move from 2% to 1.96. How? 2% divided by 1 plus 2%. करके देखो. 2% divided by 1 plus 2% will give you 1.96. Or you can say, hey, listen, I gave collateral of $1,000, but it gave me assets of only 980. So which means it gave me 20 less, a little less than 20 on 1000, 1.96. Okay. Then what will be the repurchase price for a 30-day repo at 0.25% repo rate? Again, when you see a repo rate is nothing but an interest rate. Very easy for you to think that this 0.25% is for the whole month, but it's not. We discussed earlier, any interest rate is always per annum. So this is 0.25% on a per annum basis. In a repo transaction, we do 30 by 360 day transaction. So purchase price of 980, which is a loan value, into 1 plus 0.25% into 30 by 360 is equal to 980.59. Are you okay with this? You can do this on TVM row also, by the way. Do this. Second clear TVM. 980.39. Present value. 0.25 IY. 0.25 IY. 30 by 360. Okay, mistake. 0.25 into 30 by 360 equal to is your IY. करो और एक बार. 0.25 into 30 by 360 equal to is your IY. 1 is your N. Compute future value. 980.59. Now, after 7 days, the value of the security has decreased to 975. What will be the variation margin? When you provided security, it was worth how much? 1000, correct? But now it has fallen down to how much? 975. So you will have to maybe deposit a little bit more margin. How will you do it? First, figure out what is the purchase price after 7 days. How will you do it? 980.39 into 1 plus 0.25% into 7 by 360. That's coming out to be 980.43. Then variation, ये समझा ना? Then variation margin, initial margin into purchase price minus security price. So 980.43 into 102 percentage minus 975. So we have to deposit additional 25.04 as a variation margin. Okay. On the exam, if you are short of time and you have to quickly do math, I'll tell you easier way to determine. Original security value was how much? 1000. Now the security value fell to how much? 975. 25 rupee or dollars, somewhere around that. So your answer, look at this, 25.04. So you can get the answer super fast. Now the security value has gone up to 1030. So now variation margin, you will get the money back. Approximately how much? 30, right? If you do the precise calculation, 29.96. And same calculation, find out the current purchase price of the loan, initial margin into purchase price minus security price, take the delta, that becomes your margin. Do you think you can handle this? Okay. This is done. Okay, now what factors affect repo rate? Now, when you want to answer theory questions on this, on the exam, कि repo rate कब बढ़ता है? When does the repo rate go up? When does the repo rate go down? All the factors that determine interest rate in an economy will determine repo rate in an economy. So the factors that will push the interest rates up will push the repo rate up, and so on. Okay, so if money market rates are higher, repo rates are higher. If your collateral quality is poor, right, then interest rates will be higher. If you're taking loan for a longer period of time, if repo term is longer, then repo rates will be higher. If you have a very unique collateral, which has a lot, if you have a unique collateral which has a lot of demand in the market right now, everyone wants to borrow, everyone wants to have that collateral from you, then the repo rate will be lower. Make sense? Then, are you going to give delivery of your collateral or are you just going to keep it with yourself? Those are also type of transactions. At times, I will actually physically come and give gold to you. Then it's safer for you, no? So repo rate's lower. At times, I'll tell you that मेरे पास है, don't worry. है ना? Then obviously risk for you is higher, so repo rates will be higher. So collateral delivered, repo rates are lower. What is the risk with repos? Default risk, right? Then collateral risk, the value of the collateral will fall. Margining risk, suddenly the variation margin might go up if the assets are very volatile. Legal risk, if it's a cross-country repo or cross-jurisdiction repo, then some of the legal risk, and netting and settlement risk at the time of settlement. Settlement risk, I told you, we've discussed this, right? It's a big risk. It's like you and I do a repo, and let's say you have gold, you're going to give me gold, and I'm going to give you money. Now you give me gold, and you said, Utkarsh, ab de paise. And I said, you know what, chal chai pi ke aate hai. Let's go for a cup of tea, fir deta hu. And then we go for a cup of tea, and then after that I disappear. Okay, which can happen. These are the risks which are called settlement risk, which are big risk in the derivative world, where you honor the transaction, but only one party pays, the other party doesn't pay. Settlement risk. Then there are two types of repos, bilateral and tri-party repos. In a bilateral repo, you and me are transacting directly. In a tri-party repo, you say that, Utkarsh, you don't keep your collateral with me, let's find a third reliable party and let's route it through the third party. So collateral will remain with the third party. Those type of structures are called tri-party repos. The biggest tri-party repo agent in the world, or a custodian in the world, is BNY Mellon, right? So all the folks who just few kilometers away from here, we have large BNY office. One of the big profiles here is they handle all the tri-party repo transaction, back office work. Repo, what is the risk? Rollover risk and liquidity risk in adverse market condition. Then we move to long-term corporate bonds. Do you think corporate bonds will give you more yield than a government bond? Yes. Therefore, whenever an investor starts buying corporate bonds, we say that investors is migrating to credit side of the portfolio. So a fixed income manager at times comes and tells you that I focus on the credit. That means they're mostly buying corporate bonds. Okay. Now these are your ratings, AAA to BBB, and below that we have non-investment grade. Different ratings here. Fallen angels we've discussed. Okay. Good. Next rating. Now we focus on fixed income market for government issuers. Government issues what type of assets and liabilities, right? So first, government balance sheet. Government has assets. Government has foreign currency reserves. Government might be the owner of commodity. In India, government owns a lot of things, including many companies. Right? We know that, we've seen, right? President of India is a shareholder in so many companies. These are some of the liabilities of the government. All the currency which is outstanding is a government liability. Every note that's in your pocket is a liability for Government of India. And you want a proof, just take out the note and read. I promise to pay the bearer, right? So that's a government's liability which is currency issued. And short-term debt, different type of debts that governments will have, all of those are liabilities. Maybe if some question writer wants to write theoretical questions, they will ask you this question. A lot of people will get this answer wrong, but if it comes, you will get it right if you remember what I'm saying. Government does accounting on cash system, not accrual system. Okay, that's how government accounting is drastically different than your normal corporate accounting. Okay. Difference between developed market and emerging market. CFA curriculum view has always been developed markets are great, emerging markets are risky, volatile, maybe tactical, but not permanent. Obviously now there is some possibility emerging that US might be in trouble with its debt, right? So CFA Institute will have to take a lot of effort in updating their curriculum, because the US debt might not remain risk-free anymore, right, if something like that happens. But nevertheless, we are preparing for the exams. Emerging market, high growth but less stable, depend on dominant domestic industry. Okay, every country will have one or two industries where there's a lot of reliance. India probably is diversified that way, but we still have IT, we still have pharma, these 2-3 large industries. But think of Saudi, which is the dominant industry, oil, right? And then if something goes in oil, the economy is in trouble. Then central government has budget priorities, which typically also involve expanding social infrastructure. Not necessarily central government always thinks of economics, right? At times they have their other agendas. Okay. Now, Indian government can issue debt in two scenarios. One, it can issue in rupees. One, it can issue in US dollar. If it issues in rupees, it's called domestic debt. It's relatively safe. But if it issues in US dollar, it's called external debt. That's risky. Okay. So when India is taking loan from World Bank, typically the World Bank will give us loan in US dollar. So we have to repay in US dollar again. So we can't print US dollars. We can print Indian rupees. Then this concept we discussed in economics called Ricardian equivalence. Okay. What is Ricardian equivalence? If you as an individual government comes to you and says, you know what, I really like you, don't pay taxes for next 3 years. Keep everything that you want, keep it with yourself. Now, the traditional economics will tell you if that were to happen, आप जाके खर्चा करोगे, right? You would go and want to spend, but not under Ricardian equivalence. Under Ricardian equivalence, you are little chatur. So you doubt the government. You say, okay, they're coming and telling me no taxes for 3 years. How will they manage? Which means in the future, they will come and charge me higher taxes. So I will not spend now, I will save. So that in the future, when government charges me higher taxes, I will have money to pay. That concept is called Ricardian equivalence. Understood? Which means government increasing fiscal deficit does not directly increase consumption. That's the implication of Ricardian equivalence. Okay. Now, when government is issuing debt, okay, so maybe this part I'll show you from US bar curve. Yeah, there is a little bit of economics in this reading, so it's a good revision. See, this is your par curve of US. Look at what US government is doing. They're issuing bonds 1 month, 1.5, 2 month maturity, 3 months, 6 month, 2, 3, 5, 7, 10, 20 and 30. Imagine you're the head of the department in the government that wants to borrow the money. Now I've told you before, government typically borrows through auctions. What would you like to borrow? Would you like to borrow more money for 1 month or more money for 30 years? Where would you like to borrow? Would you like to issue 30-year bond or would you like to issue more of a 1 month bond? Huh? Bolo? Depends on? Hey, interested to say in front of you. 1 month? So you should borrow 1 month, right? Now, if I borrow for 1 month, then next month I have to repay. Where will I get the money? Borrow again, right? And then 1 month after that I have to repay, so borrow again. So government is creating rollover risk. What if sometime they try to borrow but no one is willing to buy? So government will default. And why not borrow 30 years? What's the problem with that? The rates are high. Correct? The rates are significantly higher, 4.86. You know what's happening right now? In the last 3 years, US government, last 2 years, US government has been struggling to borrow long term. So the ratio of borrowing short term to long term, the short term proportion is increasing and long term proportion is decreasing. That means now US government has significant rollover risk. Because they borrowed short term, they have to keep on doing those rollover. The correct way to borrow is to kind of spread it across the entire spectrum. Correct? So borrow a little bit here, a little bit there, so that you can manage it properly. This is what we are talking about here. Okay. How does government borrow? It borrows through auctions. Okay. Now on this auction, there can be some tricky question. So I want you to isn't 30-year someone is saying, isn't 30-year better? Yes, it's better, but 30-year will cost you more because you'll have to pay something called as a term premium. I mean, we can go into depth of it, but it's a crash course. I'm keeping it concise. But that concept of term premium, market practitioners forgot after the 2008 crisis. Okay, there was always this thing called term premium, but after 2008 crisis, US Fed got so aggressive in that quantitative easing that people forgot कि term premium नाम का भी चीज होता है. But prior to that, we've always had this concept of term premium. What is that? It is if I'm buying a 30-year bond, you need to pay me more because I am taking uncertainty for such a long period of time. So I need the term premium. If I'm buying for 1 year, it's okay if you pay me less, right? Now what's happening is that term premium has re-emerged again. And now I think across all the countries, slowly the term premium will start becoming higher, which means long-term yields might go up. Therefore, we should not borrow everything for 30 years, we should spread. Okay? Now, I told you government issues bonds with auctions. Now, as a government, when I'm selling the bond, do I want the highest price or lowest price? If I'm selling a bond, do I want highest price or lowest price? I want highest price. But the bidding does not happen on the price. Government issues bonds at a fixed price of 1,000 rupees. Because they want to raise something, they'll say, hum 1,000 mein bond bechenge. Then, the bidding happens on coupons, coupon rate. Assume there are two bidders. One says, I want a coupon of 3%, other says 4%. Which is more attractive to the government? 3%. Therefore, I told you that government always issue the bonds at par value. Therefore, the coupon rate at which those bonds are issued, they become the par rates. Okay? Now, there are two types of bids in this auction. There is a competitive bid and non-competitive bid. Okay? Who are non-competitive bids? These are folks who follow BAP principle. Have you heard of BAP principle? No. BAP principle means buy at any price. Okay? So, these folks will go and they will bid in a non-competitive bid. They will say, please give me 50 bonds. I am not even telling you what coupon, you decide. Are you getting it? So these are referred to as non-competitive bids. What are they bidding? They are bidding the quantity. They are not bidding for the coupon rate or price. These folks will come and say, listen, we will buy only if you offer a coupon of 4%. Someone else will say 5%, someone else will say 6%. So the government will have to calculate a clearing quantity. Let's say clearing quantity is coming at 5%. Then everyone will be issued the bonds at a 5% coupon. Okay? This system is called a modified Dutch auction system. समझे आप कैसे हो रहा है? So two types of bidders, competitive and non-competitive. What is non-competitive bidding? Just quantity, not the price. They will be always given first preference for allocation. Because obviously they said you decide the price, we'll buy. Then we go to competitive bidding. In competitive bidding, someone will quote lower coupon, some will quote higher coupon with their respective quantity. You'll have to find the quantity at which the 100% quantity can be cleared. For example, let's say government wants to issue 100 bonds. These folks said we will buy 40 bonds. Okay? So fine, 40 is done here. Now here, there was one person who said, give me 5% coupon, I will buy 30 bonds. Someone else said, okay, if you give me 6% coupon, I will buy 20 bonds. Someone else said 7% coupon, I will buy, 1 minute calculate karne do, 70, 90, 10 bonds. Someone else said, give me 8% coupon, I will buy 200 bonds. Okay, I'm just making up. What will government do? They will say, I need to sell 100 bonds, 40 is coming from here, so done. Then 40 plus 30, 70, 70 plus 20, 90, 90 plus 10, 100. So at 7%, I can clear out the whole 100 quantity. So that's called market, that's the rate at which the whole quantity is cleared. This is called which auction? Modified Dutch or single price auction. Okay? Everyone will get 7% coupon. Now there is a small variation of multiple price auction. Some governments have operated that in the past where to different people I will offer at different rates. But obviously then the problem with auction like this is no one will bid lower rate. Right? Because there's a risk. Think about this guy. If government had issued 30 bonds to this fellow at 5%, then he would feel little bitter because other guys got it at 7%. And believe it or not, RBI was actually on this regime couple of years back. Now they have moved to single price regime where one rate for everyone. Okay. Then on the run, off the run. On the run means most recently issued. Off the run means issued sometime back, right? Now on the run are more liquid, off the run are less liquid. Okay. Because these are very desired, on the run YTM will be a little lower, whereas off the run YTM might be slightly higher, marginally higher. Okay, so that's your on the run versus off the run. Okay, then different types of bonds issued. There are government agencies. Example here is Airport Authority of Hong Kong, which is a government agency. Or there could be local governments, which is municipalities. Municipalities issue two types of bonds, GO bonds and RO bonds, or revenue obligation bonds. GO bonds are, I'm taking money from you, I'll pay you from general taxes and other things. Revenue bonds means I'm taking money from you, I'll pay you specifically from one project, revenue of that particular project. Then supranational organization means your IMF, Asian Development Bank and all of those. Okay. Next reading, a lot of this we've already covered. Price and yield. Calculate value of the bond using annual coupon, semi-annual coupon. Can you handle this? What is a YTM? We know. Do we know full price, flat price, accrued interest? Good. Okay. Now, do you know the concept of convergence to par? Convergence to par means a bond price, if it's issued at discount, over a period of time that bond price will gravitate towards par value. That means it will increase. If the bond price is issued at par, it will decrease. Bond will always reach at the face value on the 5th year. Convexity effect we know. Metrics pricing we have to do a little bit of work. When do we use metrics pricing? When I want to value a bond but I don't know what's the YTM because there is no transaction. Okay, so here's an example. An analyst needs to value a 4-year 6% annual coupon payment corporate bond. Assume bond X is not actively traded, there are no recent transaction reported. So we have YTM of a comparable bond. So we have A, B, C, D. These are their different tenors, these are their different coupons, prices and YTM. So how will we run metrics pricing here? Observe. Step number 1, for 2 years we have 2 bonds. Right, these two. So, please calculate an average of the YTM here. How much is that? 10%. Then please calculate an average of 5 years. How much? 13 plus 17 by 2. 15%. But our bond is how many years? Our bond is 4 year. So what we have to do is we have to run linear interpolation. Okay, I'm showing you a simple technique to do the interpolation. This is a 2-year bond, market rate is 10%, and this is a 5-year bond, market rate is 15%. We have to be here. क्या हुआ? 13%. क्या 13%? Okay. So 2-year bond 10%, 5-year bond 15%. I need to be in which year? 4 year. I need to figure out what's the YTM. So step number 1, take the total distance in time period from 2 to 5. How much is that? 3 years. For 3 years, take the distance from YTM to YTM. How much is that? 5%. Then step number 2, take the desired distance, which is 2 to 4. How many years? 2 years. How much should be the distance in the interest rate? Now in the school, they taught us this concept of cross multiplication. So 2 into 5% divided by 3, how much is that? 3.33. So I need to add 3.33 to 10 because that's the red distance. So 13.33 becomes my answer. using matrix pricing. Would you be able to handle this? Yes? Okay. And then, of course, once I have the YTM, I can value the bond. Now, a slight variation of this example. Example 2. You're an investment banker who needs to value a 4-year 6% annual coupon payment. Assume that bond X is to be newly issued. The investment banker is trying to determine an appropriate yield spread for the bond. Okay, now here we have to apply matrix pricing on the spread. Spread means the incremental interest rate. Remember, it's a 4-year 6% annual coupon payment bond. Current 4-year government rate is 8%. So my YTM is going to be 8% plus the spread. My job is to figure out the spread, then I can value the bond. Yes or no? A 2-year and 5-year government bond is 7% and 9% respectively. Exhibit below shows prices and YTM for these 4 corporate bonds with similar credit quality. Okay. So what do we do? Step number 1, calculate the spread. Remember 2-year, what is the government rate? 7%. So what will be spread here? 1%. What's the spread here? 5%. Then for 5-year, what is the government rate? 9. So 9 and 13, what's the spread? 4. 9 and 17? 8. So these are the current spread. Then take an average of 2-year spread. How much is that? 1 plus 5? 6 by 2? 3. Average here? 6. Then do the same thing. This is 2-year. Okay. 2-year, and this is 5 years. Here the spread is 3%. Here the spread is 6%. The bond that I am working with is 4 years. Okay, so this time we have to compute the spread. The logic is same. Step number 1, take the total distance in the 2 time period. From 2 to 5 is how many years? 3 years. 3 years, no? 2 to 5. And by how much the spread distance? Spread distance is 3%. Then compute distance from the beginning to your maturity, which is 2 to 4 years. How many years? 2 years. For 2 years, what should be the spread? Cross multiplication. 2 into 3 divided by 3. क्या? 3 years के लिए 3 तो 2 years के लिए कितना? 2. Thank God. So 2%. This 2% is the increase in the spread, which means 3 plus 2. Spread here should be how much? 5%. So you go and add 5% to the government rate. So YTM becomes how much? 13, and then go and value the bond. So this is your matrix pricing on the spreads. Nice. But our speed will slow down in the last few readings. Are you enjoying this? Break चाहिए? ये वाला रीडिंग थोड़ा टेक्निकल है. इसमें we have to memorize all the definitions of the spread. Okay. Which area of finance do you think I say I'm just kind of breaking the conversation a little bit for 2 minutes. Which area of finance do you think has the highest salaries? Quants. Quant research has the highest salaries, okay. Private equity has the highest salaries. Wealth management. Some folks are saying hedge funds. No, are you asking me for are you looking at me for an answer? Okay. I'll tell you India specific at least. I think in India, front office IBs and private wealth, private banking are the top salaries. Both these roles require more of marketing skills. You need finance, but you need more interpersonal skills and less technical finance. I mean, okay, technical finance is assumed, but you have to have really fantastic with your interpersonal communication skills. Private wealth, I feel, is relatively faster way to, let's say 1 crore salary, maybe, if that's the threshold, right? And I'll tell you my experience, and of course, whatever limited knowledge I have. You can reach in private wealth in that domain, you can reach in maybe in the current market environment, if you're really, really good, about 6-7 years. Once you start managing 300 odd crores type of money, then for your firm, you're generating about, close to 1.7 to 2 crores of annual revenue. They don't mind paying you 80 lakhs, 2 crore rupees out of it. So private banking, private wealth, according to me, is a top tier career. I also feel that's one career that's largely protected by the whole AI thing. I mean, just think about it. If you're managing money for this, the आपका eternal founder, क्या नाम है उसका? Dipinder Goyal. You're managing money for Dipinder Goyal, for example. Now, AI, if that investor has a doubt, he needs someone to call and ask, right? So, generally at that level, AI penetration will be lower. I feel investment banking front office also is a great career, but it's very cyclical. There, your pays is a function of salary plus bonuses. Bonus is a function of deal flow. So in good markets, when there are a lot of IPOs, a lot of transactions happening, good deal flows, your bonuses are really, really fat. I've seen, we had one student, I think post-COVID, for every year, his bonus was about 2x of his annual pay, right? The base level salary. But that's also because the buoyancy of capital markets and transactions were very, very fast. Now the transactions in the last 18 months have slowed down, right? Which means technically if there's no deal happening, then no bonuses. And investment banks generally are quick to hire, quick to fire, right? Because all this fixed cost starts hurting them. So the moment deal flow reduces, they start getting rid of the employees. Private equity is also fairly cyclical. I feel it's very, very tough to break into private equity with just being a CFA. It will happen in the future, but right now I find it extremely difficult. But if you get into a top tier private equity firm, like a good quality private equity firm as an analyst, your entry level pay is easily, as a fresher or 1 year experience, is about 20-25 types. But if you get into really good firm, and from there you're looking at a 20% CAGR. Equity research is where you have the highest diversification in pays. If you go to sell side with top level folks like Macquarie or CLSA or GS, तो fresher या जो 1 year experience entry level analyst, उनको कम से कम 20 से 25 लाख 20-25 lakhs देते हैं. In fact, they would not hire anyone less than that, the top tier firms. But if you go to Indian brokers on sell side, there it comes down to about 10 to 12. If you come to buy side, Smaller firms, then maybe salaries can go as low as 3, 4, 5 lakhs per annum as well for a fresher, right? But as your level of skill penetrates, you also make a lot more money. I think in general, sell-side equity research pays more than buy-side equity research, but you can't become a fund manager being on the sell side. And fund manager always will pay you more than any equity research analyst, right? So that's a call people have to take, that after how many years of being on the sell side, I should transition to buy-side equity research. So, anything you want to ask? See, cons is very, it's such a generic term right now. Some firms will have budget to pay, but it's a very small market in India at the moment. It's very small. I think not more than 20-30 firms are doing serious cons. So the market size is lower. Based on what I've heard from folks is the pays are good, but not obnoxious. I haven't heard pays of 1.5, 2 crore plus type of salaries. Mostly whatever folks I've spoken to are 15-20 lakh type of range, already in 2-3 years of experience, which you otherwise would have made elsewhere as well, right? If you have that kind of data science experience. So right now it's not picking up, but I think right now is also good time to be in cons to acquire skills, because 3 years, 5 years down the line, large number of human funds will become machine funds. I am sure there will be a day where we'll be able to advertise that our product is human intelligence led, because everything else by default would be machine intelligence based. That's happening. Hedge funds, we don't have hedge funds in India. The salaries in US are fantastic. I mean, if you get into a top tier hedge fund, you're being paid crazy. But there, we have a few students. In fact, one of our students owns a hedge fund. He built a hedge fund on cryptocurrency, and he exited, sold the hedge fund, made kick-ass money. I think he retired at the age of 32. So last time I called him, he'd shifted to Miami because you get you get tax benefits. If you build your business in New York, then the taxes are obnoxious, but at the time of sale, you can shift the transaction to other states to get tax benefit. So hedge funds are kick-ass money, but hedge fund makes money if the strategy works, right? Because hedge fund typically makes money on 2/20. So when the strategy works, the whole money gets passed on to the team. Small buy-side PMSs, you make hedge fund-like of money in India. I know one fund manager who made some 300-400 crores of small fund manager whose office is probably smaller than us here. But during COVID, he was significantly loaded up on chemical and COVID stocks, because that was his expertise, and he made some crazy 300-400 crores a year, right? And then in those kind of bonus years, then you want to reward your team, so you want to pass on some of these benefits. So the 2/20 structure works really well in good times, because just think about it, that you're into asset management business where you have profit sharing access available, and your assets are, let's assume, 100 crores, where every year you charge 1% management fee. So every year you get 1 crore, that takes care of your team, expenses, Bloomberg terminal, everything. Now you have one bounty year where your 100 rupees becomes 400, 500 rupees, right, in 1 year. It doesn't happen all the time, but COVID was like that. So then suddenly in 1 year you have made profit of 200-300 crores, out of which you take 20%. So you take how much? 60 crores or 40 crores, right? So your net take home goes up drastically well in good times if the markets support and you have some upside left. And that's why our industry is one of the best industries in the world to work in, because once you build credibility and once you have sizable AUM, you participate in the client's upside, but you do not necessarily participate in the client's downside, right? It's an asymmetric payoff structure. McLaren kind of money. What money that Miami dude made? I don't know, I never asked him. But I'm sure he must have made sizable money. What's the future of merchant banking? Very bright. Why do you need a merchant banker? So there you go. So companies which want to do IPO, see, one part of that IPO is your RHP building. DRHP or RHP, right? Now AI will help, so it will reduce the cost. But there are still, SEBI will have 1,000 different regulations, compliances. So merchant bankers will be required to run and especially if it's a large IPO, then you need some really experienced folks to place those IPOs, do the roadshows, garner the top investors, AMCs. So this is a pure relationship-based business. It might sound like you have to be good in finance. No, you have to be someone who can pick a phone and call folks and say, please buy. Now, no, see, did you see what happened? This Lenskart IPO, it was garbage valuation, right? Because it's that company which sells Chashma. It's a retail company, but they were trying to get themselves valued like a tech business. But even then, some of the reputed asset management houses participated in that IPO. Right? DSP and all those folks came in. I was surprised when I saw DSP buying them. Why? Because of the investment banker, the lead runners. Right? These guys will call up the asset manager, say, why aren't you buying? Because next time if I have a hot IPO, I will not give you the allocation. Correct? So that's how the relationship business works, and all of them are a syndicate. Sell in open market. So underwriters, if they get stuck on the inventory, they have to sell in the open market after a year and a half. There is a story of this crazy company. They helped Relaxo do an IPO in 1987. IPO was 1 rupee per share. Relaxo, jo joote wala company hai. About 5 or 6% of the IPO was not bought by investors, so investment banker had to buy it. Well, underwriting means I will sell, if no one buys, I will buy. No one bought, so they bought. IPO happened. These guys never sold the shares. And at one stage, that Relaxo share from 1 rupee was at some 1400 rupees. Right? So these folks made insane amount of money because of they were not able to sell the IPO, and then they decided that we will not sell the shares. So there are stories like these also. Anyways, I think now yes, that company is listed. It's called VLS. Someone on the chat box pointed out. Okay. Now I think let's do yield and first, little bit on YTM computation. So I'll give you a simple thing here. If it's an annual bond, whatever IY you get in your calculator, that's your YTM. If it's a semi-annual bond, whatever IY you get in your calculator multiplied by 2. If it's a quarterly bond, whatever IY you get multiplied by 4. This is called semi-annual equivalent basis. Semi-annual equivalent basis, okay, or semi-annual bond basis. You should be able to convert one from another. For example, let us say I have bond A, which has a YTM of 15%, but this is an annual bond. Okay, I have a bond B, which has a YTM of 14.95%, but it is a semi-annual coupon bond. Who's offering a higher YTM? Now, obviously, these two YTMs are not comparable. Why are they not comparable? This is semi-annual, whereas this is annual. So, let's convert both of them to annual. Okay, I will convert A, you do B please. A is 15%. How would you find out B? Use I conversion function. Please put 14.95 as nominal. And remember, if it's semi-annual, it has a compounding frequency of 2. So make C by Y as 2, compute effective. 15.508. Which one is higher? B. Okay. Or let's convert both of them to semi-annual. Let me do the B one. 14.95. Now please convert this to semi-annual. How will you do it? Second clear TVM, second 2, second clear work. Use I conversion, make effective rate as 15, make C by Y as 2 and compute nominal. 14.47. So you should be able to handle these conversions easily. Do you think you can handle them? Okay. Can you handle the conversions if the YTMs are negative? Yes. Same logic. Just make the number negative, do the same computation. You don't have to worry. Exactly the same logic. Then current yield, what's your formula? Coupon rate divided by bonds, flat price. Simple, okay. Then street convention versus a true yield. What is the difference between the two? Street convention ignores holidays. A true yield will consider precisely the date on which payment is made. That means it will consider holidays. A true yield typically will not be higher than a street convention, because we are generally assuming if it's a holiday, payment will be made later, not earlier. Okay. Corporate bonds use 30 by 360. Government bonds use actual by actual. Now you can convert a 30 by 360 day yield to a government equivalent yield, which is an actual by actual convention, which is called GEY, government equivalent yield. It's the most stupid question you can get on the exam. If you get a GEY question, you just take the yield and multiply that with a ratio of 365 by 360. So you should hope that half of your fixed income paper should be this. And just memorize into 365 numerator, 360 denominator, multiply, you're done. Here's an example. A 5-year corporate bond is earning 10%. Government bond is 8%. Calculate the spread with and without GEY adjustment. Comment which one is appropriate. Obviously GEY is appropriate. How will you do it? So first, take that 5-year corporate bond. First, just take the difference, 10% and 8%. How much is that? 2. But that 2 is wrong. Why? Because one is calculated on 30 by 360, one is calculated on actual by actual. So let's convert the corporate to actual by actual. How will we do it? 10 into 365 by 360, 10.13. And then take the difference of 10.13 and 8 will give you 2.13, which is correct. Easy? Then YTC, YTW and O option adjusted yield. YTC simply means what if the bond gets called, then what YTM will I earn? So whatever is the first call date, that becomes your maturity, and the call price becomes your redemption value. That becomes yield to call. You might have multiple yields to call, so you select the one which is lowest, which we call as yield to worst. Know that generally yield to worst is the number which is shown along with the bond. When it's a callable bond, when you see it on terminal or you see bond market quotation, they don't show YTM with it. They show yield to worst. That if things go wrong, worst case scenario, how much an investor will earn. Okay. A more precise approach is to use an option pricing model, an assumption about future interest rate vol. The value of call option is added to the flat price of the bond to get option adjusted price. Okay, so how to calculate option adjusted price? Take normal price, add up the value of call option. Investor pays a lower price for callable bond if it were option free. If the bonds were non-callable, prices would have been higher. Option adjusted price is used to calculate option adjusted yield, which is nothing but YTM after adding that option price. Let's do a comprehensive example. We have a bond, face value of 1000, coupon 10%, maturity 10 years. The bond was issued at 900. It's callable at year 3 at 920, year 7 at 925. Calculate YTM, YTC, yield to worst. Okay, easy. कैसे करेंगे? It's a simple YTM calculation. Notice present value is same. 900, 900, 900. What will change is the future value. For YTM, future value is 1000. But for yield to C1, future value will become 920. For yield to C2, future value will become 925. 100 payment, N will also change, 3 year, 7 year. So we'll calculate these three, which one is lowest? This one, this becomes yield to worst. Do you want me to solve this or you will be able to do it? Huh? Okay, good. Let's say we have a callable bond. Okay, trading at 900 rupees. Face value of the bond is 1000. Maturity is 10 year. Coupon rate is 12%. Please calculate the YTM of this bond. Let's say if I told you that call price of this option is 30 rupees, please calculate option adjusted yield of the bond. I will help you with the YTM. 900 negative present value, 1000 future value, 120 as payment, 10 is N, compute IY. How much is that? 91%. Okay. How will you calculate option adjusted yield? Very simple. Add 30 rupees to 900. So 930 negative present value, 1000 future value, 120 payment, 10 N, compute IY. 13.30. That's it. Easy. Yield spread. Yield spread is a difference between your yield of a risky bond and yield of a government bond. YTM is generally made of nominal RFR and risk premium. Nominal RFR is made of inflation plus real rate. Risk premium is made of taxation, liquidity and credit risk. Then on the run we've already discussed G spread. Have we discussed? We did one example. G spread is a yield over actual or interpolated government bond yield. Just the difference, right? G spread is just 3% here, 10 minus 7. I spread, the formula is YTM of a corporate bond minus swap rate. When I'm taking swap rate, remember swap rates are generally calculated based on MRR. So I'm calculating YTM minus the MRR of sorts. Z spread, the rate that I add along the treasury curve to make the value equal to market price. That's called Z spread. Z spread is calculated using trial and error method. Then if I take Z spread and if I deduct option value from it, I get option adjusted spread. Okay. Then reading number, I don't know what is the reading number here. 8. A floating rate instrument, we know it gives you a coupon in the form of MRR plus spread. Why would someone buy a floating coupon bond? Remember, it will always have a very, very low duration. A floating coupon bond will have lowest duration. Low duration होने से क्या होता है? You are not affected by, significantly affected by changes in the interest rate. So therefore, can I say that FRNs have low interest rate risk? Yes, because interest rate risk is captured by duration. So we'll say they have relatively low interest rate risk. Now, some language you need to get comfortable with. So let me kind of build this into your notes itself. So I'll share them with you. Okay. So now focus here with FRN. Can get a little tricky. And FRN will give you a coupon which is equal to MRR plus a quoted spread. Okay. What you need to know is, you need to know that this quoted spread is inside a legal agreement and this number is fixed. This will not change. It's like coupon rate, it doesn't change, right? But the YTM of a floating coupon bond is generally calculated as MRR plus a discount margin, or also called required spread. Okay. Now, this number, discount margin or required spread, this will change. How will it change? If the credit risk of the company has gone up, the spread will go up. If the risk has gone down, the spread will go down. Okay. Now, how to know if a FRN will trade at a premium or discount? So, you want to compare this number, and in your head you want to think of this as C. And this number in your head you want to think as YTM. And if the coupon is higher, FRN will trade at a premium. If coupon is lower, FRN will trade at a discount. Okay? So let's see. Okay. This is done, this is done, this part is done. Let's do an example. Suppose we are pricing a 2-year semi-annual FRN that pays MRR plus 2%. Okay. Assume MRR is 4% and assume the yield spread required by investor is 3%. Determine the value of the floater. How will you do it? Very simple. Take coupon rate as 2-year semi-annual MRR plus 2. What is the MRR now? 4. So 4 plus 2 how much? 6. So coupon becomes 6 semi-annual. Take YTM as 2 plus 3. How much is that? Sorry, not 2 plus 5. 4 plus 3, how much is that? 7. And it's a 2-year bond. So let's do the valuation. Second clear TVM. Let's assume 100 as face value. So 100 as your FV, future value. What should be the payment? Should it be 6 or should it be 3? 6 or 3? 3. Why? Because it's semi-annual. So 3 is your payment. It's a 2-year bond, so what should be N? 4. So 4 is your N. And if I make a mistake, correct me. 7 is your IY. 3.5 is your IY. 3.5 is your IY. Compute present value. 1634. Easy? Okay. Now, this is a tricky question. Example 2, I want you to solve this. I'll wait for you. See if you can solve this one. What's your answer? केव्हा गेला? आत्ता गेला. कसं काय होतं? ऑटोमॅटिक होतं का? मे बी. Come on, this is a test of your endurance. Don't give up just yet. We have a audacious task of finishing the whole fixed income today. That will require you to be on the edge. Okay, how to do this? I'll show you how to do this. I have a simple trick for you. If you follow it, you'd be able to handle this easily. See, it's a 4-year note. It's a 4-year note on a 3-month basis. That means payment is made quarterly. That kind of makes it a little tricky. Quoted margin, which means coupon, 2.5%. The market value of the floater is 97. Calculate the discount margin assuming 3-month MRR is constant at negative 55 bips, assuming 30 by 360. So step number 1, I will figure out what is my coupon. Okay, coupon is going to be equal to minus 0.55% plus 2.5% is equal to 1.95. That's my coupon. Now for this bond, I know the coupon, I know the market value, I know the maturity. Can I figure out what is the YTM for this bond? Yes or no? Yes. So let's solve for YTM. Let's do it together. Second clear TVM. Sir, break की याद आ गई. Second clear TVM. 97 negative present value. 97 negative present value. 1.95. I'm making a mistake, correct me. 1.95 is payment divided by 4. So 1.95 divided by 4 is payment. Then 4 as n, 16 as n, और कुछ डालना रह गया, 100 as your future value. Compute IY. 0.68. But now is this IY per quarter or per year? Per quarter. So multiply this with 4. 2.74. So 2.74 is your YTM. But how is YTM calculated? It must have been calculated as MRR plus spread. So can you find out what should be the spread? 3.29%. That's your spread. So this is how you solve. If you see curriculum for this, you would be scared. If you see the formula that curriculum is used for this, it's crazy. But it's fairly easy if you learn to think like this. Did we get 3.29 as answer? Yes, good. I'll put this one in your notes as well. Okay. All right. Add-on versus discount rate. Chalo. You took loan of 5 rupees on 100 rupees of borrowing amount. If you do 5 by 100, it's called add-on rate. Bank certificate of deposit, MRR, is add-on. But if you calculate the same 5 on expiry value or face value of 105, it's called discount rate. CPs, T-bills and banker acceptances use discount rate. Okay, let's say we have a CD. It's quoted on an add-on rate of 0.12%, assuming 365 days a year. If initial amount is 20 million, what is the redemption amount? Simple. So let's do it on the TVM row just for fun. 20 million with all the zeros as present value. 20 million with all the zeros as present value. Then 0.12, which is an annual interest rate, into 90 divided by 365 into 90 divided by 365 equal to is IY. 1 is N. Compute future value. So you will get 20 million plus 5,900 extra. That's how you do it. Easy. But notice I did not keep N as that 90 by 365. I adjusted the rate. That's what you will have to do with money market instruments. In money market instruments on TVM row, your N will always be equal to 1. You choose any other N, you're doing it wrong because you're compounding. Second, after 50 days, the CD investor wants to sell that to a dealer. At that time, quoted add-on rate for 40 days is 0.06. What should be the selling price? So, ठीक है. So 0.06% कमाना है. So let's do the other way around. See, the maturity value of this CD is this 20 million plus 5,000, right? Now, I'm going to sell it, and I'm going to sell it after 50 days. मतलब अभी 40 दिन बाकी है. So let's take the present value of that final amount. So let's do it. That number, if it's already on your screen, make that future value. This number, 20,05,917.81, make this future value. Then 0.06 into 40 divided by 365. 0.06 into 40 divided by 365 is IY. 1 is N, compute present value. 4602. Okay, and calculate the add-on rate stated as a percentage rate. Okay, what is an add-on rate? So add-on rate is closing value divided by opening value minus 1. This is the rate, and then you annualize it. So, okay, we have to calculate add-on rate of how much the previous investor earned. So previous investor bought it for 20 mils, sold it for 20 mils plus 4,000. So they earned some 0.02. So they've earned roughly about 2 basis points. And then you annualize it. 2 basis point into 365 by 50. Comfortable here? Okay. So discount rate, add-on rate, this is your equation in general. CPs, T-bills will use discount rate, and CDs, repos, MRR are typically add-on rates. I think you should take a break. Because at this point I'm the only one who's learning and teaching both. We're doing good though. I think at this speed we should be able to finish. ज़्यादा नहीं बाकी है, आधा तो हो गया. Another 2 to 3 hours. 2 to 3 hours. Maximum by 11 we going home today. ठीक है? चलो. Come back in 20 minutes. Okay. Now, this is a likely question on the test. So this is my 5-star. Here you'll have to compute BEYs. BEY stands for bond equivalent yield. The convention is it's an add-on rate and it uses 365 days. So when you've been asked to compare different money market instruments and you've been asked to figure out which one is giving you better returns, you compute BEYs for each one of them. Okay, so let's see. An analyst is working at FinTree comparing following two money market instruments which offers higher expected return, assuming the credit risk are same. A 90-day CP issued by Fruity Corp quoted at discount rate of 12.12% for 360 days. Remember, this is quoting at a discount yield. A 90-day CD by Leafy Bank quoted at an add-on rate of 0.12% for a 365 days a year. Both we need to convert to annualized without compounding using 365. Okay. How would we convert this one? This is the discount yield. That 0.12 is already annualized. Unannualize. Okay. Unannualize, make changes and annualize again. Do it then. I'll give you 2 to 3 minutes to play around, otherwise then we'll do it together. See if you can solve it yourself. I'm going to solve this now. Step number 1, this 0.12 is for 360 days. What I need to do is I need to convert it to first 90 days. So please do it. 0.12 percentage into 90 divided by 360. 0.03 percentage. This is what the actual yield that I'm going to earn, but on a discount basis. Now, I have a shortcut for you, and I'll tell you how to derive the shortcut yourself for the exam. Let's assume you're taking a loan of 5 rupees, taking a loan of 100 rupees on which they are going to charge you 5 rupees. That means on maturity you would pay 105. This 5 becomes an add-on yield. Okay, what would be a discount yield? So you want to come backwards from 105 to 100. Okay, so a very easy way to convert that to a discount yield is you calculate 5 on 105. Can you please do it? 5 on 105, 4.77. So how to calculate from 5 to 4.77 discount yield? So you do 5, now you want to reduce that to a discount yield, right? So divided by 1 plus 5 percentage, try. 5 divided by 1 plus 5 percentage. 4.77. How to go from 4.77 to 5? So 4.77, you want to increase it, right? So 1 minus 4.77 percentage. So try it. 4.77 divided by 1 minus 4.77 percentage. How much is that? 5. Okay. Right now, which yield do we have? We have a discount yield. Discount yield means we have 4.77. We want to convert that to add-on yield. So what will we do? 0.03, right, divided by 1 minus 0.03 percentage. 0.03 divided by, bracket open, 1 minus 0.03 percentage, bracket close, equal to. That would be slightly more than 0.03. How much? 0.00. Okay, जो भी है, multiplied with 360 by 90. Sorry, 365 by 90. Multiplied with 365 divided by 90 into 100. So that 12 point. So 0.1217 percentage is a comparable BEY. How about this one? This one is 0.12%. It's already an add-on yield, but right now it's okay. It's already on 365 days, so I don't need to do anything. So 0.12 percentage. Which one is better? This one. So we take this one. So 0.1217. We compare and we're done. Okay. Can you quickly compare? Let's practice a little bit. Add-on and discount. Okay. Let's assume for 90 days so that there's no confusion. Let's say discount yield is 10%. Please convert to add-on. So step number 1, convert 10% to 90 days. Okay. Assume 365 days. Okay. So 10% into 90 divided by 365. This is your numerator. How much is that? So क्या करो ना, ऐसे करो, 10 into 90 divided by 365. Ignore percentage for a minute. How much is that? 2.465. Okay. Now, what do you want to do? Which one is higher, add-on or discount? Add-on. So you want to increase it, right? So this 2.465, you want to divide with 1 minus 2.465. So whenever I'll divide with a number less than 1, it will go up. So do this then. 2.465 divided by, bracket open, 1 minus 2.465 percentage, bracket close, equal to 2.528. Now annualize it. So into 365 divided by 90. 10.25 percentage. Okay. Please convert 11% yield to a discount yield. So how will you do it? Step number 1, adjust for time period. So 11%, so just 11 on the screen, 11 multiplied with 90 by 365. 11 multiplied with 90 by 365. How much is that? 2.7 something. Okay, so you have 2.7 now. Now you want to go from add-on to discount, want to increase it or decrease it? Decrease it. So this 2.7, decimal bolo aage? 712. Okay. So 2.712 divided by 1 plus 2.712 percentage. 2.64 into 365 divided by 90. 10.70. Are you getting comfortable with this? Let's say this is 15%. Convert to add-on. So what will you do? 15 multiplied with 90 by 365. Then that's your numerator. Now discount to add-on, increase or decrease? कैसे याद रखना है मैं बताता हूँ. When 100 rupees become 105, here you calculate 5 on 105, here you calculate 5 on 100. Which one will be higher? 5 on 100, no? Because base chota hai, so add-on will be higher, discount would be smaller. So you want to reduce. So once you've done, chalo साथ में 15 into 90 divided by 365. How much? 3.61. Okay, गुस्सा मत करो. 3.698 divided by 1 minus 3.698 percentage. Make sure you're opening bracket. Into 365 divided by 90. Annualize it. 5? 7. Do you think you can do it? So don't memorize, just apply this logic. Just ask yourself, do I want to increase or decrease? If I want to increase, 1 minus the rate. If I want to decrease, denominator mein 1 plus the rate. That's it. Okay. Now, we have a question where we have 4 rates. We want to convert all of them to BY. Out of 4, I'll help you with 1, which is the last one. It's an add-on yield. It's 365. It's 4.45. You do the remaining 3. Easier way to remember is discount is anyways discounted, so it's lower. Something on discount. Add-on is add-on, so it should be higher. So 4.33 into कितने दिनों का ये? Sorry, 180 days. So 4.33 into 180 divided by 360. 2.165 divided by 1 minus 2.165 percentage. (2.1212) into 365 divided by 90. Sorry, into 365 divided by 180. 4.48. 1 is done. 2 more 2. 4.48 na? Okay. So 1 is done. Let's do this one. 4.36 into 180 divided by 365. 4.36 into 180 divided by 365. How much? 2.15. 5 what? 0. Divided by 1 minus 2.15 percentage. Into 365 divided by 180. 4.45. Now this one is already add-on. So all that you need to do is 4.35 into 365 divided by 360. 4.41 and 4.45. Which one is highest? 4.48. So 4.48, 4.45, 4.41 and 4.45 as it is. That's it. Easy? Okay, moving forward. What is on the screen? Online, give me an eye pass if you got this right. What is on the screen here? Yield curve. Upward sloping or normal yield curve. Then how to calculate bond price using spot rate? Do you know? Yes, good. What is a par rate? Do you know? Remember this formula? It's 1 minus Z4 divided by Z1, 2, 3, 4. How to calculate forward rates? Do you know? Good. अच्छा लग रहा है ना अभी? हाँ, it's शायद उम्मीद बन रहा है. Maybe we'll be able to go home. Of course, before I ask, your answer is yes, no? How to value the bond using forward rates? Yes? Then do it then. Do this one. Use a shortcut we learned today. Hundred, 1100. 1.15 into 1.12 into 1.08 into 1.06. 1.12 into 1.08 into 1.06. 1.08 into 1.06. 1.06. 1100. Do this with me. 1100 divided by 1.15. 1100 divided by 1.15 plus 100 divided by 1.12 plus 100 divided by 1.08 plus 100 divided by 1.06. 1005.69. आंसर क्या है इसका? 1005. Good. Then relationship between spot curve, forward curve, par curve. Next reading. When I invest into a bond, I earn through coupon and principal, reinvestment of coupon, and I earn through capital gains. YTM assumes all the cash flows are reinvested at YTM. Horizon yield is nothing but IRR assuming a actual reinvestment rate. That's called horizon yield. Now, typically my yield will be affected by two risks. One is the price risk, one is the reinvestment risk. Correct? But I can set off price risk and reinvestment risk if my holding period is equal to Macaulay's duration. If my holding period is more than Macaulay's duration, that means in my graph I'm in the river area, I have negative duration gap. Dominant risk is reinvestment risk, and what should be beneficial to me? Rates going up. What is the risk? Rates going down. If my holding period is same as Macaulay's duration, if holding period is same as Macaulay's duration, then price risk, reinvestment risk will offset each other, and therefore I don't worry too much about changes in the rate. If my holding period is lower, that means I'm in the Pahad region, my duration gap is positive, dominant risk is price risk. I will benefit if the rates have gone down, but if the rates have gone up, then risk. Easy? Same calculations, but I'll skip these calculations. Okay. Macaulay's duration, correct way to calculate, the one we learned is an approximation method. Correct way to actually do it is the weighted average of the time to receive the cash flow. Okay. For example, if this is a bond, these are the cash flows, this is the present value, I can actually compute the weights. How will I compute the weights? 92.87 as a ratio to 1158. And then I will multiply weights with the time to do a weighted average, add them up, gives me Macaulay's duration. But a shortcut to do it is modified duration into 1 plus YTM by N. Next reading. Sources of return from the bond, coupon, reinvestment, capital gains. Modified duration, Macaulay's duration, क्या किया है हमारे spelling ने यहाँ पे? Let me send it to content. I'm sure by the time my team reached here, they must have also been tired. Sorry, just 1 minute, I have to send right away. This thing you need to know, by the way, if it's a zero coupon bond of 10 years, okay, it will have Macaulay's duration of 10 years. For a zero coupon bond, Macaulay's duration is same as maturity. For a coupon bond, Macaulay's duration is a little lower. Did you listen to what I said? Yes. If it's a 7-year zero coupon bond, what would be Macaulay's duration? 7 years. If it's a 7-year coupon bond, what would be Macaulay's duration? Less than 7 years. Okay, thank you, you're listening. Then your modified duration formula, you know, callable bond, this is a shape, correct? Putable bond, this is a shape. Money duration, we know. PVBP, we do know. Then this formula I didn't cover, I should have covered earlier, I forgot. Maybe you should write down. If you want to calculate the duration of a perpetual bond, okay, the formula that we use is 1 plus R divided by R. This is how you get duration of a perpetual bond. Bond means a bond which has an infinity. If you forget this formula on the exam, what you do is calculate the duration using the same technique, keep maturity as 1000 years, any large number, it will get you the same answer. So you can always brute force your way in case if you forget the formula. Okay, how would you calculate Macaulay's duration of a floating coupon bond? Okay, so you calculate time to the next reset as a ratio to total time in the reset. For example, if it's a 180-day coupon and 57 days have already gone from the previous coupon, how many days left? 180 minus 57, that as a ratio to 180, just proportionate calculation, that is your duration. Easy? Next reading. So, I'll tell you this nonsense, right? This, why call it like that? This syllabus they changed 2-3 years ago. Earlier in fixed income, they had 7-8 readings. When they changed the syllabus, the same 8 readings they converted to 19 readings. Why? Because their rationale was that you should be able to finish 1 LM per evening. That was their rationale, that you should be able to finish 1 LM per evening. But I don't know if that really works. I mean, there are some readings which are still so large. For example, your income statement in FRA will take you probably the whole week, right, just to master those EPS calculations. Nevertheless, convexity formula we know. Then change in the price of the bond is minus duration into delta y, okay, into delta y plus half into convexity into delta y square. Now the way we calculated money duration, we can also calculate the money convexity. Works exactly the same way. Then how do you calculate duration of a portfolio? Okay, for all practical purpose, just know duration of a portfolio is simply the weighted average. Then same stuff, comparing holding period with Macaulay's duration. This thing repeats again. Next reading. This is called curve-based and empirical fixed income measure. Now here we just have to learn one concept on empirical duration, otherwise it's repetition. when do you calculate effective duration and effective convexity? When you're dealing with a bond where cash flows are uncertain. No, cash flows are uncertain. Regular duration when cash flows are certain, but effective when cash flows are uncertain. When are they uncertain? When you have a callable or puttable bond, that time the cash flows are uncertain. So remember this for the exam. A regular bond use modified duration, but a callable bond use effective duration. Now the good news is effective duration calculation formula is exactly the same. V minus minus V plus divided by 2, same, nothing changes except one difference. No, yield curve for theory. In the denominator, instead of delta y, we write delta curve. Okay, that's for theory, but for practice, that V minus and V plus you cannot calculate on TVM row. For a callable bond, you cannot value the bond on the TVM row. Then how do you value a callable bond? We will learn in level 2. Callable bonds are valued using binomial trees. We have to build interest rate trees. Level 2, we have 2 readings dedicated to this. Very beautiful. You'd love those readings when you learn the math, you'd really have great time with it. But till then, on level 1, V minus is given, V0 is given, V plus is given. All that you need to do is save them in your first, second, third memory slot and then apply the same formula, job done. Is it okay? Now, is call risk same as the repayment risk, which is same as the reinvestment risk, or which leads to reinvestment risk? Okay. When you take a housing loan, and let's assume you take a 20-year housing loan. In fact, I'll digress a little bit. Something interesting I learned yesterday. Yesterday I took some NISM exams. We are applying for some SEBI licenses that I had to take that exam. It was called RI. तो मैं तो ऐसे ही मुँह उठा के चला गया ओवर कॉन्फिडेंस में. थॉट ओके मैनेज कर लेंगे. But there were a lot of things that I didn't know when I was solving this, so I had to do a lot of guesswork. I mean, fortunately I managed to pass. But there was one question that came where they had given a client. That client, वो पढ़ते I was feeling bad for that client in that case study. That lady had so many loans. She was a single mother. She had 2-3 credit card loans, car loans, one housing loan, second housing loan. वो पढ़ के stress आ रहा था. And then she gets, and then someone dies and she gets inheritance. So when I read the case study, I was like, wow. Thank God someone died. But inheritance, how much? 1 lakh rupee. So now using that 1 lakh, she had to repay the loan. Okay. And the question said, use avalanche technique to repay the loan. Now I'm sitting in the paper and thinking, what could be avalanche technique to repay the loan? So I said, forget, I don't care about the avalanche. I'll do simple finance logic. The one where interest rates is higher is a loan that you are supposed to repay. So there was some TVM adjustment you had to do where one rate was given monthly, one was annual, so you compound it by raised to 12. So you figure out which interest rates is higher, you pay them in sequence. So I said, okay, fine, maybe I did it okay. Then I went to the next question. Now the question would be, now repay the loan but use blizzard technique. So I had no idea what blizzard technique of loan is. But then I looked at the option, and in those options, the first 2 options were repaying some housing loan, which were like 70-80 lakhs, which was not possible. The remaining 2 options, she was paying credit card loans first. Sorry, car loan first, and then credit card. So then I chose the one that I thought was logical. Then after the exam, I Googled and found out what blizzard is. So apparently blizzard technique is, when you have too many loans, you don't want to repay the loan logically, you want to repay the lowest amount outstanding first, so you get that psychological satisfaction that I am on the path to repayment, so that you would be encouraged to repay the other loan. That technique is called blizzard technique. I mean, I got lucky. So now here, when you take a loan, any point of time you can repay the loan, right? If you can repay the loan, think from a bank perspective, it's a risk because suddenly they get money back, right? And it's nothing but a call risk if you think about it, because bank is the bond investor for a loan given to you, and you are the issuer of that loan. And at any point of time you say loan nahi chahiye, please take the money and cancel the loan or give the loan document back to us. That's nothing but you calling back the loan. So repayment in a housing loan is same as callability in a bond structure. Is that making sense? And when will you repay the loan? Okay, logically, let's assume you took a loan at 10%, and suddenly after that interest rates have become 2%. Is it hurting you to pay at 10%? Yes. So you will take a new loan at 2% and repay the loan, which means bank will get money back when the interest rates are 2%. So now bank has to reinvest at the lower rate. So therefore, both of these call risk as well as reinvestment risk, they create call risk as well as repayment risk. They create what type of risk? Reinvestment risk. And you get money at the worst time when the rates have already fallen significantly. Okay. Then you know that what do you say? Convexity formula. When I have a callable bond, that convexity formula will give you answer of something like -40. Okay, because obviously we discussed earlier, callable bonds will have negative convexity. Okay, but puttable bond will not give you a -30. Puttable bonds don't have negative convexity. They will have a small positive convexity or 0, but they will not have a negative convexity. Okay, let's try this one. Current price of the bond is this much. When government par curve is raised and lowered by 25 bips, the new full price for callable bond are 990 or 1028 respectively. Please calculate effective duration and please calculate effective convexity. What do you need to do? Just save the numbers in memory slot and replicate the same formula RCL1 minus RCL3. How much are you getting? 7.6014. And convexity? Negative? Okay, that's it. मिसप्रिंट है? अच्छा, क्या एक्सपर्ट बन गया लड़के, गलतियां ढूंढ रहे हैं. थैंक यू सर. जूस नोट्स में स्टेप 2 इज रॉन्ग. समवन ऑन यूट्यूब. थैंक यू. थैंक यू. ऑलराइट. Percentage price change using convexity, same formula. I'm skipping through this now. Duration into delta y, half convexity into delta y square. Okay. Key rate duration. This is a new concept. We have to spend a little bit of time here. Okay, because if there's a theory question, I want you to be able to handle this. So, when I tell you that modified duration of a bond or effective duration of a bond is 5. Okay, what does it mean? It means 1% change in interest rate will result in 5% change in bond price. Correct? Do you agree on this interpretation? Now 1% change in interest rate, my counter question, which interest rate? YTM. But which YTM? 1 year YTM, 2 year YTM, 3 year YTM. All the YTMs. Which means when I'm using duration, it assumes that if my yield curve before was like this, and if interest rates are going to increase by 1%, the yield curve after will be like this. All the interest rates will increase by 1%. So a duration as a concept, whenever I'm dealing with it, it assumes something called as a parallel shift of the yield curve. It assumes that all the yield curves, all the interest rates will increase by 1%. But what if a scenario where my yield curve before is like this, and now my yield curve changes, and my yield curve after is like this. Is it parallel? No. This change in the yield curve is referred to as non-parallel, and in this situation duration does not do a good job. This is called as a non-parallel change in the yield curve. Okay. This is also referred to as, one word for your exam, in fact it's 2 words. It's called shaping risk. Risk that the shape of the yield curve will change. Risk that yield curve will have a non-parallel movement. Is that okay? So then what is the solution? How do I measure my risk? How do I measure my risk in this environment? Then I have to do that key rate duration. What's a key rate duration? So I'll try and simplify. You don't have to compute, you just have to interpret. If this is my old yield curve, okay, what we assume is, what if only one maturity interest rate changed, okay, and my new yield curve became like this, which means only one rate changed, keeping everything else constant. So the way we handle this is, let's assume I take key rates, okay. Key rates simply means key maturity. What are the key maturities? Key maturities are captured from here. Key means important. So where do you take important maturities? For those maturities for which US government issues bonds. All these maturities are called key maturities. Okay. Now important one for us, 1 year, 2 year, 3 year. Notice what's not there. 4th year, we have 5th. Then what's not there? 6th, the 7th. Then we don't have 8th, 9th, we have 10th. Then after that we have directly 20 and then 30. These are called key rates. Key matlab important. Okay. So what I will do is, I will calculate, let's assume I have a 10-year bond. So I will say, okay, 1 year is important, 2 year is important, 3 year is important, then 5 year, then 7th year, and then 10th year. For each of the bond, I will calculate a KRD, key rate duration. Okay, and I'm just going to make up some random number here. So 0.5, 0.7, and 1.3 are its, and then this is 2. Sorry, this is 2.5, so, and this is 4. So this will be 7, 11. Can you please take a total? 1.2, 1.5, 2.5, 4.5, 7, 11. Okay, so this is 11. Now, this 11 is nothing but your effective duration. The total of key rate duration is your effective duration. What does it mean? It means if all the rates change by 1%, then the bond price will change by, bolo na yaar. If all the rates change by 1%, bond price will change by 11%. But what if only third year rate changes by 1% and other rates change by nothing? What if only 1 year rate changes, other rates do not change? This is called now a shaping risk, right? In that case, now I know bond price will change by 1.3%. Matlab wo key rate duration is nothing but subcomponent of your total duration. So only one maturity rate change, nothing changes, then the bond price will change by 1.3%. What if, on the exam, the question you would get is, what if 1 year rate changes by 1%, 2 year rate change by 1%, 3 year rate change by 2%, and the others do not change? Then what will be the change on bond price? So you will say, okay, 0.5% into 1% is 0.5%, 0.7 into 1 is 0.7%, and this is 2.6%. So change in the bond price will be 3.8%. आ गया समझ में? Key rate duration breaks down the yield curve risk into smaller key rates. Key rates means important rates. Where are these key dates taken from? The maturities for which US government issues bonds. Look at this. What if you get a question like this? I want you to solve. These are your key rate duration and these are your expected changes in the yield curve. Now be a little careful here, because in some cases the yields are decreasing, in some cases yields are increasing. Okay, so handle that carefully. See, show me if you can do it. So the way to solve this, chalo, everyone, do this with me. 0.25 into 0.4 percentage. 0.25 into 0.4 percentage. Now both of them are negative, so multiplication will become positive, STO1. 1.5 into 0.6 percentage. 1.5 into 0.6 percentage, STO2. Now this is also negative, negative. Why negative? Because formula is minus duration into delta y. So negative, negative, this is positive, STO2. 4.2 into 1.2 percentage, make this negative now, STO3. 7.5 into 2 percentage, negative, STO4, and add up the 4. 19.04 negative. Understood how to use it? All right. All right. Now this piece, last piece here, थोड़ा सा technical है. There can be calculation question or mostly a theoretical question on this. So I want you to look at this concept carefully. Now, after teaching all of it, now curriculum find flaws in the whole duration concept. And it says that this duration doesn't work. Okay, so instead we can use a different duration. Which duration? Empirical duration. Now how to calculate empirical duration? You don't need RCL1, RCL2. It is yesterday interest rate changed by 1%, yesterday bond price changed by 4%, therefore duration must have been 4. This is called empirical duration. That means observing actual data, empirical data to figure out what the duration is. Okay. Now, this duration might be higher or lower than the effective duration. Why? And what differences? That's the theory we want to learn. Approach taken so far, which is duration convexity using mathematical formula. These are called analytical durations. Or these are called analytical metrics. Anything that you do with a formula, we call them analytical. Now, estimate of impact of benchmark yield changes on bond price using analytical duration. Implicitly assume, okay, I hope you're listening, that government bond yield and spreads on the bonds are independent variable and are not correlated. So here's your theory question 1. Under analytical duration approach, what is the implied correlation between spread and government yield? And the answer is 0. One more time. If I'm using analytical duration means which one? Formula. Then, what is the relationship it assumes between spread and government rates? 0. Empirical duration. It measures duration using historical data, incorporating factors affecting bond prices and the price-yield relationship. Statistical estimate that accounts for correlation between yield spread and benchmark yield changes under different economic scenarios. Okay. During the crisis period, if we are currently in crisis, think of 2008. In the crisis period, what will government do? Government will reduce the interest rate. But if we are under crisis, what will happen to the spreads of companies? The spreads of the companies will go up. That means if you notice, there is a negative correlation between the two. Yes or no? In situation for a government bond with little or no credit risk, we would expect analytical and empirical duration to be similar. Why? Because government bonds don't have spreads. correct? Because yield changes largely drive bond prices. But for corporate bonds, credit spreads and benchmark yield are negatively correlated. Under this scenario, wider credit spreads will partially or fully offset the decline in government yield, resulting in lower empirical duration, which means in most of the situation, empirical durations will be lower than analytical duration. Maybe this part you did not understand, so I will make one more attempt to explain. I want you to focus. It's not difficult. Let us say we have bond of HDFC Bank, HDFC bond. Now the YTM on this bond right now is 13%. The analytical duration of this bond is 5. So which means it is telling me that if YTM of HDFC bond goes up by 1%, bond price will decrease by 5%. Okay. Now this YTM is actually made of two parts. One is the nominal RFR and other one is the spread. Nominal RFR is also called benchmark yield in this discussion. Okay. So let's assume that this is 10% and this is 3%. Now, when you use analytical duration, generally when we say interest rates have gone up or gone down, we are referring to benchmark yield. So let's say this decreased by 1%. YTM will become how much? 12%. Now YTM changed by 1%, duration 5. But in practice what happens is, when this decreased by 1%, when government reduce the rate, there is a possibility that spread will increase by maybe 0.5%. Okay. So technically the YTM will not change by 1%, YTM will change by 0.5%. So your analytical duration is not capturing the fact that when the government rate changes, the spread can also change. Therefore, the actual change in the YTM is a little lower than what 1% suggests. Therefore, empirical durations are lower than analytical durations. Did you understand this? Okay, I hope so. Now we go to credit risk. The core component in credit risk is that your expected loss is calculated as probability of default into loss given default. Okay. Now it's a very simple concept. Imagine all of you come to me and you say, Utkarsh, 100 rupees ka loan chahiye. I want 100 rupee loan. Now let's assume there are 100 people here. Now I estimate that each one of you has a probability of default of 5%. And when you default, doesn't mean I will lose all my 100 rupees because I have Vasuli bhai. So I will come and try to recover something. So let's say out of 100 rupees, I will be able to easily recover 80 rupees. So then my loss given default is how much? 20 rupees. Okay. So 20 rupees of loss given default and probability of default of 5%, expected loss is 1 rupee or 1%. So what I'll do is, on the loan that I've given you, I expect to earn a 5% interest. Okay, that's my normal expectation. But I will charge 1% more on that, this 1%. So I'll give you a loan at what rate? 6%. Which basically means PD into LGD is nothing but an estimate of credit spread. इसको अपने दिमाग में डाल दो. And this will come in extremely handy in level 2. Level 2 have a very, very complex mathematical topic on credit risk, where I will teach you the whole topic, and that day if you remember what I said today, at the end of the topic I'll show you a shortcut to solve everything with this formula. PD into LGD. Okay. So probability of default 5%, loss given default 20%, expected loss 1%. This expected loss I'm going to price into my product. So if I want to earn 5, I will charge you 6. Why is that? So if one of you at 5%, 5 of you will default. Correct? But I will still be able to recover 80%. So my net loss will be that 5 rupees that I have anyways collected from you, all of you in advance. Therefore, banks will charge a higher interest rate to riskier borrowers. Why? Because their probability of default is higher. Therefore, unsecured loans are expensive than secured loans, because with unsecured loans, loss given default is higher. Have you understood this? Okay. On the exam, they might not give you LGD, they might give you recovery rate. Let's say recovery rate 80%, but you know that if recovery is 80%, LGD is 20%. Now this PD typically is determined based on the credit rating. Okay. Historically, if your credit rating is investment grade, the probability that you will default is less than 1%. So probability of default is very low for investment grade, but higher for non-investment grades. Loss given default at times is also called loss severity, same concept. Okay. Now this nonsense of the C's of credit analysis. School के बच्चे हैं क्या है कि are they making it easy for us to remember all the C's? Country. I mean, I don't know what they think of CFA students, right? It's country, condition, currency, collateral, covenants, character, capital, capacity. These are called top-down factors because you're looking at from a big picture perspective. See, for example, India's rating is BBB. Okay. Now, which is India's best company? Largest company, Reliance. Reliance can never have a rating than the rating of India. I mean, for example, if I am in the international market, if my country's rating is BBB, then my rating cannot be better than BBB. Are you getting it? So, it's a natural limit to all the companies in India now, in the global market, that are rating are restricted by this. When you want to evaluate individual company, you look at these parameters. This is the most important parameter, at least in India. What is that? Character. Because at times in India we have defaults because people don't have money. And at times we have defaults because people don't want to give money. I told you that UP example in some class, no? In a political rally they had election, so that Neta went and said, give me votes, I will waive off all your loans. Now people, I don't know if they gave votes or not, but they took it on themselves to waive off their own loans. So the whole town collectively decided we will not repay the loan. So that's your character, and we have a lot of those characters here. Then corporates, how will corporates pay through business? Then how will governments pay? Taxes. Then these are your components, the same graph. Honestly, it's just this formula. Your LGD into POD. POD is PD, probability of default, and this is your loss given default. Then risk of relying on ratings. What is the risk of relying on ratings? Number one, ratings change over time. Then rating agencies cannot always judge credit risk accurately. Then specific risk for a company are difficult to predict, incorporate into ratings. For example, fire, right? Very difficult to capture. And credit rating lags market pricing. Market ko pehle pata chalta hai, then the rating agencies will adjust. One more point, credit ratings can be bought. Or rating agencies are corrupt. And they are corrupt, by the way. Look at 2008 crisis. I wonder kind of a world we live in where we still allow them to operate without significant regulations. Then what affects your spread? Macroeconomic variables, market factors, issuer specific factors. Spread means at what rate, how much extra do I need to pay? So that is a function of what is the economic variable in India right now, how is the credit market, and what is the company specific factors. How will you evaluate credit for the governments? Government of India, Government of Maharashtra. Some of the, have you heard of Bimaru states in India? No? Bimaru literally means sick in Hindi. So it is basically Bihar, Madhya Pradesh, and it's basically an acronym. Now these Bimaru states in India, they are actually over leveraged. That means they have taken too much of debt, and therefore if they do not get support from the central government, the states will default. So how do you evaluate a state, right? Or how do you evaluate a country? So you look at, I mean, none of this makes sense in Trump environment, but you look at the quality of institutions. Now you look at rule of law. What kind of rule of law today? Right? It's not rule of law because he does not like the lady. He did not like the lady who was in charge of statistics because she was not calculating inflation numbers that he liked, so he fired her. Right? So now in US today the problem is no one is trusting the data that's coming out through the official government channel. Then fiscal flexibility is how strict your government is with usage of fiscal budget deficits. Okay. Now, generally what you want is you want to keep that number around 2 to 4% per annum in such a way that your debt does not increase very long. I mean, does not go up. But now we have some of the countries which have debt have gone up. How effective is your monetary policy? Economic flexibility. Can you diversify your economy across the asset classes? Some economies are very concentrated in one or two industries. I told you about oil example, right? And finally, do you have foreign currency? Do you have a geopolitical risk? And all of it. All of this component. Then sovereign immunity, under which investors face limitation, forcing a sovereign government to declare bankruptcy. Do you know there are some international courts where there were a lot of cases happening of Venezuela with US anyways, even before Trump came in, because Venezuela had defaulted on multiple payments before, right? And a lot of Latin American countries. So unko court leke jata hai, because what will you do? Can you force a country to declare bankruptcy if they're not paying you? Or can you say, okay, I will come and take your assets, which by the way he is doing now, but right? Can you force them to say that I will take your assets? Then quantitative factors, look at fiscal strength. A very useful number you want to look at is debt to GDP. Now, since I want to get your attention, I'll show you some data. So let's make a list of okay, I think trading economics will be more updated. All right, and let's look at the debt to GDP of the highest value. Sudan, okay. Japan, what is the debt to GDP ratio? 237, that's insane, right? Generally, US is reaching around 130, 140, we are complaining so much. Japan crossed that in 1990s itself. You know, वो तो कर चुके हैं, दादाजी है. And Japan had the same thing. I mean, Japanese market was the fastest growing market in the world at one stage. And then I think in 80s there was a reversal where deflation came into Japan, and since then everything changed, right? There was a crash, and after that it went really slow. Then Singapore at 173. So look at this, it's crazy, right? US is not very far. US is now about 130 something. How much is India? We are moderate. Let's see how much is India now. 81. I think we are a little more than that. Now, every year you create a fiscal deficit of 3-4%. You know? Fiscal deficit means I'm earning 100, I'm spending 104. So every year that 4 rupees is adding to my loan. But every year GDP is also increasing by 4. So if your fiscal deficit is at par with GDP growth, your debt to GDP ratio remains constant. If your fiscal deficit is growing faster than the GDP growth, your debt to GDP starts growing. If your fiscal deficit is lower than the GDP growth, then debt GDP will compress. The lowest in the world, let's see which ones. I'm very curious to see which ones are lowest. Okay, Brunei. Have you heard of this country? It's near Singapore. It's actually one of the nicer places in the world to work if you are in the oil and gas industry, because it's a kingdom. There is a king of Brunei, And you can go and read their stories. It's insane the kind of, he has a mansion and some 300, 400 cars or whatnot, right? But geographical vicinity is closer to Singapore, not Middle East, so the weather is good and the pays are insanely good. So therefore, a lot of people in oil and gas industry, for them, dream destination is Brunei. Kuwait, 3%. Cayman Islands is here. Good. How come Afghanistan is here? I don't know. Hong Kong is here. Burundi, Haiti, Switzerland is here. Okay. These guys, do you know this country, Swaziland? It's a landlocked country inside South Africa. But a couple of years back, they changed the name. Do you know why? You would not believe why they changed the name. Because people were confusing their name with Switzerland. So they decided, and I've been to that country. I was driving through Africa, so I crossed through that region. It's a fairly, like, what do you say, underdeveloped of sorts, right? And of course, but they decided we don't want this name anymore. So now they have some other names. Okay, anyways, now back to business. Economic growth, stability of the country, external stability. So balance of payment, your currency reserves are very important. You want to look at India's currency reserves. We are 500 billion plus, which is probably one of the highest we've been. Now 700 bills, right? That's sizable. Which means this is the amount of foreign currency that government of India has. They need that because we need to buy oil, right? So back in the day, one big challenge in India was we didn't have oil, but we need to get oil. But we did not have foreign currency. So every now and then, हमको IMF के पास जाके भीख मांगना पड़ता था, right? We'll go to IMF and we'll beg, and therefore it was extremely difficult in India to import anything. You had to import, you had to take a permission from the government, right? And it was strange. The government was very strict. I mean, you wanted to, if you read Chitale's story, you know Chitale is in Pune, right? Chitale is a big brand now, Bakurbadi. That gentleman wanted to buy that rolling machine from Switzerland and Germany back in 1980s because he wanted to make the best Bakurbadi. Okay, but they went to the government. They said, we want foreign currency. Government said no. And then they had to do a lot of begging and lobbying to eventually get approval. But you know what government was okay allowing that time? Import of French cosmetics. Why? Because certain politician would not use Indian cosmetics. You can guess who. So for her, it was okay to spend foreign currency in importing cosmetics. Again, I don't want to get political, but just a factoid you should know. All right. Some ratios we look at: debt to GDP. Then we also look at interest payment to GDP. We look at debt to revenue, interest to revenue. Now tell me, this number, do you want higher or lower? Lower the better. How about this number? Lower. How about this number? Think about it. Lower the better, because that is in the numerator. How about this number? Lower the better. Then GDP growth is change in GDP as a ratio to base value. We generally compute GDP in real terms, purchasing power terms. Per capita GDP is GDP divided by population. How much is ours? About $3,000. How much is Switzerland? $100,000. Somewhere that. How much is US? $80,000-$90,000. You see this, you realize hum garib hai. You should see this chart to understand. Forget this, even Thailand and some of the Southeast countries are better than us. GDP per capita list world. Okay. US, no, this is not per capita. Okay, some of these countries, look at this number, it's crazy. Ireland is 129. You know, Ireland has a high per capita GDP, but the country is poor. You know, because of whom? Apple. So what's happening in Ireland now is Apple shifted their headquarters there because of tax benefit. Apple is making crazy money, but Apple is not paying anything to the government. So GDP is going up, but sab log garib hai, right? Switzerland, of course, with Swiss banking, Singapore 94, Norway. I believe these guys are like true rich in the world. And they're also very civilized, right? Sweden, like Scandinavian folks. US 89, India, India will be somewhere here. Yeah, 2818. Who's better than India? Egypt, Ghana, Uzbekistan, Venezuela. Of course, Bhutan is much more better than us. Philippines, Sri Lanka, Djibouti, Bolivia, Vietnam. बस वही देखना है आपको नहीं. आई थिंक वो नीचे होगा. नहीं, ऊपर ही है. काफी ऊपर है. Okay, enough now. Then non-sovereign risk. What if you're buying bonds issued by municipal corporation, state government, agencies, IMF, World Bank? Then you have to kind of look at, their financial ability to repay. Two types of bonds, GO bonds and RO bonds. We've discussed this multiple times. General obligation means pay from taxes. Revenue obligation means pay from revenues of a specific project. Okay. How do you analyze corporate issuers? Next reading. Come on, let's pick up some speed. Evaluate corporate governance, business model, business risk. When you do this, you're as good as equity research analyst in credit rating, but focus less on the upside, more on ability to repay the cash flows. Top-down approach, bottom-up approach, a hybrid approach will use both. Some of the ratios: EBIT margin, interest coverage ratio, debt to EBITDA ratio, then your retained cash flow to net debt ratio. Now here we have some technical stuff, so I want you to first, I'm going to give this. I'll give it a few stars. First lien has the highest seniority because you have a direct right on one particular asset. Then you have senior, secured, junior, secured debt. So secured debt will be at the top. Then after that you will have senior, unsecured. Then you will have the three subordinated bonds here at the bottom: senior, subordinate and junior. Remember, junior are even below subordinated debt. On the exam you might get a question on sequence of this. So easier way to remember: first lien at the top, then secured, then unsecured, and then subordinated, and the lowest is junior subordinated. Then pari passu, remember this word, it means equal, all on same level. When is pari passu useful? If I have already taken a loan and I am taking a second loan, my second lender will insist that you give me at least pari passu with the previous loan. Otherwise then they will have a second hierarchy. Okay, now issue credit rating and issuer credit ratings. Okay, I'll show you what this is. Think of Reliance Industry. Now Reliance Industry has a senior secured bond, then they have a subordinated secured bond, then they have a senior unsecured bond, and then they have a let's say a junior unsecured bond. Okay. Now the credit rating is this is double A, this is A, this is triple B, and maybe this is double B. So one company can have multiple bonds, and each of the bond can have different credit rating. These are called issue ratings. Okay, but which one of these rating is the rating of Reliance? If I have to find one rating, which we will call as issuer rating, which one will this be? Senior secured? Senior unsecured. That's correct. The rating of the issuer will be triple B here. Okay. Why? Because this rating reflects ability of the firm to generate cash flows and pay, not the ability of the assets to repay. When it's an unsecured loan, there is no collateral. So rating is purely a function of my ability to generate cash flows. Therefore, senior unsecured rating is considered as the rating of the issuer. And individual issues can be either higher or lower. This process they call as notching. Okay. So assigning different rating to different bonds of the issuer. Then this concept you should know, structural subordination. What does this mean? If I am a holding company, let's call it holdco. If I have a subsidiary company, okay, this company is the operating company. This company is the investor company. Who do you think will have superior rating? The holding company or the subsidiary company? Subsidiary company. That's correct. This will have typically a better rating. Why is that? Because the cash is generated here, right? How will the cash go from here to here? Only if the company decides to pay dividend. Therefore, the ratings are better closer to places of business. So if my business is happening in subsidiary, this rating will be better than the holding company rating. Okay. Now we are in the last reading, 2 or 3? 3 readings. Want to take a break before I start? छोटा ले लो. 10 minutes is okay? Okay. Come back in 10 minutes. We'll finish all 3 in 1 hour. Come back in 10 minutes time. सबके लिए होता है, बट उसके लिए ज़्यादा यूजफुल है. नहीं, मॉडिफाइड भी हो सकता है. अभी लगा है तो चलेगा. Chalo, settle down. We'll start in some time. 2 minutes to start. What is the what is the longest duration class you've ever attended? 12 hours. FRA. You must have done CA classes, no? 12 hours every day. 12 hours of classes every day for 7 days a week. Which course was that? CA. Inter. And was it one teacher or
Around 2 to 3 subjects.
different teachers? At least you get to see new faces.
We had to beg to have breakfast, like 10 minutes de do khana khane ko. So you wouldn't get that also.
How about rest of you non-CA folks? CA लोग थोड़े अजीब ही होते हैं नहीं? That's why I never hung out with CA friends. I always stayed 10 feet away. दूर ही रहे. How about you folks? 10 hours. Where? स्कूल में 12th में इधर 10th में 10th में होते हैं इतने लंबे क्लासेस 8-10 घंटे के.
हमारा क्वेश्चन कंप्लीट नहीं हुआ था. हमारे ट्यूशन टीचर ने क्रैश कोर्स दिया था. सुबह से 7 बजे पूरा एक दिन का पोर्शन.
10th का पोर्शन एक दिन में. ये आपके एक ही क्लास में थे क्या? Are there any tuitions for 11th and 12th? Do people take tuitions for that? Yeah? No, science, yes. Science I can understand, you need to prepare for JEE, you need good teachers there. But 11th, 12th commerce, people take tuitions?
Some people join.
Yeah, okay, foundation is also fine, understand. But just 11th and 12th, you took classes? Do not go to college. Teachers don't teach in college. So where did you go? Which is like a VCA. It's the name of a class, college class. VCA. In Aunt. Okay. Sorry, is it Vikrant? You went to Vikrant, huh? I know Vikrant. Huh? It's fun? और कौन सा बहरे ma'am, right?
She doesn't teach anymore.
Yeah, I know. Her son was my student, so I know her.
I tried for 11, but I didn't like them a lot. Like the people who are teaching now. So I left at 12.
Sir, new teachers are more charged. So is that a good thing or bad thing? School, did you attend school regularly? School to compulsory hota hai. School you must have attended, right? Which school did you go to? Army school. Where? Pune? Where is it? Dighi. Nice. Yeah, like, is it that in army school only people with army background go or? Mostly army. हाँ? सीट्स बची तो बाकी है. अच्छा, तो आप उस वाले में थे या? नहीं, मैं इसको पूछ रहा था. पर नहीं, तू भी बता दे भाई तेरे. You were where? That's a fancy school, right? Vibgyor, no? I've heard it has, I see buses. Where is it? Vibgyor means those 7 colors. Why hota hai Vibgyor? It's not a fancy school? It is. Expensive. Which is the best school in Pune? DPS. Delhi Public School. Bishops is also famous. ओके चलो पीछे मच्छी बाजार कम करें. थैंक यू. वाह वाह एक ही बार में मान गए तो. चलो शुड वी स्टार्ट स्टडिंग? Last 1 hour I need your 100% now. Okay, all in. Anyways, you've endured the session till now, so might as well give you 100% for last 60 minutes and take the juicy part home, right? At least when you'll sleep in the night, you'll sleep with satisfaction कि कुछ किया है. FEB candidates don't need motivation because I told you the source of motivation now is from somewhere else. You know? All right, here we go. So we're starting with securitization. You know how securitization is, but I'll still give you a quick review. You create a structure, we call it as SPE. In this structure, you buy a bunch of bonds, a bunch of loans, whatever, and then right of this structure, you sell to different investors. That's your classic securitization. At times, what you do is, within this, you create different layers. You say, hey, to you, we'll give you a safe bond, but we'll give you less return. So you pay this fellow first. And to this guy, you say, we'll give you a risky bond, but we'll give you more returns. And then you pay to this fellow last. So you kind of redistribute certain risk or you package it, right? All of it is classic financial engineering. You don't have to do the engineering. You have to memorize a ton of things with securitization. Okay, so let us start. Securitization is, it pools and transfers the ownership of cash flow generating assets, typically from original lender into a specially created entity, we call it as SPE or SPV. Special purpose vehicle. The pool of the assets that are securitized are referred to as reference portfolio or collateral. Okay. Now, some of the products that you need to know, one is called the covered bond. Okay. Pool of loans are sold to investors, but this is what I will test you on if I were writing questions. So this I will give a 5-star, a high chance of this showing up, which is loans are not transferred to SP, they remain on balance sheet. Okay. So which means I am a bank. I have given a lot of housing loans in Pune. I can bundle them and then put them into a structure, not a SP, keep them on my balance sheet and give rights of those loans to someone else. Okay. Now this has an advantage and disadvantage which we will cover later. But therefore covered bonds are not considered full securitization. Then pass-through security is your classic securitization where you create a pass-through structure. And finally, some of these bonds you create a structural enhancement, which means some bonds will have high priority, some bonds will have subordinated structures. Now, within pass-through, we have mortgage-backed and we have non-mortgage-backed. Mortgage-backed, we have RMBS, CMBS and CMO. RMBS means residential mortgage. Mortgage simply means loan, housing loan, okay, or a loan against property. Residential, commercial, and if you kind of create some sort of a complex structure out of it, we call it as CMO, collateralized mortgage obligation, we'll learn. Non-mortgage, we have collateralized debt obligation, collateralized loan obligation, collateralized bond obligation, and then we also have CDO squared. So total 3 products here, 7 products here, plus we have to learn a little bit on covered bonds. Then what is tranching? Look at this. I have Tranching basically means I have assets of 100. Okay. What I'll do is I will break down those assets when I sell the security as 70, 20 and 10. Okay. 70 I will go to those folks, I'll say you're a senior tranche. Tranche means like a part. Okay. Broken down into tranches. You're a senior tranche. You will get first priority for repayment. So I'm selling you a safe asset, but I will give you only MRR plus 40. Second one, a mezzanine tranche, matlab beach wala, MRR plus 250. The third one, last priority, but no fixed return, residual, जो भी बचा है वो आपको दे देंगे आखिरी में. It's almost like, that's why it's called equity. It behaves like equity, therefore this is not rated. Okay, so what will you remember? You will remember equity tranche is not rated. Equity tranche does not have a coupon rate. It gets residual cash flows. What is the benefit to the issuer of this process? Benefit is I can get rid of those assets from my balance sheet, sell them to someone else, get my money, give loans again. Right? So frees up the cash for me. What is the benefit for investor? As an investor, I don't have the skill to give loan to someone. But when I buy a securitized bond, I get a pool of these loans given to someone. So it's indirectly I'm giving loan to a bunch of folks, but I get diversification because it's not one person, it's a lot of people. And the loans given hopefully are good quality because issuer had those abilities. So that's the benefit to the investor. And benefit to the economy, it decentralizes the risk. If one bank is giving all the loans in your country, imagine if something goes wrong to SBI tomorrow, those loans default, SBI will be in trouble, the whole country will be in trouble. But if SBI securitizes them and sells them to thousands and lakhs of people, if something goes wrong to those loans, everyone will have a little bit of loss. So decentralization of risk, therefore it's good for the economy. Which are the parties? One is the seller of the collateral. Okay, these are also called originator. Then an SPE. Between the two, they create an agreement called as the purchase agreement. And then servicer, which could be same as seller or different. What do you mean by servicing a loan? Vasuli. Time to time vasuli, right? So time to time I should get my coupon payment, whatever. That process is called servicing the loan. Okay. Do you know who a trustee is? I'm kind of looking at this stock. I haven't bought it, but I might, but not now. But I'm hoping it falls, and then we will buy it. It's called Beacon Trusteeship. Okay, what do they do? So imagine I am issuing bonds. You guys are buying. Now, you want me to pay you time to time. You want me to ensure that all the payments are efficiently done. So you would put a condition that Utkarsh, please hire a trustee. And then trustee will be responsible to ensure that I am making payment to you on time. If I don't do it, then trustee is the one who will go and reach out to credit rating agencies and do all of it, right? So trustees is that trusted third party in between. Now there would be technical difficulties. For example, let's say I was supposed to pay you coupon on a Sunday, but I did not, right? A lot of times trustees will then ensure that I'm paying to you on Monday at least. So trustees' job is to act on behalf of the bondholders, investors. But trustees are hired and paid by whom? The issuer. Is it okay? So in India, we have Axis Bank doing trusteeship business, and we have some private trustees which have come up now. So a trustee is an agent. At times is known as known as a disinterested trustee. Typically a financial institution that safeguards the asset after they have been sold to the SPE, holds the fund due to ABS holders until they are paid, and provide periodic cash flow to ABS holders. That's the job of a trustee. Then what?
Trustee is only for securitized loans or
No, even for normal bonds. Trustees are for securitized loans, trustees are also for bonds. What is the role of SPE? It's just a legal placeholder for bonds. But one of the benefit of SPE is it gives you something called as a bankruptcy remote protection. Okay, now that concept you should know. This is HDFC Bank. Okay, now this is equity shareholder of HDFC Bank, and this is a lender to HDFC Bank. Okay, let's say depositor or whoever the lender is, let's call it Mr. X. Okay, now HDFC Bank has given some housing loans. Okay, what HDFC Bank said? HDFC Bank said that these loans I will sell to, right of these loans I will sell to different investors. Okay? Now, is this a covered bond or is this a SPE structure? This is a covered bond because I'm keeping the balance sheet on my books. Now what happens is that HDFC defaults in payment of this to Mr. X. Now Mr. X will come and Mr. X will claim rights on all the assets which are there on balance sheet asset side. Because that housing loan is already there, Mr. X will come and claim ownership of housing loans. But this investor will say, hey, we've already paid for it, right? We bought the housing loan proportionately. He will say, I don't care, it's already on the balance sheet. So there is no protection from bankruptcy of the issuer, correct? But if I structure it like this, that I create a new entity and transfer the loan to new entity. And now this entity sells the protection to investor. Now the loans are not there anymore. Now if Mr. X is mad with HDFC Bank and he wants to claim assets of HDFC Bank, he cannot claim these housing loans. That means it gives you bankruptcy protection. Therefore, these are called bankruptcy remote entities. Okay, so testable, you should know the bankruptcy remote entity. That's the benefit of having a SPE. Then reading number 2, which is on ABS, asset-backed securities. First concept we look at is covered bond. Now, covered bonds are generally famous primarily for aircrafts. That's where they're primarily put to use. These are senior debt obligations, typically backed by a pool of assets which are commercial or residential mortgages or public sector assets. Covered bonds that are backed by ship and aircraft have also been issued. In fact, that's where they're most famous. They work similar to ABS. So I want to buy an aircraft. I can go buy the aircraft and then issue the right of that asset, aircraft being the collateral, and take a loan. If I don't repay the loan, the lender will have a right on the aircraft because that's an asset which is indirectly kept mortgaged. Covered loans remain on the balance sheet and are ring-fenced into a separate cover pool. So you create a pool within a balance sheet. Now, the benefit that the investors get for covered bonds is they get something called as a dual recourse. Okay, what does that mean now? So referring back to my previous image, I told you that Mr. X is mad. Okay, so he will claim assets of HDFC Bank and he will also claim, he will not be able to claim housing loan. But imagine a situation where, let's call these investors as Y investors. Imagine Y investors are not happy with repayment. Right now, Y investors can claim assets only of this SPE, right? But imagine if there were no SPE and if the loan were sitting on the balance sheet like this, then Y can claim these loans, okay, these housing loans, but Y can also claim other assets, right? So Y will get more protection in these cases. That is referred to as a dual recourse. Dual recourse means दो जगह से मैं recovery कर सकते हैं. One, I can go and sell those assets, but I can also have a general claim on other assets on the balance sheet. So covered bonds give you that. Okay. Uh, then green covered bonds, anything that's green means what? Environment friendly, renewable energy. Now, dynamic nature of cover pool. Covered bonds issuer must replace any prepaid or non-performing asset to ensure sufficient cash flow until maturity of the covered bond. Covered bonds usually carry lower credit risk, offer lower yields than otherwise similar ABS. Okay. Now, what is the dynamic nature of pool? That means the underlying assets in that cover will keep on changing. They will not be constant. Example, let us say a covered bond issued on credit card loans. Okay. Now, the thing with credit card loans is, I cannot say that, let's assume I have given loans to these two ladies in the front row. Now, is credit card loan for 10 years? 10 months? No, maybe typically 2-3 months. So, if she comes and gives me money back, then what will I do? I will take this money and give credit card loan to, let's say, her. Which means the nature of the composition of asset in my pool will keep on changing. That's called as a dynamic nature of cover pool. Covered bond offer two additional tools to mitigate risk. One is over collateralization. This concept will repeat again and again, which is very simple. On my balance sheet, if I have a pool of 100 rupees, I will actually issue bonds worth only 90 rupees. Why? So if there is a default, I have that spread of 10 rupees. So collateral value is more than the value of the loan. That's called over collateralization. Second, LTV ratio, which is similar. LTV ratio means if I have a collateral value of 100 rupees, loan will be given maybe of 70 or 80 rupees. So they will have certain LTV ratios on mortgages. Then redemption regimes. Redemption means how will the money be paid back? They align covered bonds cash flows as closely as possible with the original maturity schedule in the event of default of covered bonds sponsor. Okay, very interesting. Read this. Align covered bonds cash flows as closely as possible with original maturity schedule in the event of default of the sponsor. Okay, how do you achieve that? So you have 2-3 different variations. Hard bullet covered bonds, soft bullet covered bonds, and conditional pass-through covered bonds. Okay, now theory testable, so make sure you remember. If the payments do not occur according to the original schedule, a bond default is triggered and bond payments are accelerated. When that happens, this is referred to as hard bullet. This is especially very important in a revolving structure. What does it mean? Imagine the candidate sitting on the left of the classroom here. I give each one of you a credit card loan. Okay? And then the rights of those credit card loans I sell to each one of you. Now what happens is that some of these people are paying me back the loan, then I am continuously issuing new loans, so my asset pool is changing. Unfortunately, this quarter I defaulted in payment to some of you. The moment I make one default, then if there's a hard bullet structure, what it would mean is it would prohibit me from reissuing new credit card loans. So when these people start paying me back loans, earlier I was revolving them, right? I was rotating them. Now I cannot. So when you give me back your loan, I immediately have to take that money and give it back to the investor. I cannot keep on revolving the structure anymore. In what condition? If it's a hard bullet structure. A soft bullet structure, covered bonds have scheduled maturity date and extended maturity date. Soft bullet covered bonds delay the default and payment acceleration of bond cash flows until a new final maturity date, which is usually up to a year after the original maturity date. Which means what? Which means, imagine I was supposed to pay you a lump sum amount, okay, but I started experiencing default. So then I will extend the maturity by 1 year. Until that time, I will try to recover as many credit card cash flows as possible, and then I'll make you a payment. That's referred to as a soft bullet structure. And a conditional pass-through structure, convert to pass-through securities after original maturity date if all the bond payments have not been made. So then I will take all my credit card loans, put them into an SPE, and make you take your covered bonds and in return give you SPE ownership. समझे ना? Covered bonds, that credit card asset is sitting on my books, right? Now I'm not doing well. I'm defaulting. So what will you say? You will say, Utkarsh, please pay money. I'll say, these are your credit card loans. खुद देख लो. So how खुद देख लो? I'll create an SPE, put all the assets into that SPE, and I will give you rights of that SPE to you. You handle now. You handle as in, there would be servicer, but now you get direct. So you convert a covered bond structure to an SPE structure in case of a default. Okay. Then credit enhancements. Credit enhancements means, and this is where I think if you've seen that Big Short movie, it helps. What is credit enhancement? I can give loan of very, very poor quality. Okay. Bundle them together, and credit enhancement is like some sort of a magic masala that I sprinkle on top of it. And suddenly when the bonds that I'm selling you, which are securitized on that loan, they will have AAA credit rating. How? So these are the different ways of doing credit enhancement. One is over collateralization. Easy. I will give 100 rupees of loan, but I'll sell you securities only worth 80 rupees. So we have a buffer of 20 rupees. The second one is called spread. Okay. Now what do you do in this spread? Look at this. Underlying loan pool may pay 8%, but you promise only 6%. So you save 2%, you create a buffer of that 2% over a period of time. In case if there is a default, use that cash and pay. That is called excess spread. And finally, subordination or tranching, which is I take all the loans, but I don't issue equal securities. I issue some securities which are senior, some securities which are junior. Maybe this part I would like to explain a little bit better. I don't know how well you've understood subordination. Who is this? No. Huh? Borrower. Okay, now all of these folks, let's assume, has anyone traveled through Kerala? Yeah? You should. Okay, we have someone from Kerala here. So you'd see, like if you get into leave cities and go into rural parts, Kerala actually has some phenomenal houses. Okay, like you'd see big bungalows being built. A lot of those bungalows are actually funded through Middle Eastern money, right? Dubai money, hai ki nahi? So all the Mallus will go to Dubai, work there, make money, but they want to build house in their village in Kerala. Okay. Now let's assume that these are different Kerala houses and they have taken loans. Okay, so loan for each of the house they have taken loan, and let's assume that ability to pay is there, but willingness is not there. Let's assume that it's a very poor quality loan. Now, because it's a very poor quality loan, if I am selling that to investors, let's assume to investor, obviously the rating of this will be low because the probability of default is higher. But what I'll do is, I will say to the first guy, I will say, listen, you buy bonds of 70 rupees. I'm giving you a promise of AAA. How is that possible? Because to second guy, you buy 30 rupees and you are buying subordinated tranche. Okay. Now, this loan is worth 100 rupees. Okay. Let's assume that 20 rupees I receive from the loan pool. I will take the whole 20, give it to this guy. Not give anything to the subordinated. Okay. Let's assume now out of this one fellow who had taken loan of 10 rupees defaulted. Now logically that loss should have been shared between the two, but now I will say, you know what, ye lost tera. The subordinated one will take all the losses. The senior one will not get any losses. Then the next guy paid 40 rupees. I will take that, give that money to him. So now someone who invested 70, they've received how much? 60 already. Someone gave 10, I will give it to him. After that, if there is anything left, then it will be given to subordinate. This is oversimplified, but this is a concept. Which means by creating these tranches, I might have a very poor quality loan, but I can still create a very high quality bond. And larger the value of subordinated tranche, safer the senior tranche. Because that is like your buffer, absorption buffer. Understood? Cushioning. Then external credit enhancement. Here we have letter of credit, cash collateral accounts. Simply means, external means, the best way to do external is buy a CDS. Insurance. That even if there is a default, we have insurance. So therefore, the bonds have become safe. Then this is your tranching process. Credit tranching. It's an ABS. ABS stands for Asset Backed Security. Tranche A, B, C, D. Sequentially you pay to A, then B, then C, then D. समझाइए? Internal, no? See, internal means whatever engineering that I am doing myself. External means मैं बाहर किसी से जाके कुछ लेके आ रहा हूँ. Like a letter of guarantee, a letter of credit. That's external. Internal means whatever structuring I am doing within myself. Okay. Now this is referred to as what? This is referred to as waterfall structure. Why waterfall? Because pay first to this guy, then this to this guy, right? Waterfall structure. The last tranche is called equity, which is the residual claim. Then non-mortgage ABS, amortizing, non-amortizing collateral. Amortizing means the loans that I've given, those are similar to auto loans. What happens in auto loan? You pay EMI, some part of the EMI is interest and principal. What can you think of a non-amortizing collateral? A term loan, right? Companies take term loans where for 3 years they'll pay interest, then they will pay principal. A bullet structure, credit card debt, it's non-amortizing. Okay, now credit card receivable. Again, in the US, unfortunately, this whole industry must be under a lot of pressure right now. Thanks to the genius of Donald Trump, who says now you cannot charge more than 10%, which is so stupid and bizarre. The US Treasury we saw is giving you how much now? 4-5%. We saw no US PAR is giving you 4-5% type of ballpark. Now credit card, if someone is defaulting, that's the highest tier of credit risk. So you want to charge them sufficient to recover the business. Now if this continues, most of the banks will stop doing credit card business because he's capped the interest rate to be charged at 10%. But anyways, back to the topic. These are, I told you, revolving pools. Why revolving pools? Because people will pay back the credit card loan, so you have to give it to new people, right? So you have to keep on replenishing the pool. Then solar ABS. This, if you watch my main video, I've given some stories on this. It's actually a very, very attractive investment product in the US. I don't know if I studied this market 3-4 years ago, but what was so cool about this is that when I give loan for a solar panel to someone, do you know what I keep as collateral? Their house, which is insane, right? Because that means the probability of default could be high, but loan given default is 0. If someone defaults on the payment of solar panel loan, वो जाके घर ले लेगा, right? And that means almost 0 default risk plus ESG compliant. So lot of demand, right? So it was a fantastic opportunity. Solar loans allow customers to borrow the cost of purchasing from installer. The utility cost saving from switching to solar energy will exceed the cost of investing. At least that's the pitch as a salesman you'll have to give. That please install solar, you will save more than what you are investing. right? Which is true right now. Right now is still economical. Plus it has a ESG angle, and then you can do some sort of a ABS around it. When solar energy system loans are structured as residential home improvement loan, the solar ABS effectively securitizes a subordinated mortgage loan on the property. This is why solar ABS investors look for this type of debt. Solar loan borrowers are prime borrowers that their own homes and have good payment records. Additionally, solar ABS are protected through over collateralization, subordination and excess spread, which means it makes the whole solar ABS extremely safe investment avenue. Then we go to CDOs. Think of CDOs as a mutual fund of various mortgage-backed, asset-backed securities. Okay, where there is typically a CDO manager, a fund manager, and the manager will manage the pool of assets efficiently. So CDOs are securities backed by diversified pool of multiple debt obligation. If you buy corporate bonds and emerging bonds in your pool, then you are called as CBO. Okay. If you buy leverage loans or leverage bank loans, these are typically loans used in private equity structures, then you are called CLO. And if you buy CDOs of other company into your mutual fund, into your CDO, then this is called a structured finance CDO or CDO squared. Samjha na? Then what is a synthetic CDO? This is typically achieved, now you don't need to get into maths, but I'll give you, by buying treasury bonds plus selling CDS. Okay, now think about it this way. Imagine I am Tata Motors. Today Government of India rate is 7%. But if Tata Motors needs to borrow, they will have to pay more, let's say 3% more. So Tata Motor borrowing cost how much? 10%. Okay. Now, if someone is buying a CDS on Tata Motors, that means they want a protection against the credit risk. What should be the premium on that? 3%. Because that is the credit spread, no? So now, if as an investor, I buy Tata Motors bond, I get to earn 10%. I buy Government of India bond, I get to earn how much? 7%. What I'll do is, I want to buy Tata Motors bond, but I will not. I will buy a treasury bond of 7% and I will sell CDS and earn 3%. The moment I sell CDS, I get 3% and I have exposure to Tata Motors credit risk. This is referred to as a synthetic CDO. Okay, so what you need to know in a synthetic CDO, you make use of credit default swaps. Is that okay? And of course, a CDO will always have a CDO manager whose job is to ensure that there is sufficient pool. Okay. This is how a CLO structure looks like. Okay. What you do is you have multiple collateral. Your collateral is made of senior secured loans of multiple banks. Now generally the value of collateral should be more than the value of debt. Okay. Why is that? Because of over collateralization. No? Collateral is more than the value of the debt. You have typically 100 to 225 issues actively managed. You break it down into these tranches. Okay. AAA tranche, AA, BBB, BB and equity tranche. First loss will be borne by equity tranche and then these tranches are protected. Subsequent losses are borne by these guys and finally if there are very large losses then only they will reach to AAA. The collateral manager must continuously meet various performance tests and collateral limits for underlying collateral. If the manager fails a pre-specified test, a provision is triggered that require payoff of principal to the senior bond class until the tests are made. Which means you have to have certain quality of collateral, over collateralization, cash buffer, वो सब ratios रहते हैं. If you are in violation of those, it will immediately trigger a default provision, and then these folks will have to be paid right away because you promised them a AAA rating. Then, a typical feature of CLO transaction is that collateral of the portfolio is not finalized until after the transaction closes. Similar to how a mutual fund is, where you subscribe to a mutual fund and then with your money they will go and buy assets. Similar will happen in case of CLO structure. And of course, equity tranche is not rated. Okay. Now, what are those tests? So, here's your test number 1, over collateralization test. Value of collateral has to be more than value of debt issued by CDO. If the test is failed, cash will be diverted away from equity and junior CLO debt tranches and it will be paid to senior tranches. Then some other test, measurement of industry diversification. तो उसके लिए एक टेस्ट होगा that are you diversified broadly within your asset pool. So those type of items will be looked at. Role of collateral manager. Collateral manager is purely the fund manager of the whole collateral pool. And now in the final reading, MBS. MBS is typically on mortgage, RMBS, CMBS. RMBS means residential, CMBS means commercial. Now, whenever you're giving a mortgage, one of the metrics you want to look at is LTV. Do you want LTV higher or lower as a lender? Lower. You 100 rupee a house, you give only 40 rupees of loan, you're safe, right? Then you want to look at debt to income ratio. Do you want debt to income higher or lower? Lower. That is, someone is making annual income of 100 rupees, you don't want to give them loan more than 400-500 rupees. Prime loans means good quality loans, subprime means poor quality loans. Then agency and non-agency RMBS. Now this is very US market specific. In US, if you are a prime borrower, prime means a good quality borrower, you're actually not taking a loan from a bank, you're taking a loan from an agency. Might be funneled through a bank, but all the good quality loans are bought up by these agencies. There are 2-3 agencies. गिनी में ऐसे 2-3 नाम है उनके. And if you are a poor quality borrower, then the loans will be given to you by the banks. Okay, some contingency features. First option is prepayment option. Prepayment option is similar to call option, calling a bond, right? Prepayment option creates what type of risk? Reinvestment risk. People will prepay the loan when the interest rates have fallen. Now, how can you protect? You can charge a penalty for prepayment. Okay, now legally it's not allowed on residential mortgages. Do you know that? No. So in India, if you take a housing loan, you can prepay whenever you want. RBI will not allow bank to charge you a penalty. Okay, but personal loan they will. Now I remember back in the day, there were prepayment penalties on housing loan also. Then RBI came up with notification saying no. लोगों को घर बनाना है, if they want to prepay, why not? Let them prepay. Axis Bank used that as an opportunity. They ran a massive advertisement campaign saying, now you can prepay, we will not charge you a penalty. But every bank was doing it, but Axis Bank just capitalized on that particular new regulation. Then a recourse loan. Recourse loans mean you can have 2 types of loan, with recourse, without recourse. With recourse means if you default, I have the right to come and take your personal assets. Without recourse means I cannot. Then underwater mortgages. So if your mortgage is a non-recourse loan and if the value of your house has fallen below the value of your loan, छोड़ दो. Right? Those are called underwater mortgages. And if your mortgage is underwater in a non-recourse, then you default. That we call as strategic default. If mortgages are with recourse, can you do a strategic default? No, because then the bank will come and take your personal assets. Then RMBS, अरे बैकपैक करना शुरू कर दिया, बैठो भाई 5-10 मिनट. RMBS, residential mortgages. Now you need to, you need to know these numbers, by the way, WAC and WAM. What is this? So in the US there is a famous structure called 2/28 or 2/25. When you take a housing loan, and I didn't know this, and first time I got to know this, I was really stunned. US banks have innovated to a level where, let's say you take a housing loan, your EMI is going to be 50,000 rupees, okay, for whatever. What happens in the US is bank will say first 2 years you pay EMI of only 10,000. Right? We'll make it very easy for you, and in 2 years anyways the rate will increase. So you sell in 2 years if you're not able to pay more. And then next 28 years will charge you a higher rate. So typical housing loan duration in the US could be 25 to 30 years. Okay. Now, over a period of time, some folks will prepay, some folks will not pay. So what I can do is I can calculate a weighted average time left for payment. That is referred to as a weighted average maturity. To some people I might have given loan at 10%, to some of them 15%. I can also calculate weighted average coupons. Why are they important? Because this will determine how much interest I'll be able to generate. This will determine how long the bonds will be there. Then CMOs. CMOs are structured RMBS and CMBS. Structured means you create tranching. Now there are different types of tranching you create. The first one is called sequential pay. The name itself tells you the story. Now what is the beauty of this? Imagine this is my loan pool and I have given loans on an average of 25 years. Okay. What I can do is I can go to some investors and I can tell them, you want a 5-year bond? I will give it to you, don't worry. Some other investors, you want a 10-year bond? No problem, I have it available. Some other investors, you want 25-year bond? Sure, I'll sell it to you. So, housing loan that you've given is 25 years, but against that loan you're selling 5-year bond, 10-year bond, also 25-year bond. How are you doing it? Very simple. What you do is when these people who've taken loan start paying you back, पहले आप इनको पैसे दे के चुकता करो. So get rid of those 5 years, pay them a little bit more beginning. After that you pay these folks, and after that finally you pay these guys. This is called sequential pay CMO. Have you understood this? Now in this process it creates two risks. Which risk? Extension risk and contraction risk. So when I assume that this housing loan is for 25 years, I assume that कुछ लोग prepay करेंगे. Some people will prepay. Okay. Now what if in practice more number of come and prepay the loan? Then I will not have a choice but to pay these guys faster. So their loan bond maturities will compress. That is called contraction risk. What if no one came and prepaid me? Then maybe instead of 25 years it will go to 28 years. Then their bond maturities will extend. Those are called extension risk. Is that okay? Then this is the last tranche, Z tranche. What happens in this? You get payment after everything else is taken care of, which means if I get excess payment faster, I will give it to you. I will normalize the payment of the main tranche. If I get slower payment, I will not give it to you, so that I will normalize the payment of the normal tranche. So which means ज़्यादा आ गया तो इसको चिपकाओ, कम आया तो इसको भूखा रखो. Are you getting hang of it? This is referred to as the Z tranche. Then a PO tranche and a IO tranche. PO means I will repay you only through the principal. IO means I will prepay you through interest. Now, if you are the owner of PO tranche, would you prefer principal repayment made by the homeowners faster or slower? Faster. Jaldi jaldi paisa वापस मिलेगा ना. So I will earn more return on my investment. Getting hang of it. If you're a IO only investor, will you prefer homeowners to pay loans faster or slower? Slower, because then they will pay me more interest. So that's how POs and IOs behave. Then you can create a floating rate tranche. You can also create inverse floaters. How does the inverse floater work? We saw a regular floater works this way. MRR plus spread, right? An inverse floater works this way. 10% minus MRR. So if the MRR goes up, your coupon reduces. If MRR goes down, your coupon increases. Those are called inverse floaters. Then residual tranche means the one that gets last payment, equity tranche. Then there is a concept called PAC. PAC thoda tough hai. Let me see. Are you absorbing? Yes. No? Until? Until PAC, yes. Okay. So how does PAC work? PAC stands for Planned kya? Amortization class. Now, it's a very complex modeling topic, extremely mathematical. I'll try and simplify this for you. If I give loan to a fellow, right, and let's say if I loan is 25 years of loan, do you think the loan will last for the whole 25 years? Maybe or maybe not. But imagine if I've been doing this business for last 20-30 years, I would have some experience that on an average people will come and prepay a little bit. Hai na? Now, how much will they prepay? So I can make some assumption. Let's say a base case assumption, okay, that a 25-year loan, on an average people will prepay for about 2 years, so it will last for 23 years. Okay? But if my assumption is violated, and if they pay faster, then maybe the payment will happen in just 21 years. But if my assumption is violated and people pay slower, then the payment will happen in 25 years. Now these assumptions, I can give them some name. Okay? So let's say this assumption, base case assumption, I can call it 100 PSA. Let's, for the timing, just think of it as some sort of a level, 100 PSA. If people are paying faster, maybe I can call it as 150 PSA. If people are paying slower, I can call it as 80 PSA. Okay? Now, in the US, this assumption is available through a quasi-government body, which has historical rates of prepayment. And then historical rates of prepayment, the average rate is referred to as 100 Public Securities Association. That's the PSA. Okay? Now, when I am sitting with my investor who are also aware of, so imagine I have a portfolio of housing loans now. Okay? And this is the the manager. The manager will say, investor will ask that looking at the quality of assets that you have, what do you think is a good assumption for your loan repayment? Manager says, I think I'm close to 100 PSA. Okay? Or manager will say, you know what, the kind of people I have, I think they will pay faster, so I'm at 150 PSA. The moment I say 150 PSA, that means they will pay faster. They will pay faster means पैसे जल्दी आ जाएंगे, so I have contraction risk. Okay? This investor says, listen, I don't want so much of risk. Okay? Now what if you think it's 150 PSA, but what if people actually pay at 400 PSA? Then I have a problem. Or what if people pay at 50 PSA? That means they pay slower. Then also I have a problem. What you do is, you create a tranche for me. In that tranche, you promise me that if you assume that your average is 150, you promise me a range of, let's say 120 to 180. Which means, the cash flows that you would give me, the cash flows should be based on the assumption of either on the lower side 120 PSA, on the higher side 180 PSA. If your actual payment turned out to be, let's say 200 PSA, you have to give me cash flows as if it's 180 PSA. फिर वो excess cash flow कौन लेगा? ये बेचारा नीचे वाला support tranche. So by doing this, you're trying to curtail that prepayment risk, which is made of extension risk and contraction risk. So this is called as a back tranche. You're protecting your investor against significant faster prepayments or significant slower prepayments. Did you understand this? Okay. Then CMBS. Okay. Now CMBS, from exam perspective, you need to be aware of the two main features CMBS have. One is they have a call protection. And call protection they actually have on two different levels. Call protection means prepayment protection. कि आप prepayment नहीं कर सकते, है ना? Protection against prepayment on two different level. One is the structure level, one is the loan level. Okay, what is the loan level? First protection is called prepayment lockout, which means for the first, it's a 10-year loan, but for the first 3 years, we will not accept any prepayment whatsoever. It's a standard practice even in India on a commercial loan. Because to give loan to someone, it incurs cost. I have to recruit employees. Have people called you for taking loans? Imagine the kind of cost bank is spending to get your loan. So if I give you a loan, I do all the hard work, and in 2 months you come back and prepay the loan, then I will have a loss, right? So lockout. First 3 years you cannot prepay. Then after that also you want to prepay, I will charge you a penalty, a 2%, a 3% penalty. Okay. After that also you want to prepay, I might have a very strict cost called defeasance. I want you to know this word. This might be repeated multiple times in CFA curriculum in all the 3 levels. Defeasance. Defeasance means what should be a good word in English for it? In Marathi we call it as bharun dene. Nuksan bharun dene. Nuksan bharpai. How should I call it in English? Loss. So I'll tell you what defeasance is, okay? So this is a borrower. He took, let's assume 50 rupees of loan, or for simplicity, he was going to pay you 22, 22, 22, 3 payments. Okay? Now, he made the first payment and then he said, listen, I want to come and prepay the loan. Whatever amount is left. What you tell him is, you tell him, okay, you want to prepay the loan, no problem. You don't pay me cash. What you do is, you give me a basket of US government treasury bond. How much? In such a way that this basket will give me cash flow of 22 and 22. So that I would get the same cash flow that I would have otherwise received had I kept your loan. This process is called defeasance. समझे क्या अभी? Okay, good. This is at which level? Loan level. Now what is at structure level? Structure level, easier way to achieve, just create a sequential pay tranche. So obviously the higher rated tranche gets a high quality protection. Then balloon maturity provision. Okay, what is a balloon payment? One large payment on maturity. Typically, commercial loans are balloon structures, they are not amortizing. So interest, and then one large balloon payment. What is a balloon risk? कि वो बड़ा पेमेंट आया तभी आपको दिया नहीं, right? Balloon risk is the risk that borrower fails to make payment. In this case, the lender may extend the loan over a period known as the workout period and modify the original terms of the loan during workout period. Because the life of the loan is extended by the lender during the workout period, balloon risk is a type of extension risk, right? For a theory question, make sure you know this. Okay, now we are almost to the end. हो रहा है, थोड़ा सा रह गया. If you do it nicely, you will have the motivation of having all in. CMBS risk. RMBS may contain thousands of mortgages, but CMBS are generally more concentrated. Okay, a single default in the CMBS pool can have significant impact on the CMBS investor. Therefore, if I am buying a CMBS, I should analyze the underlying loan portfolio. You can't do that with housing, because housing will be made of 10,000 loans, but CMBS would be made of 20, 30, 40 loans. Now, what metrics you look at? You look at DSCR, NOI by debt service. This NOI we will learn in Thursday's class is a metric that we use when we are evaluating real estate. Very loosely, NOI stands for the rent that I receive, loosely. Okay, so if I am receiving a rent of 100 rupees and if I am giving debt service of 40 rupees, I am comfortable. But if I am receiving a rent of 100 rupees and I am offering a debt service of 95 rupees, the day I don't receive rent, I am in trouble. Right? So that's your debt service coverage ratio. Then LTV ratio, higher or lower? You want lower. And that's it, I'm done. 10 minutes before 11? Good. Congratulations again. Very, very, very proud of you. I want to take your pictures, can I? हाँ अभी एकदम बाल मिल रहा है ना. I am not very good at this, but okay, here we go. Oh, she's you're the only one in entire नहीं ये. Done. Thank you very much. I'm very proud of you. And even online, you guys did fantastic. Stayed through the entire session. Proud of you, of each one of you. Keep on doing the good work. I'll upload the notes before I leave. And then I will see you all on Thursday for the last session in this series, which is derivatives and alternative investments. All right. Thank you very much. Good night. Surprisingly jaldi. There's someone who says warm up done, now let's start the main course. You deserve a treat? Okay, last session. We'll do derivatives first. Thank you guys. I love you too, Anuj. Ethics नहीं. नहीं वो तो मार्च में हो रहा है. रेगुलर सेशंस ना, वो मार्च में होगा. ट्रीट चाहिए तो क्लास में आओ उस दिन. लास्ट सेशन इज एनीवेज गोइंग टू बी लॉन्गर. जो आखिरी में टिकेगा उसको ट्रीट. We didn't solve forward to spot, we did. We did solve forward to spot. I showed the calculator technique and also the formula technique. Thank you guys. Good night. Bye.